We're good. We are Gucci. Right? We're not right. We're good. Yeah. Boa. Yeah, boa. Yeah. Boa. Hey. Okay. All Gucci on this end. We call this thangity thing. Red boxes getting God. How about that? Oh. I mean, not really much catch up on, right? Kind of talked about the whole idea of like you losing the VWAP at the market open, value area high, and then you just straight nuke down from there. We take that shout to you. Also, if you took this red box, shout out to you, right? It's another golden pocket bounce so far. Huh? Huh? What? 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 Yeah, I mean, in terms of like CME, right? This thing was like came right to like fill the RTH gap, tapped the naked point of control, and just kind of went on its way from there. Just filled this whole like, Gaparoonie right here, and then a little ding, boom, 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 boom. What did I just do? Remove some of this stuff. Yeah, you know, kind of as expected, right? On the market open, just straight doo-doo, basically. Straight doo-doo. Get rid of this. Also Tesla, goddamn this Tesla. This thing is being such a little tease, right? They're gonna go or not, or not. Anyways, update our levels. Boom, boom, boom. Boom. Anyways. You know.
Imaginary lines, that's what they say. What? Till price tap twice and fades away. They pressing heat, I'm marking gray. Chalk out hard, I paint that play.
Yeah, the levels. The levels. 851118.
I don't draw dreams, I chart design. And they still mad at imaginary lines. They don't believe, but they get clipped. Price it once, then
Here's a look at the order book in a second here. 863.
yellow dash with silent threat. I don't redraw, I place and let. You post vibes, I post fills. You chase breakouts as I set kills. Line got tagged, they called it glitch. Next move came, I got rich. It ain't random, it's routine. You drink candle, I dream mean. Read 'em. Imaginary lines, that's what they say. What they say. What? Till price tap twice and fades away. They pressing heat, I'm marking gray. Chalk out hard, I paint that play. Dash line glow, they call it luck. Price bounce clean, they stuck in muck. I don't draw dreams, I chart design. And they still mad at imaginary lines. Plot that level, no emotion. Price went back like I stirred.
Well, thing I'll say about this is not particularly strong bounce, right? Not a particularly strong bounce down here.
They so pump, I saw rest. They want chaos, I want code. They get wrecked, I just reload. Dash line from last week's close. Still hold firm while volume froze. Answers, I want edge.
At this point of control will be quite interesting to watch, right? Do we end up like sweeping this thing or end up going from here or no? We're not. We're not. We're not. I'm sure a lot of people are looking at this like kind of channel, whatever, flag, whatever you want to call it. As cooked at this point. Looking pretty cooked. Whether you drew this, whether you drew this. You know, it looks like it's breaking down right now, right? Break them down. Kind of just mathing, right? Doing the math. What's this stuff all looking? The contract rolled over.
I got faith in the math. Let them talk, I don't react. They chase dreams, I trace tracks. Numbers talk back, I move exact. No emotion, just that map. Zone a line, then it snap. They want feeling, I want facts. One clean whip, then I'm back. She said, how you stay that calm? I said, math don't need no charm. I don't flinch, I wait for price. You guess hope, I draw slice. We came close, I don't flail. TP tap, no detail. Didn't pray, didn't stress. Just one chart, no second guess. No candles loud enough to shake. No voice can make me fake. My trust ain't built on faithless moves. It's built on levels that don't. I got faith in the math. Let them talk, I don't react. They chase dreams, I trace tracks. Numbers talk back, I move exact. No emotion, just that map. Zone a line, then it snap. They want feeling, I want facts. One clean wig, then I'm back. Screen too dim, but I still see. Balance built in, geometry. Volume whisper, range got tight. Mass said now, then came light. I don't blink, I just obey. Pattern formed in quiet sway.
What? What? The fuck is going on here? The fuck is this? Okay, no clue what the hell just happened with this chart, but I don't know what this study shit is. No clue how that happened, but okay. Boom, 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 boom. Boom, boom, boom. Okay, we're all done with that. And these moves down, the open interest is just so aggressive. Goddamn. Goddamn. Or just market smashing that bitch. Don't give a fuck. Reckless. Boom, 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 boom. Okay. It'll be interesting to see if we get to this 85 zone, right? Or we start to like front run this and start going. Because this is where all like the spot orders are from like 85 down to 80. We got a lot of bidding the spot order book down here. Have yet to be filled either too. We gotta get on our bullshit, start nerding out here. Okay. A couple of things needed to watch here. Already looked at this. Oh, wanted. Also, I watched the rest of the video with that poker player. I don't know, man. I don't know. Don't know. I do not know. Goddamn, I don't know. You know, I have a feeling that people that are mega juicing the stock market are not known on YouTube, right? Sneaking suspicion. Like, I'm trying to see people that have made like $500 million type shit, right? I don't give a fuck about people that make like $1 million in their career. Give a fuck. Not give a fuck. That is low bro shit. Don't give a motherfucking fuck, boy. It's light work. Okay, we'll power through this shit. Actually, take out this first for anything. Don't mind me as I'm just looking at the daily. I'm just powering through the daily list real quick. Interesting. Yeah, we also never got the news for this stuff, I believe, right? From last I was looking at the gym, all like the weed stuff sold off. Also, all these like clothing, like Gap, American Eagle. What was the other one? They've all been pumping pretty fucking hard, right? Must be Christmas related, I imagine. Not now that I think about it. Probably true, actually, right? Probably is Christmas related. They did the same thing last year. I mean, this is like not comparable to the rest. Definitely something to write down, right? Where's this thing? You do need to investigate that a little bit more, actually. Because how's Bath and Body Works doing? Interesting. That's actually a pretty interesting thought, right? That's like such a that just unlocks such like a fucking massive tree of shit to research. God damn. God damn. Because there's so many seasonal effects like that of like random shit to like look into. During Christmas. That's gonna be a mega nerdo actually. I mean a mega nerdo. Like another interesting one I heard about was the companies like DraftKings and whatnot. Like I don't know if that's directly related to like if they have like a studio, I guess draft. But apparently they're going into the Super Bowl and like the FIFA World Cup and whatnot. These like gambling companies like typically you see pumps. Also need to think about this globally as well. We need to start dabbling more in like emerging markets. Hello, hello, Dev. Micron reporting this week. Yeah, I saw. Pretty slow week though. What else was there this week? There was like one more company, right? Oh, yeah, Nike, FedEx. So I've been curious about this Nike chart. Pretty beat up, right? Quite the massive pullback at this point. Carnival? I mean, what is Carnival? Oh, I need to finish writing this. It's another interesting chart. I mean, it's a bit late, but what was it? United Health Group? Because we're so late to this. So late. Looks like it wants to start kind of reclaiming this level, right? Doing like a pretty big head and shoulders on the daily down here. Interesting. What are you writing a book? No, I just saw that a bunch of like the clothing companies were like pumping, like, well, they've been pumping. Like this one was more news related. Boom, boom, boom. I'm curious, like, is this because like look at these things, right? They're just fucking going like crazy. I'm curious, like, is this just because like, because these are pretty common like Christmas gifts, right? Like this stuff, the Bath and Body Works type of stuff, so on and so forth. I'm curious, is this like more Christmas related, or is there like something else going on here? And whatever, regardless of the answer to that question, just a thought of like companies doing better around the Christmas time or like gift giving seasons. That's like a whole tree of thought, right? There's so many things to think about like that. Because then there's like the whole idea of like, oh, like a bike company, for example, you could expect them to do better in like the spring and the summer, and so on and so forth, right? So I'm curious to, I was writing that down to make notes to go research this stuff like really in depth. Which is why I was mentioning the thing about like gambling as well. Like maybe like during March Madness, you see a huge uptick in these companies as well, kind of thing. During a large. Okay. Isn't the Christmas season already priced in? Government's supposed to get a growth in sales, etc. Yeah, it's definitely late now, but like maybe it's worth like buying it next year in like October or something. Like way ahead of the curve kind of thing. Maybe not, maybe not. I don't know. That's why we need to go research it. I don't know the answer.
I've been trading hard, puffing loud, math in place. You still guessing wrong. I'm still ghosting every space. They chase with. I fade the
The market's looking pretty sus. We'll say that. We'll say that, right? Looking a little suspicious. Hard to say until like we're back into the new year and like volume's really picking up again and whatnot, but
luxury paranoia. I sip white scream. I don't chase that pump. I fade that dream. Your bag too loud. Your chart too green. My entry chill. My zone too clean. Smoke from the wick. I seen that.
trailing 12-month evaluation. No clue. I don't even know what that is. I mean, like, I can like logically understand what that sentence means, but like, I don't know like, the context of why you're saying it. Well, this is interesting, right? I mean, we bought this a while ago. Looks interesting though, right? What's going on up here? Shotar Louis bags. No pun intended. This thing is still holding after the gap up. Interesting.
Trading hot, puffing loud, math in place. You still guessing wrong. I'm still ghosting every space. They chase with, I fade the high, top shelf gas. That logic fly. I'll be trading high, and they stressing low.
When an investor tries to price a stock, you can look at the past 12 months of earnings with a fair valuation. Honestly, I don't really care about that stuff. Don't really care about that stuff. I'm sure it's probably somewhat helpful to look at it, but at the end of the day, like, to me, there's no edge to be derived from looking at that garbage. Like, to think that we're gonna sit here and have some kind of like balance sheet edge over like Goldman Sachs, like TD, or any like large financial institution is like, who cares? Better off just getting positioned properly. Okay. Boom, boom, boom. Interesting. Interesting. Pause this. Swap of this thing.
It's also extended from the 10-week, and that's an exhaustion. So you want to sell into that. And at point L, this is what I call a second extension. So we really accelerate. We have the widest range bar of the entire move. Well, we're very extended from the 10-period moving average. But the key difference between the first extension and the second extension is once you have a second extension higher, the stock will typically sell off either harder or it will take a much longer basing period to reset again. Always use the entry tactics in context of your overall strategy. If a stock's in a downtrend and you're looking to buy a break and recapture, it's not going to go too far, even if it works. You want to be trading, pull back to a moving average where you're in a weekly and daily uptrend.
Okay, welcome everybody to day 2 of the 2024 Traderline Conference.
Seems like all these swing traders are doing the same thing, right? Essentially. Like, I mean, we'll find out if this person's any different. But like they're on like the weekly, and I don't know who came up with this. Actually, we won't even change the chart around. We'll kind of just yap about it. But essentially, they have like the 30 weekly moving average, right? So suppose I'm looking at a weekly chart. And they're just watching for like price to break down from the 30 weekly. And then once it does start to do that, then they go in the daily and then do like the Qualamagi approach of like longing or shorting, where they're just taking a retest, a bearish retest of the moving averages, like once this condition is fulfilled in the higher time frame. And then like down here, it starts to form like a base at some point once like the correction's like done on the higher time frame. And then when it starts to break above the 30 weekly, then the inverse of here, right? They go into the daily with the same Qualamagi approach and look to break out and then get it on a retest of those moving averages. And they try to just swing it from like here to here and from here to here. So far, this is kind of what we're gathering with these people. All taking the same approach. Or what they'll find out is this person doing the same thing or not, or do they have some more nuance? This guy's talking about like deviation away from the moving average is interesting. Something you don't see as often.
Super excited to be kicking things off with Oliver Kell. You all know him as the U.S. Investing Champion of 2020, also the record holder, and he's someone who I've learned an
Interesting.
about.
Interesting.
Trading. I've really adopted his price cycle into how I interpret
A champion, they say.
I hope you guys all find his presentation today extremely valuable. We'll be talking about swing trading from entry to exit, kind of building from the essentials, the foundation, all the way up to the more advanced tactics. Oliver, thank you so much for being a part of this. Really looking forward to your presentation, and yeah, it's great to have you back at the conference.
Sure. Yeah. Thanks for having me.
Of course. Let's dive right in. So, as I mentioned, swing trading from entry to exit, and just a quick disclaimer here, and then Oliver, I'll kind of hand it over to you to discuss what we'll be touching on today.
Sure. So, I mean, today is, I think it's like 45 minutes or something. So it's basically going to be, what I view as like from the high level, all you need to really swing trade, right? And then I'm a big believer that, as you go about learning how to trade, you're going to pull bits and pieces from different people, adopt what you like, throw out what you don't. But I think this can give you a good overview.
Think about this though, like the poker guy from yesterday, when I finished watching that video, that guy doesn't short. Like I had like whatever. We were kind of thinking that while watching the video, but after watching the end of it, like he certainly is not a shorter, which I find so fascinating. Not in a good way, but because he was like talking about it, how like in a bear market he makes no money. So I'm like, how are you gonna trade for a living? And like, what if you're going to prolong bear market? Just gonna make no money for years? A little suspicious, right? A little suspicious.
Kind of at least on what I try to accomplish. And if it helps you, great, and add to it and make it your own. But so the general agenda, so stock selection, I'm going to go through, pretty quickly, the types of stocks that I try to trade. Then I'm going to go through my, price cycle, and then the 3 different time frames that I really use. I do use some other time frames, but this is really all I need: the weekly, daily, and the 65-minute time frame. Then position sizing.
Is buying an inverse ETF going along? I mean, if you want to look at it that way, like yeah, you're long the inverse ETF. But like you are trying to capture the downside move if you're doing that. Like, I don't think like the term long or short like has any bearing in that scenario. Just depends on like what directionality of the baseline asset they're trying to capture.
Some reminders. All right, so we're going to jump right in. So stock selection. So you know, there's fundamental and technical characteristics as to the types of stocks that I like to trade. So I'm generally looking to trade liquid, high priced, and high beta stocks. So for a couple of different reasons, liquid, you just get less slippage, and you know, as you grow your account and scale, hopefully you don't have to change anything you're doing. I don't think anybody listening to this is probably going to run so much money that they can't trade, you know, the most liquid stocks that the US stock markets have to offer. And then high priced, because I think the risk reward is better on high price stocks. So for example, if I'm trading a $500 stock with like a $10 stop, that's 2%. Whereas, you know, if I'm trading a $20 stop, you know, I know some people try to trade some of these $20 stocks with like 10-cent stops, but I find a lot of the times you need at least like a 50 or 60-cent stop anyway. Or sometimes even like a dollar. So you're risking like 5%. Now they can be much higher beta. They can make quicker moves. But I just kind of view it like the risk I have to take on a high price stock is lower, and the gains, you know, kind of take care of themselves. And then high beta, you know, I typically want to trade faster moving stocks. You know, I don't hold a ton of stocks, you know, typically 5 to 10 stocks. So I want to try to get, you know, names that are moving when I buy them, you know, rather than something that's trading at the same speed as, you know, the index ETF. You know, I want something that's hopefully moving, you know, 2 times that.
Makes sense.
So those are kind of the three just, you know, basic high level characteristics. Um, you know, I say I like to trade stocks over $20, ideally over 50. But a lot of the time I'm trading stocks that are over $100 a share. I mean, that's not like a hard rule or anything. If I find a stock I think is interesting, that's, you know, a 25 or $30 stock, I'll trade it. But oftentimes, you know, 3 to 5 names make up a lot of my gains on a year, with 1 to 2 names being the majority of that. And a lot of the times those are $500,000 stocks. So probably the last 3 or 4 years, those stocks have basically been Tesla, you know, in like 2020, 2021, and then Nvidia in like 2023, 2024. And, you know, they were both, you know, triple digit, quadruple digit stocks. Then strong institutional support and high dollar volume. So strong institutional support, high dollar volume, you know, the next question that often comes is, you know, how do you, you know, what are you looking for? Like, which mutual funds do you want to see owning your stocks? And that's not really what I mean. Is what I really mean by this is that, you know, the way that they trade, they're not like whipping all over the place. They don't just like downtick, you know, like 5% on the open for no reason on no volume and then come back. You know, this is another way of saying, you know, they have liquidity.
No shit
And
coins,
a lot
no
of these
shit
stocks
coins in the
that
stock
fail,
market, basically.
I find that kind of institutionally supported stocks kind of hold their patterns better. They hold, you know, what I consider to be proper support better, which just makes them easier to kind of size up, and, you know, trade. Now there's downsides to that as well. You know, sometimes they don't move as quick when you're right. So, you know, there's trade-offs, but those are the types of stocks that I'm most comfortable trading and that I tend to gravitate towards. High dollar volume. Now this is going to be different for everybody. You know, let's say you're trying to buy like a, you know, $100,000 position or something. Like I sort of feel like at a minimum, like an absolute minimum, you know, you want to be trading like a, you know, $20 million a day dollar volume. Now for me, I would say the majority of the stocks that I'm trading, if I have to look up the dollar volume, like I'm probably not trading it. A lot of the stocks that I trade are trading like billions of dollars a day, and I can clip off, at least for me, what I consider to be a pretty significant position, and, you know, no one even really knows I'm there. You know, I start getting down into the names that trade like, you know, $50 million a day. I sort of find there's just a lot of slippage, no matter what I'm executing. And then next, and probably, you know, maybe most importantly, is that you want them to have.
Curious how much size this guy
basics.
trades with. Oliver Kell. Trader.
So if a stock is extended on the weekly time frame, you know, it may like break out on a daily chart pattern or something, but it's probably not going to have an extended move. Whereas if it has a weekly base and it's kind of turning on the daily, and it's starting to move on the daily time frame, you know, you've got a chance for it to be, you know, maybe like a 4 to 10 week, you know, sometimes even multi-month, you know, move. And that's really kind of my sweet spot. Is I'm typically looking for multi-week, 4 to 10 week kind of.
I asked ChatGPT, it said buying an inverse ETF is going long. Gemini had a seizure when I asked. No, I'm starting to think that this tournament, this whatever competition that they partake in, like the United States Investment Championship, I'm starting to think this is just luck who wins every year, right? Because they're all doing the same fucking thing. Literally every single one I've seen, they're all doing the same shit. It's just a matter of like who got a better entry at the bottom of some large swing trade and didn't get stopped out before the move actually happened. Seems like the TLDR of this thing. But we'll see. Maybe this guy knows a little bit more. They're all gambling. They're not pro traders. I don't know about that. What is your definition of a pro trader? They're not gambling. It's just their strategy. Interesting. Oh, interesting. This method comes. Okay, that's interesting because we've seen another. This CAN-SLIM method. Who was the last person that mentioned this? We saw somebody that said the same thing. CAN-SLIM. Oh, it was with that PhD guy. Samir? He said the same thing. It's from the book How to Make Money in Stocks. Interesting. Trading as you can never buy something you can't sell. You must have an edge. That is their edge. Trading the high time frame breakout is their edge. If it's not broke, don't fix it. If all these people are doing it and it's working successfully, like that obviously works. I'm curious about the slippage statement though, because apparently he only trades under $1 million, so it seems a bit odd that he would have slippage on these like. Well, I guess it makes sense. If it's like $50 million daily volume, and you're trying to do, that's the thing. He wouldn't have his whole account at one trade, right? I mean, I guess we'll see.
Earnings cycle type moves.
Maybe that's
and
30%.
And I'll probably a lot of the time I trade the same name over and over again. But I might get in it, when it sets up again. But typically I'm looking for that, kind of 4 to 10, 12 week type trade. And then I kind of hop off and just let it set up again. Even if I buy it back sometimes, even at a higher price, I don't really care. That's just kind of, my personality. So I'm looking for that window. And to get a move of that length, you need a weekly base, minimum 5 to 8 weeks. And, the old saying is the bigger in base, the higher in space. So the bigger the base, the better.
Yeah, and just to touch on something that you mentioned a few times, but Oliver, I know you like to kind of go back to that same core group of names as long as they're working, as long as the theme is in vogue. So,
The other gift had 30%. The Gravely voice. Yeah, but he was a little different though. Because he was doing like the 30% on like essentially like really high leverage, right? So like him winning one trade, he's making back like a shit ton of money. I'm not making back, like making. His account's like if he hits one of those trades, like his account equity curve is like kind of thing. Like substantial gain, substantial. Like mini losses over. Whereas, I mean, we'll see what this guy does, but
you know,
Sure.
an SQ when that's in vogue, you might go to that. But
I suspect not, but we'll see. Because think about like when you trade on like this low of a time frame, if you take a huge loss, your year might be cooked. You might not get that many trade opportunities.
but you kind of go back to that same list of not too many stocks and really focus on those. You know how they trade. You've learned
Yeah.
their patterns, and that kind of is an edge for you that you're so focused on that group of stocks.
Yeah, so like, look, I do, I run quote unquote, scans. Like I scan for volume every night. I look for huge volume, and that's kind of part of my process. It really only takes me like 3 to 5 minutes each day. And for all the names I uncover doing that, if I can catch maybe one or two names a year out of the hundreds that I might write down, that's sort of how it plays out. For example,
SMCI.
this year SMCI, I found SMCI like $68. I took one trade in it then on a bull snort, it ran, and then I kind of just didn't think anything of it. And then I was looking, and throughout all of 2022, it kept going up. And then I kind of really caught a big trade in it, earlier this year. Or I guess in, it must have been like April to July of 2023, and then this year. But really, a lot of the other names that I scanned for in there, in wrote down, I didn't trade.
The thing
I
about
tend to find,
competition
like I
is that your
said,
goals are skewed, no longer about capital preservation, it's about leaderboard status. Actually, out of curiosity, let me look this up. Because I don't know, actually, are they trading actual money in this or no? But either way, like, you have to like preserve your money, right? You can't just blow up your account. You're just not gonna win. No, but they are trading real money, so yeah, I doubt too many people are just kind of YOLOing no risk management in that case.
I tend to make, most.
They aren't using the right metrics to measure performance. How do you know that? We haven't even heard this guy speak yet.
Of my money in like 3 to 5 stocks. So this year that's been like Nvidia, SMCI, Kava, AMD.
I'm a baller. I don't mind throwing 10K away for a chance when a trading competition. I mean, I don't know enough about these people. I haven't studied this competition enough to know if it's the same people every year or not. Or the same set of people. The competitions are all the same. Advertised P&L when results come out. I haven't seen that. They all talk about the percentage gains from what I've seen. I don't think anyone really cares for P&L.
Beginning of the year.
It's like an irrelevant number, right? Like if I'm like a Saudi oil prince and I put $100 million in one trade, make 2% and get out, does me making $2 million mean I'm a better trader than somebody who made like $1 million actively trading the whole year? No. That P&L is a pretty pointless thing to talk about.
What else is in there?
Crowd.
Coin's been good. Crowd's been good for me. Those have
Yep.
kind of been my kind of go-to names the last, really kind of since this move really started in October. Those 6 names.
Then take a risk into account.
My key names, and then I've traded other.
I suspect these people are all managing their risk, right? Like, sure, they all might trade the same, but I haven't heard anybody sit here just talking about how they're like YOLOing shit mindlessly.
Their names outside of that, but I would be willing to bet that they've all kind of evened out, and I've made all my money in those key names, and a lot of it in Nvidia in particular.
Yeah.
All right, so fundamental characteristics. So like, I recommend reading How to Make Money in Stocks. There's no secret sauce that I can provide to you. I'm not trying to reinvent the wheel here. That book is a study of the biggest winners in history. Like he's done the work for you and put it out there. So go read that book. But typically, you know, Juan's whole thing was 25% minimum quarterly earnings and sales growth. You know, for 3 quarters. He had other things like 17%
Interesting.
ROE and things like that. I personally prefer 40%, triple digits, and the bigger the better. You know, if you can get triple digits, or sorry, 40% earnings and sales, triple digits is best. And I really care about revenue growth. So another book that I'd recommend reading is you know, Trade Like an O'Neill Disciple,
Trade like a what?
Catcher and
Trade like a what
Bill
now?
Morales. They wrote revenue growth. So another book that I'd recommend reading is
Right way, Sharper ratio, Sortino ratio. It's really not though. You're just saying that, right?
you know, Trade
Just
Like
because you think that does not mean it applies to everybody.
O'Neill Disciple, Chris Catcher, and you know, Trade Like an O'Neill Disciple.
Trade like an O'Neill Disciple. What is that? Trade like on. Oh, that's literally what it's called. Thought like I misheard it. I mean, I got too much to read. Goddamn. I'm still reading that futures trading strategy book. But the book reading list is growing.
Chris Catcher and Bill Morales, they wrote that book. They talk a lot about revenue growth in that book. And I think with a lot of these kind of internet type companies, or you know, more modern tech or whatever you want to
Growth
call
at
it.
all costs.
Yeah. Revenue growth is very important. It's even more important when rates are not rising. But so revenue growth is especially important.
Percentage win losses mean anything for everything on block.
A lot of stocks that I do very well in actually tend to have high PEs.
Isn't that what you do? Didn't you literally put all your savings in one thing? Literally. But these two people do factor risk management into account. Like they're not just entering a trade with no stop loss and saying if this thing goes to zero, I'm that's it. That's rip. Risk management is as simple as this: keep your losses small and let your winners run. Boom, management solved. Right? Don't you just say you're doing Sortino ratio, Kelly criterion, blah blah blah. Like you're not running a fucking portfolio for a hedge fund. If they're not giving their Sharpe ratio, neither am I. I don't track that shit. I don't give a fuck. It's irrelevant. All that matters is your account equity curve growing or not. Everything else is just yapping.
But they also have massive growth, accelerating growth. Once you kind of have high PE and that growth starts to decelerate, you know, that's kind of when you want to watch your back. So that's just something to kind of keep in mind there. And then a theme, you know, what's in play. So, you know, when Tesla was in play, that was like the EV theme, and like, you know, Tesla was my go-to name, but there were plenty of other names that did well. A lot of the Chinese EVs, I personally did reasonably well in NIO, but Tesla was the leader, and so I like to trade the leader. You know, with this whole AI theme, you know, there's been a couple different names, but you know, NVIDIA's been the leading name of that theme. You know, in crypto, you know, I know there's these names like Mara and Riot that are high flyers, they crush it. But for me, you know, Coin is kind of that like liquid name that I can take a really big position in, and you know, therefore for me, that's kind of like the leader.
What is this from?
I feel like it's like an obvious theme, and for me, you know, crowds kind of
2024 basically.
Other names that, you
know, like Coin's competition all the time. I just create everything into some high volatility instrument. I mean, these are $1 million accounts that they're doing this competition with. Like, if you think people are just pissing away millions of dollars to win some tournament with no no prize, seems a little illogical. Oh, I lost 5 million and one account hit. Now I have this cool label after losing $5 million. Doesn't mean anything.
You know, Palo Alto Networks has been a really good name.
Oh, so can they even do that? Can they? How does the scoring submission work? Can I blow up an account and then use a new one in the same year? We're not. Just think ChatGPT thinks I'm trying to cheat. Seems like you can't. Like at the start, you have to submit them month by month, and month one you submit your brokerage statement with your account number, and that's like the one that they peg you to. But this is just ChatGPT, so I don't know. Like, oh, it might be wrong, kind of thing. I'm not sure. Not sure, but it seems like you have to continue with the same account the whole time. Yeah, I've seen people throw away more than 1 million on nothing, especially when you have a net worth in the billions. Nowadays, millions are pretty common. 9% of us are millionaires. Every competition has their own rules. Yeah, I don't know. I don't know what kind of millionaires you know. They just gladly piss away their money on a trading competition, no less. Like 9% of people being millionaires when like all their net asset values are accounted for, including their house and whatnot, does not mean they just have $1 million liquid to go throw in the USIC.
It's best when more.
Let's see how long this person has been trading. How long has
multiple names are running. It's not that common when you just have one name go. However, I will say that kind of the biggest and baddest names are often like, you know, Tesla. Yeah, there's an EV theme, but Tesla was its own
interesting?
beast. And really, even with the whole
10 years, also worked as a trader at a hedge fund. Quite the background career in finance. Multiple different like trading careers actually. Like, algorithmic execution. Interesting. Quite the career then. Talk to this guy.
AI thing, there were plenty of semiconductors and things that were going absolutely nowhere. Well, Nvidia had moved, 200%, and then, kind of other stocks started to participate. But so I'm looking for big themes like, the utility sector. Really, I actually never really made that much money in it, but that was obviously a great theme. Maybe the last 6 to 9 months with the whole power thing for AI. So there's like the core theme, AI, and then there's these kind of tertiary themes, that work into it. But you want to try to identify what's in play, and try to focus there. So like right now, we're seeing this huge rotation. You could say it's small caps because the Russell's moving, but to me, it's really interest rate sensitive, right? You got your home builders, your financials. Those are the areas that are moving, and if you can identify that before they move, that's really where you want to try to allocate your money when they're set up.
And to identify that theme as it's building, you're looking for the setups, right? You're seeing what's setting up, what's breaking out on big volume, bull snorts, all that coming together, right?
So yeah, you're looking to identify volume. Really, is what I'm doing is I'm typically trading like growth names. But you want to have your head on a swivel as well. If there's some underlying force that's at play in the market, you want to pay attention to that. I think with this kind of small cap situation or interest rate sense, that's kind of what's at play there. I don't think Bank of America all of a sudden became some breaking bank. Like there's some underlying force at work in the market. So it's a combination of both.
Yep.
And I personally think that some of these growth names that are very they have a bright future and they've got the growth numbers and stuff that they've been doing well, and maybe they've really for some of them I haven't seen massive rotation necessarily out of them. They've just kind of paused. I think the market will probably come back and buy up the best names in those spaces that have that growth. So I think you want to find the good sectors with the big earnings and sales, and at the same time kind of pay attention to what's happening under the hood.
Yep.
So like I said, I break things down into the weekly, the daily, and the 65-minute. But at the root of all of it, and this works on every time frame. At the end of the day, this is like the 10-20 EMA. I kind of built this nomenclature for myself that helps me kind of identify where we are, as far as whether we're near the beginning of the move or if we're getting a little more extended in the move. But
Same kind of thing that we were talking about at the start, right? Basically, this kind of whole 30 weekly EMA thing.
Basically, when a stock tops out, it's typically extended from the 10-week and the 10-day, and it's got what I call an exhaustion extension. It's had a big move, and it's just kind of stretches into the stratosphere. There's typically big volume at turning points. So
We'll just save a screenshot of this, right?
Everybody's obsessed with the name. There's usually somebody very loudly talking about how it's going to the moon or something like that. And then it's like the air's let out of the balloon and it just comes back in quickly. And it's like an exhaustion. It's like everybody who's going to buy that stock, they bought it and there's nobody left. Stocks top when there's nobody left to buy, and they bought them when there's nobody left to sell. So there's an exhaustion. Typically, the stock will come back into the 20-period moving average. It could just be the 10-period moving average. And then it will kind of wedge up. It could happen over the course of a couple weeks, or in some cases, maybe just a couple days, if it really kind of popped. And then it'll have what I call a wedge drop. And a wedge drop is, in reality, is what it is if you took all the moving averages away. Because at the end of the day, even though I have the moving averages here, they're just kind of like a guide. We're really trading the price bars. So think of an exhaustion, wedge up, just kind of has no power, no volume. And really, it's setting a lower high. And then it breaks down off that lower high and it starts a downtrend. Because now you have a lower high and a lower low when it takes out that retest of the moving averages. It drops the moving averages. And then it has what I call an EMA crossback. What's an EMA crossback? Stock moves down. It has its expansion to the downside. So that's really all I'm doing is playing expansions. And then it kind of contracts. It wedges back up into the moving average. And then the sellers come back after it. And they sell it back down. And then, we have what I call a basin break, which same deal. It's just like a consolidation. And then the sellers come back in. They sell it down. But now the opposite of the exhaustion is just, you've got this fear, everybody's selling out of it. The guy who said it was going to the moon,
Capitulation.
didn't admit he was wrong. Now he's kind of walking on eggshells and and they capitulate. So I call it a reversal extension, but it's really just a capitulation extension to the downside. And why is it capitulation? Because everybody who was there who wanted to sell the stock, they hit out. And maybe you get some undisciplined shorts who say, "Oh, I should have shorted this up higher when I knew it was a short. I'm going to do it now." You know, I used to trade for big hedge funds. That happens a lot of the time. And then is what ends up happening is the opposite of an exhaustion extension. It kind of reverts a reversal. It reverses back and it comes up into the moving averages. You know, typically the 20 EMA. There's a lot of volatility. It might get rejected from the 20 EMA and look like it's going to turn into a bear flag. A lot of the time, that's actually when I get bearish. Is right. It's right around then when it's going to put in its higher low. But then it kind of contracts its vol and it tightens up a little bit, and it builds. What does it build? It builds a higher low, right? So stocks top out when they have a lower high, and they bottom out when they have a higher low. That volatility contracts, and then you have what I call a wedge pop, which is just like a move back up through the moving averages. But again, it's just like we built a higher low, and now we're going to turn the trend back up. We expand higher, we contract via some tight sideways action. It supports at the moving averages, but really it's like supporting at the moving averages. Just know it's building its next higher low, and it just so happens a lot of the time, not all the time, but these moving averages, they do a pretty good job of tracking those higher lows. And then we expand higher, and hopefully we have an explosion higher, and then we build a new kind of maybe 2 to 3 week base or so. A base and break would break higher. A real good trend, an intermediate term trend, something in the kind of 4 to 10 week range, will hopefully have like 2 base and breaks. And then you kind of do it all over again. The euphoria sets in, the stock goes parabolic, and it kind of bursts. And so typically you want to try to do your buying around the wedge pop, which is the ideal buy area, or around the EMA crossback, that kind of first higher low. The reason being for that is that the time period between the reversal extension and the wedge pop, there's typically a lot of volatility. And so there are times where I've like picked the low in the stock, the reversal extension, like I knew it was capitulation and it ripped up, and like I did really well, and I should have just taken my profit, because then it started to set up like a bear flag and it looked like it wanted to break, and I would get scared and sell, and I'd make like maybe like 30% of what I should have made. But then all it does is kind of put in that higher low contract. And then when it has a wedge pop is when you kind of get that more, trending type move versus that huge, reversion.
Interesting.
So we want to try to trade the low volatile, kind of trending part of the move. And then
Seems like these people are like very hesitant to because it's not the first person that's had the same kind of issue, right? Where they like have trades that run and they don't save anything out of it when it starts to retrace, and then you end up giving a bunch back. Especially if you're using this kind of model, right? Like if you're expecting some kind of sequence like this to be occurring, and you do catch the low, like how he's describing, some like capitulation type low, or like prices accelerating, has like an exhaustion gap to the downside on like a massive volume spike, probably the low, right? At least for like in the medium time frame period. So you can like sell that pop, and then if it ends up being this portion, like it doesn't just retrace lower, then you can like add back here, right? Instead of like potentially round tripping a bunch, only for this to end up happening anyways.
At the major turning points. And so another key here is you want to try to identify stocks that are in their weekly upcycle, which can last, years. You could have like an 18-month upcycle. And then when you have a daily down cycle within a weekly upcycle, meaning you're below the 10-20 day moving averages, but you're still above the 10-20 week moving averages, a lot of the time that down cycle will be very compressed and choppy. It won't be like a massive move down. It'll just be a stock that got too extended and needed to kind of reset up, rebase, get back into the 10-20 week or the 50 day. The 50 day about lines up with the 10 week. And then you want to try to get on to situations where both cycles are aligned. And what I mean by that is we're in a weekly upcycle. We want to try to play the daily upcycle and then get out of the way for the daily down cycle. Because it can just be choppy, not massive gains. Now, if you're really good, like I know some people are really good at shorting those exhaustions. It's not my number one thing. I'm pretty good at selling them, but I'm not the best at shorting them. That can be actually a really, really kind of quick trade. But then the actual move back down can kind of, it's just like you're better off. Look, if you're good at it and you're good at kind of fading the weekly move, then have at it. But I find it's best to align weekly and the daily. I'll just kind of leave it at that. But that is what I'm
Fair enough.
trying to do.
Fair enough.
At the core of it all. And the way I go about that is by combining the weekly, daily, and 65-minute charter.
And the down cycle part of this can be a lot more compressed, a lot shorter than the up cycle. Even though in this diagram for educational purposes, they kind of look the same length in time and distance.
Exactly. So, like for example, like let's say we're in a weekly up cycle, and we have a stock that it rips like 50-60% in 3 months, and then it has a daily down cycle. It might pull back 20%, with the first 5 or 6% being the exhaustion, and the last 5 or 6% being the capitulation, and the 10% being the 3 to 4 weeks in between, where it just kind of has a couple bad days, some big up days, just a lot of volatility, but it really doesn't come down that much in that time period. But it's basically it's given back 20 to 30% of the expansion higher you just had in the previous upcycle, and then when it sets up again, it may have another huge expansion of maybe 50-60% if you're lucky, in really great situations, maybe 100%. So basically when you align time frames, when you align the daily with the weekly, and the daily cycle that's aligned with the weekly is likely going to have a bit greater move than the counter cycle to the weekly. And then just typically in general, I think everybody knows this, it's harder to catch a huge move to the downside, because you can only make 100% if it goes to zero. Whereas, I try to trade stocks that aren't going to zero. But yeah, you want to definitely try to.
Not when you leverage the fuck up, boy.
Speaking of time frames, actually, we've got the price cycle example with Tesla, which is like a classic version of it. So I'll let you walk through it, Oliver.
Yeah, so like Tesla is, up, I would say, until Nvidia, at least for me, was like the greatest stock ever. And this is this is 2019, so we had a massive move into a blow off top at point A, and so you can if I went through the whole move, I could kind of point out the different setups in the cycle. But basically, a point A is an exhaustion extension. If you look at the bottom, there's massive volume. It's just ridiculously extended from the 10-day. It's also extended from the 10-week, and that's an exhaustion. So you want to sell into that. And sure enough, it just completely.
I'm curious, like, is he actually collecting data for this, or is he just looking at this with his eyes and saying it's extended? Because you can just create like distributions around this, right? And how far these things are moving averages? Like how big of an outlier you're seeing, just for that extra edge.
Into the 10-day in this instance, it's so extended that move down to the 10-day, was pretty significant. And then what happens is it actually finds support at the 10-day. You could even argue that 6 or 7 days later it actually set up again. I can tell you for a fact that I actually bought that. But then what happened is it wedged up and it put in a lower high. And then at point B, it kind of fell apart. And to me, this is a very unique situation in that it got so extended that when you were losing the 10-day, that was actually like the wedge drop. Whereas oftentimes it's not quite this extended, and it'll wedge up and the 20-day will be there and you'll actually lose the 20-day. But it's the same concept. If you took away the moving averages are there, as I call them, filters, or you could view them as guardrails. They kind of let you know where you are. But at the end of the day, at point B, we confirm a lower high. And we fall apart, we come back down into the 50-day, where we then bounce up to point C, which this is the crossback to me. And if you could see the move in Tesla, it was a multi-month move, and really this whole move, obviously COVID was a significant sell-off or whatever, but it was actually pretty quick. It was like 3 to 4 weeks. But point C is the crossback. We come back down, and then those 3 little bars there, right there, Richard, that's actually like the base and break. We trade down through there, and then kind of one of the keys to the reversal extension is you're oversold into a higher time frame level. So in this instance at point D, this was actually a back test of a massive weekly base on Tesla, and the 200-day was there. And that was actually the reversal extension where we snapped back up to the 20-day, which is the blue moving average. And it's a huge rip. But then notice how we kind of like stall there, we resist, probably on day 6 there, when we kind of break back down. If you're like me, like you probably were thinking, oh, this thing's going to roll back over and test the 200-day again. But then is what ends up happening. It kind of has the gap up. It doesn't fill that gap. It then, I guess that's not technically an inside bar, but it sort of is in concept at point E. And then we take out the 20-day, and that's the wedge pop, where we basically, what happens at point E, we put in a higher low. That's all it is. And then we expand higher. We have this pretty significant expansion. The
Pretty
price
typical
of
shit, I
Tesla just
suppose.
I can't even see him, but I think we went from like 100 to $130 in like 4 bars or something. If I'm seeing that right, that's a pretty good 4-day stretch right there. And then is what ended up happening in this instance at point F is that big gap up that led to the 2 red down bars was earnings. So we had earnings.
Yeah, I think about these things too is like it's not just a distance from like one moving average to like the price, but also like how far these are spreading from each other. It's like another way to go about it.
20-day, and we held the 20-day. Now I do position a little bit around earnings, where I might reduce a little around earnings and then look for an opportunity to buy back, which sometimes situations like this are great for me because I've reduced a little, and then you just kind of see if the 20-day supports it, and if it does, you add back. But then at point G, this is what I would consider to be the basin break. So we had our wedge pop at E. Our crossback was kind of like where F was and sort of to the left of F. It's kind of like that whole level there. And then point G is the first basin break. And really, this is your traditional William O'Neill cup and handle buy point at point G. And anyone who traded Tesla in 2020, kind of knows what happens next. We moved higher, we based again, and what happened all through point H, we held the 20-day, and then we expanded higher again. At I, we had what I call the first extension. So, if I were to go a little more in depth in what I do quantify the extensions as first extensions and second extensions. But these extensions often lead to kind of new kind of consolidation periods. So you don't know if something is an extension until after the fact. Ideally you sell into the extension, but I certainly don't always, even though I would like to. I try to. But at J1, kind of that.
I mean, you usually have a pretty good fucking idea, right?
Right?
Same thing as the low that he had earlier on screen, with just some like aggressive drop into high volume. The same kind of thing happening here, right? Just the inverse. Not like the MSTR blow off, right? There's many examples of this year. All like the quantum computing blow offs, Oklo blow off, yada yada yada. All follow the same kind of scheme, right? Just accelerating on like gap ups into like some like massive high volume exhaustion gap.
Edge drop.
Usually we know shit's about to be cooked.
If you're playing things a little tighter, or for me, definitely at J2, when we lose the 20-day, I would have been exiting, one of those 2 points. And then sure enough, because nobody's strategy is flawless, we gap back through the 20 EMA, which is actually one of my favorite buy areas. When we shake out the 20 EMA and recapture it, I view that as a big time signal to get back long.
Interesting.
So at point K, we have actually kind of what I consider to be a wedge pop. And we just accelerate higher. And at point L, this is what I call a second extension. So, we really accelerate. We have the widest range bar of the entire move. Well, we're very extended from the 10-period moving average. I am pretty good at selling second extensions in particular. Versus first extensions can be a little tougher. But the key difference between the first extension and the second extension is once you have a second extension higher, the stock will typically sell off either harder, or it will take a much longer basing period to reset again. So in this previous instance, it had about a month-long base after the first extension. after this second extension, it was kind of like a multi-month basing period to set up again, which is typically what you'll see in most stocks.
Yeah, like I mean, this it makes sense, right? It's pretty common. Like even you see it even in Bitcoin, right? Like the idea that like, okay, there's some like high time frame like base forms, and then there's like the initial move up, and like the first consolidation is like this, right? And then like it does another leg up, and then the second consolidation is like more aggressive in terms of like selling. So like the angle is like getting lower, right? And then like it does another leg up, and then this one's like even more aggressive because people the top's gonna be coming in sooner or later, right? People are selling out more and more aggressively the higher you go. You can see here, right? This came up and then like somewhat aggressive, and came up like pretty aggressive, and then we came up and then just mega aggressive selling, right? No one trying to get left holding the fucking bag. Also a good way to kind of like just like using this like ideology of monitoring how the consolidations are going. Like it's the angle of them and the length and time. Like typically, like not only do they get more steeper, but then they also get shorter in time. And so like if you see this happening on the higher time frames, you know you're nearing like a more serious top rate. Kind of simple way to kind of analyze where you are in the cycle. Looks like these things are all rolling over, yeah? About to get a 2-hour candle. Okay.
Because the weekly gets so extended by the time you have a second extension on the daily that it just takes a lot more time for that 10-week or that 20-week moving average to catch up to where it can kind of reset itself to have that kind of next move up. So kind of like I said, all we're really doing with these, wedge drops, crossbacks, basin breaks, etc., etc., it's a nomenclature that I created for myself. But if you took all the moving averages away and you just traded like the price bars, all we're doing is looking to find capitulations, when things are overdone to the downside, let it come back up. I'm not trying to pick the low here, and let volatility contract. And then when we expand, so what I do is all about expansion and contraction. If you're trading an uptrend, the moves up should be greater than the sideways or pullback moves that are counter trend. So the higher lows here in the bottom left. Let's just say for the very bottom left, that's your reversal extension, and it comes up, and we tighten up the volatility, and then we expand higher. That's like our wedge pop, right? And then we kind of pull back, and that's our cross back right in there. And then we expand again higher, and then we have a shallower pullback. And then at some point you move up, and a little pullback isn't going to do it. You're going to need to pull back, move back up, pull back, maybe undercut that, kind of first low, which is kind of how I drew it here. Just because now even the 10-day moving average kind of needs to catch up. And I call this a higher low shelf versus just like a higher low. It's like it comes in again. It just needs a little more time. And this is like your basin break. And then we expand higher again. And then we pull back. And then at some point, after we pull back, we try to move up, and we cannot make a higher high again. Our expansion is no longer to the upside, right? We expanded up, we contracted, and then we tried to go up, and there was no juice. That's what I said. There's no juice.
There's no juice. There's no juice.
And
the
the trend
fuck
changes, and now we have lower highs and lower lows.
Monitor just like died.
So my whole price cycle thing is just something that I created for myself. It resonated with me. It worked for me. I highly recommend that you create something for your own self, or use it if you like it. But all we're trying to do is identify the trend, and then the
Juicy
moving
juice.
averages kind of provide an objectivity to the whole process.
I'm curious to read this book.
Where it's like, hey, if we're above the 10-day, we're likely in an uptrend. Things are likely okay. And if we're below it, we're unlikely to be in an uptrend if we're below the 10-day moving average. I try to kind of simplify things for myself like that. But that's really what we're doing, is we're trying to identify the trend. And
yeah.
that's how trends work. Okay, so how do I kind of marry up the three timeframes that I use in my process? So the weekly time frame, I don't really pay attention to stocks when they lose the 20 week. I'm certainly not trading them when they're under the 20 week. So the 20-week EMA is, about the 100-day moving average. Now the 200-day moving average is, obviously an important moving average. A lot of institutions look at it. But typically, I look at both, but when I'm looking at the weekly time frame, more often than not, the best stocks will not lose their 20 week. And when they're kind of in their trends, they'll hold the 10 week. And then I'm looking for like a base that is building around the 10-20 week moving average. I write 5 to 8 week base ideally, but that's really sort of like the shortest, good size base you want. If you can find like a 3 to 5 month base, that's even better. And I think is what you'll find is if you go study some of the biggest winners ever, go back the last couple of years and study Tesla and Nvidia or study Shopify from before that, you'll find that when these stocks have these huge moves, maybe like they'll have like a 50, 60, 80%, maybe 100% move, they'll actually often consolidate for like 3 to 5 months. And then maybe they have another huge move and they're up like 200% in the year or something like that. But I feel like sometimes people think these stocks are just like always like ripping all the time, the whole year. And actually for probably, about half of the year or maybe more, they're often just kind of
It's not true, right? Yeah.
and they don't really have any juice to them. That's kind of what I call it. So, we're looking for stocks with a 5 to 8 week minimum base, but ideally a multi-month base to really kind of set things up, get that 10-20 week right there caught up. And then I typically like to try to buy more like flat bases that are kind of pushing the highs or near the highs versus something that is like more vertically down, like a weekly bull flag. I find has a higher failure rate if it's like a 3 to 4 week bull flag on the weekly. Sometimes if they're coming down into the weekly, but it's like 5 to 8 weeks in length, the stock was just so strong it took that long for it to kind of correct down there. I think you have more success with those situations, but they typically want to like square up, come into the moving average, the 10-20 week, come up, and then maybe come down again and really show that kind of horizontal level of support versus just like come down and like bounce back. That can happen, but I often find more when they have kind of like what I call it like a squared up base. I don't really know if that'll make sense to anybody, but that's kind of the wordage that I use. And then from a selling,
The same thing Linda
you
uses.
do want to monitor extensions from the 10-week EMA. So, I do have some stats on this. So the stats I have are sort of like
Okay, so you'd have
small
stats for
cap
this.
stocks, large cap stocks extensions from like the 50-day, the 200-day. And I do look at those in extreme situations, but a lot of the time I'm looking at the 10-week. In the same way someone will look at the 10-day and say, hey, there's air to the 10-day. I'm doing that on the 10-week. And when there's air to the 10-week, then I say, okay, if we're a little extended from the 10-week, now when we get extended from the 10-day and we're extended from both, I kind of want to have my head on a swivel, maybe be willing to kind of
Interesting way to go about it, actually.
watch my back.
Interesting. Here, this is why we watch this shit, right? You might sit here and waste like an hour and a half learning absolutely nothing, and then they just say one random sentence, so you're like, interesting. I like that. Just like that. Gotta write that down right now, boy. Interesting. I'm gonna have to code some stuff to test this out.
To take some off into strength. If we're extended and we have earnings coming up, that might be an opportunity to kind of sell the news, regardless of the number. But so that's kind of how I use the weekly. You want to really size up your base, make sure that it's well defined and it's not just some 2 to 3 week little kind of chop around. And then on the selling side of things, when we're extended from the 10-week, just kind of be aware of that. When you can get extended from the 10-week and go sideways for a week, which would just be like a basin break being defined. But if you kind of keep accelerating on the daily and you get extended there, that's kind of when you want to look for those extension scenarios. Okay, so then the daily time frame is kind of where we manage the trade. So that's where I use the price cycle, where I'm actually executing it, and I'm trading it around the 10-20 EMA. I'm looking for tight spots. People call them like technical buy areas or whatnot. But typically, what I call like a mini base, if I can find something that kind of comes up and it sets up 3 to 4 tight days under the 20-day, or within that range, or maybe it pops through the moving average and then it comes sideways like a bull flag, or I just call them mini bases. 3 to 6 day mini base has an inside bar or something of that nature, to show that the vol is really contracting. You want to try to find those areas and execute there, because when you identify the right stocks with a nice weekly, and you see the daily kind of turning on the moving averages, and then you can find those tight areas to execute. You're certainly going to take your losses. I take more losses than wins for sure. But the winners relative to the losses you're going to take if you take a tight spot, you can have situations where you're making 50R or sometimes more. Typically I'm risking like 2%, 2 to 3%, 1 to 3%, somewhere in that range. And you can have winners that are many multiples of that. And then ideally you want to be buying like the wedge pop, kind of when the stock is first turning, or the EMA crossback. So the wedge pop is often, it's not on the highs, obviously, just because of how it happens. Typically it's, ideally it's close to the highs, and the pullback isn't too deep. But it's, it comes up, and then sometimes that crossback can actually be pretty close up to the highs. But both buy areas, in context of my price cycle methodology, are near the first third of the move, and so they're the best buy areas because the risk reward's the best, right? Whether you're buying a base and break later in the cycle or you're buying the crossback, you're likely risking the same.
Interesting.
Um,
It makes sense.
but you have the opportunity to catch a more extended move with one of these earlier buy points, which therefore skews the risk reward more in your favor. And then basically, once you kind of get a trade working, you want to ride the 10-20 period moving average. And the goal is to try to assess which moving average the stock respects. And I like to see 3 touches of a moving average. So for example, if a stock goes up, pulls back to the 10-day, pulls back to the 10-day, pulls back to the 10-day, and it never touches the 20-day, I will then kind of view that as the moving average of note of it, that matters. And then some stocks are slower and they might want to touch the 20-day. Now I will say that buying pullbacks to the 20-day is typically going to be a better strategy than buying pullbacks to the 10-day, in the sense that your price will be tested and shaken out less often, which I think is true across all technical analysis. The shorter the time frame, the more signals and the more shakeouts. So I don't know why I just said that, but I believe it to be true. And sometimes a stock can like ride the 10-day, the whole move, and then maybe shake it out and start holding the 20-day. Or there's situations where, based on the price structure, you kind of built a higher low shelf, and we've been holding the 10-day, but then it pushes off, and now the 20-day is right below that shelf, like a major technical price level. So you decide, hey, I'm going to pivot to the 20-day for a little, but then it moves up and it starts holding the 10-day again. So you move back to the 10-day. So there's a little bit of an art to it. And you're obviously going to make mistakes and look stupid. And then, as the weekly stretches from the 10-week EMA, kind of as I said before, look for extensions from the 10-day EMA to start selling, into the move. Now, the one thing I will say here is people will often say to me, like in week 2 of the move, when a stock explodes, like, hey, should I sell it here? And typically when a stock gets extended, like right on its breakout, it's actually a sign of power. So like, I'm kind of talking more into the move when I, make these comments.
Yeah, I'm curious. Like, does he do this based on candle closes, or does he like do it as like printing live?
And I was feeling really good about it, and I should have just sold it. But typically, if you see power like that at the beginning of the move, it's actually a sign like, hey, I want to hold on to this thing. I want to give it a chance to rest.
I'd probably
And
just
then
be
as the
basing on the
weekly
lower
matures
time
and you get
frames.
those extensions, is when you want to start selling into strength for my time frame.
And do you look more for the extensions on the weekly charts or the daily charts?
Combo. When you're extended from the 10-week,
Is this guy not listening? He said both.
we kind of start to just chop around on the daily and go sideways.
Guy's faded.
You might chop around for 2 or 3 days and the weekly hasn't changed, it's still extended. But then you get to Friday and you start a new week and it's like, oh, the weekly's a little less extended now, daily's still chopping, and maybe the daily chops for 10 or 12 days, and it doesn't give too much back. And like now all of a sudden it's like boom, the weekly looks, you know, solid again. The daily looks real good. Actually, it might even have a new buy area. But then when the weekly's extended and that daily kind of keeps going up and accelerating, you know, then it's like, all right, this just isn't sustainable. And at some point,
You have a pet?
you
No.
know, it comes down to the fact of you know, the move isn't
No, I do
sustainable.
not.
And I would say one of the biggest mistakes that I make is when I say, hey, this thing's super strong. I know this isn't sustainable, but man, I just like this stock so much. Like, I think it's going to go sideways. I think it's going to go sideways and it's going to consolidate. In my experience, I'm better off just selling that. And then if it does go sideways, buying it back at the same price or even
Yeah.
higher. Because there's nothing worse than when you catch a sweet trade and you do everything right.
It's just never really worth it, right? Like what he's talking about, just never really particularly worth it. Like if the thing is like kind of getting like ramping up more and more aggressively, right? Like the more aggressive the move is to the upside, like the lower the probability that it's just gonna see you're consolidating. Most likely gonna start to have like a major like aggressive sell-off right away. But even in the world where it doesn't, you're still better off selling here, right? Somewhere in this upper region. Because let's just say it does end up consolidating up here. Right? Then you can just buy like the next breakout. And like, are you getting in maybe at a higher price than you sold? Potentially, it might even be the same price, right? But you like minimize the risk of getting all this potential downside for like a few dollars of potential optimal entry onto the next move. And I think we've all experienced this, right? If you traded for any meaningful amount of time, or like a lot of chart time, I'm pretty sure everyone's has done that exact issue, right? Where they're looking at the chart and they're thinking, oh, it's gonna go fucking higher, and then you don't sell it, and you're just like, oh fuck, I just gave back like 40% of my unrealized gains. Fuck. Fuck. So yeah, you gotta learn real quick, right? It happens once, don't do it again. Learn real fucking quick.
You kind of misjudge that, and you know, boom.
Be back in about 2 hours. True. I don't know if I'll be here in 2 hours, 11 o'clock. Probably near the end, but we'll see.
Just all of a sudden creators like 6-7% in a day, or you know, 10-15% in 3 days, because it can happen quick, you know, obviously. So I find when the weekly and daily, you know, get extended like that, and you know, there is a, you know, you get better at this with experience.
I gotta go a trading group 9 to 11.
For 6 to 8 weeks to then just all of a sudden on a dime selling your position. So the one thing to keep in mind is you don't have to sell your whole position at once. But then, you know, I think as you get like I think I'm pretty good at selling. I think I'm pretty good at selling. You know, you only get so many opportunities to
that too, right? That's a nice thing about selling into pumps. So like when it's like let's say you have some like level in mind, and like you're like let's just say this is like fib extensions or something. Like you have some target above you in mind to sell at, and like you sell like into the move, and that start to pull back. Like that's always the best fucking feeling, right? Because like taking partials here, like it means that if you do start to round trip some of the remaining position, like you don't want to exit entirely. Like you're giving back way less, right? Because you've like cut your position in like in half, for example. So instead of giving back, like, let's say this move down from like here to here is like 30%. Instead of giving back 30% of your unrealized gains, you've cut your position in half. So you're only giving back half of the position this amount, which is always a feels good, right? If you end up in that kind of scenario. What's up with this stuff? Yeah, the S tagged all the lows. How about this? Not quite. Not quite. How's silver doing out of curiosity? Go to palladium, right? Palladium's looking strong. God damn. God damn. God damn. Are these things gonna do a failed auction at the Valeria low and start going, or no? Or no? Can they reclaim the VWAP, or no?
Weeks to even get the opportunity to practice that. And you know, there's no other way to practice that than to, you know, earn that. So that, you know, yeah, it's something you got to get better at through time. And I will say, I find when the kind of the daily and the weekly get extended together, the risk reward now gets the further it moves up on the daily, the more the risk reward is skewed towards selling, if that makes any sense. So
Makes sense. Makes sense. We're following along. Don't worry.
On the 65-minute time frame. So I use the 65-minute to enter and manage risk. So the same way you're looking for like tight areas on the daily, it's literally, you're doing the same thing on the 65-minute. It's just rather than, you know, 1 bar a day, 5 a week, you know, you're getting 6 bars a day, 30 a week, and you get a little bit more price action to, you know, try and identify areas to kind of get in. And so the way that I set up my 65-minute chart is I actually put the 65-minute 20 EMA, which is about the 3 EMA. And for me, it's just kind of like a very tight guardrail. And then I have the 5-day, which I use as like the, you know, hey, this is the trend, you know, where the 5 days going. I picked that up from Brian Shannon, you know, highly recommend checking out his stuff, especially for the price structure stuff. You know, I love his book.
Yeah, Brian Shannon's pretty. He also wrote like the Anchored VWAP book. Also has a lot of pretty cool interviews on YouTube. So shout out to Brian Shannon. Also pretty active on X. Posts a lot of charts, a lot of his trading ideas on there. Pretty good follow.
And then I put the daily 10-day and the daily 20-day on my 65-minute chart. So like I'm never looking. I mean, I do have the 65-minute 20 EMA on the chart, but I'm really looking at the daily moving averages all the time, even when I'm trading on the 65-minute. You know, I'm trying to operate. I'm trading the daily with a little bit more information, I guess might be a good way to put it. And then, so like I'm looking for tight areas to get in here, and I'll kind of give some examples on, you know, kind of how I try to buy, where maybe I'm trying to buy in like 2 pieces, where I can identify a spot on the 65-minute, it moves up a little, tightens a little, and then maybe it triggers the actual daily trigger where I'm adding, but I'm raising my stop. So I can kind of get it.
I like doing that. I have the same thing right on this chart. Like if I go on like the 30-minute, like regardless of what time frame I'm on, these are like the daily moving averages, right? It's the daily 200, daily 100, daily 50, daily 20. Kind of what he's talking about right now. You can see how price is like interacting when it gets to these, even when you're on like the lower time frames. So I fuck with that. I fuck with that.
With the same initial risk, which I'll go through that more in a second. But then I'm looking to manage the trade via the price structure and the pattern of higher highs and higher lows. So, you know, I'll give you an example of this. Like I find it's easier to identify the higher highs and higher lows on the 65-minute.
I mean, this could obviously be like a much more efficient, right? At this point, like he's everything up until now is like cool and all for a swing trader, but when you get into these lower time frames, like you gotta start paying attention to like more important imbalances, right? Like volume imbalances, time imbalances. Actually paying attention to the order flow and whatnot. Like trading price structure on these low time frames, not ideal. If you want like elite entries.
You know, maybe it's too much information for someone else and they should just look at the daily. But I like the 65. I'm not looking for like reversal bars and stuff like that. Not that they aren't relevant, but I'm just looking at the core trend more than anything else when I'm looking at the 65. I think most people don't need 10 or 15-minute charts. You know, they can mess you up, make you overtrade. You know, I do look at the 10-minute chart. But, you know, I try to operate the core of what I'm doing at you know, at the 65-minute and daily level, you know, after identifying good weekly situations. And then use the 10-20 EMA from the daily time frame as what I call a filter. And is what I mean by that is as I'm trying to identify the higher highs and higher lows, you know, like you can get too excited and, you know, call something a higher low, but it's like extended from the 5-day and it gets shaken out and you get shaken out of your position. So, you know, typically in a really strong trend, something will kind of trend with higher highs and higher lows above like the 5-day actually. but then at some point it will kind of run a little too much. And rather than just having like pure higher high, higher low, higher high, higher low, it'll have like a higher high and what I call a higher low shelf where it'll just kind of pause in place for a little bit. And that'll let the 10-day kind of catch up. And so, if it undercuts that previous higher low a little bit, it's not necessarily breaking the trend because it's above what I call my filter. It's just
It's interesting though, like compared to the other people that do this guy seems like he's a bit more like, okay, sure, perhaps this isn't the most efficient way to be entering the low time frames, but he is trying to get better RR entries than the people that we've seen other like doing the same competition. Because most of them are like doing the same kind of strategy, but they're sticking their stop loss on like, let's just look at like a Bitcoin breakout, for example. Like in this case, like they're sticking their stop like here, or like here, right? It's like the previous, like the most recent candle close, or like the low kind of thing. Whereas this guy's like getting into the lower time frames to get like potentially better RR on the trade if it ends up running, which makes a big deal, right? And can end up being quite a big deal because you can size up a lot and have the same like risk. So I suspect that's how this guy ended up winning that year. Because he had like a 1,000% gain on $1 million account. No joke. It's no joke.
at the real weak hands. And when I say real weak, like it's never really like changing the trend. It might just kind of test it a little, but it's holding its trend. And then we're looking for upside expansions followed by tight contractions. So in an uptrend, price should expand and accelerate up with power, and then it should have little give back, or just kind of more tight trading, and then it should expand in the direction of the trend again. And that goes for uptrends and downtrends. Basically, the direction of the trend should see expansion, and then you should have contraction in between those, expansions. And actually, part of the reason why I like swing trading, well, one, I'm not very good at day trading, but two is that sometimes these major expansions will happen like right on the open, and then the rest of the day, the stock will kind of chop around. But if you're in the stock and you're aligned with the trend, you have the opportunity to take advantage of what's happening, what the trend is. So yeah.
And one thing, just going back to this point here, one thing you said, I don't know if it was in the masterclass or a swing report, is you're not looking at the lower time frames unless the stock is at a key point on the higher time frames, and you're just watching to see how it reacts versus those levels and give you that extra information at that key point. If it's not set up on the daily and weekly, there's no point to at really looking at the lower time frames.
Yeah, exactly. I mean, you can find trades all the time on whatever time frame you're looking at.
Generally true, right? Generally true. Like, sure, like we have these open just because like that's what's on the stream. I'm not actually typically sitting here looking at these like 5-minute charts and whatnot, right? Like we're really paying attention to the higher time frame levels and then just drilling into the lower time frames when it's time to like execute at some level of interest or just monitor the reaction at some level of interest. Basically, you only go into the lower time frames, at least for like this style of trading, like swing trading / like essentially not scalping in the lowest of low time frames. You really only need to go into those time frames when it's time to be doing something at a level of interest. Other than that, just like kind of noise, right? Obviously, the statement doesn't apply for like a 1-minute scalper.
Technical analysis: the lower the time frame, the more signals, the more.
But even then, like even as a 1-minute scalper, like it should still be the same logic in the sense that you shouldn't just be scalping like any random sequence of price action on the 1 minute. Typically, you still want to base it around like key levels. At least if you want to have a higher probability of doing things, and you're not doing some purely mechanical strategy.
Shakeouts, the shorter the move. So I'm trying to identify multi-week moves. You typically don't get multi-week moves on 10-minute charts. Maybe you get multi-hour moves. So I'm definitely trying to focus on the time frames that are going to get me, my intended upside, I guess. Yeah. Okay. So then breakouts and back tests. So like I'm looking. So like this is kind of more in the 65-minute chart. So like I'm looking to buy breakouts. But I would say like I had a major change in my trading when you're not going to catch every breakout. And the nice thing about the 65 minutes, you're going to have breakouts and then you're going to have pullbacks, and you're going to have plenty of breakouts. But where I kind of took a big jump in my trading was, look to trade back tests. So like if you miss the breakout, don't chase the breakout, just wait for the back test. So very often a stock will break out and like a very powerful breakout where you've got like the weekly and the daily and everything is aligned. It may not back test. It may just rip for like, 2 weeks and then it'll kind of consolidate a little. But often leading up into those big weekly breakouts, it kind of actually breaks out on the 65-minute and pulls back and sets up again, and then it breaks out on the weekly. So I guess my point is that kind of one of the keys is, if you don't catch the breakout at the right spot, wait for that back test, that kind of higher low spot after that initial expansion higher. And what did I write here? If you can rewire your brain.
Like this is the tricky thing about this stuff, right? And I'd imagine like I don't really swing trade these people. Like, we'll start doing in the future, right? Especially if we enter some like prolonged downturn in the market where a lot of these things do go into like that 30 weekly moving average drawdown. But I suspect a reason a lot of the people don't have high win rates on this is because of this exact point of buying the breakouts, right? It's risky. Like if you don't buy the breakout, or how should we phrase this? Typically, the strongest breakouts on the higher time frames aren't going to give you the backtest. So it's like you either have to buy the breakout and just hope that is the actual breakout. Because if it isn't, then it just like ends up being like a sweep of like the previous highs into like a trap for shorts or like longs. Basically like a bull trap of some any nature, right? You're gonna get stopped though, because it's gonna come back and sweep out the lows at that point. So like you don't have the luxury of waiting for confirmation. And then, like, typically your best bet is going to be how he's describing, like a lower time frame pullback. If you're like waiting on the daily chart to get like a confirmation or like a breakout and retest on the daily or weekly, you're probably not going to get it. And if it is, you should be a little suspicious.
To say I missed the move, the goal is to wait for so a lot of the time is you'll get a rip up, and then I think most people who traded for a while would agree, sometimes you get that move down in the market from like 9:30 to 9:45, maybe 10ish. And then, the strong stocks that are ready to go that day might consolidate, and then they rip to like 11 or 11:30, and then everybody goes to lunch, they might go quiet, and they shake out the day trader that was trying to hold his runner or whatever, at like 2 o'clock, 2:30ish, and then they have a strong close. So sometimes, around that hour when things have kind of been hovering down all day for like 3 hours or something, that could actually be an opportunity to kind of look for that back test and a name that had expansion, and then kind of catch that higher low for a strong close. And sometimes it moves up during the day and it chops all afternoon, and then it has what depending on your time frame is viewed as like a shakeout in the morning the next day, but it's actually just a pullback to a higher low, and then it closes strong in the afternoon. And so mess with this, try to kind of go review some of the best stocks or names that you're trading and try to identify these areas. Okay, so this was Coin. So this is the trade I had in Coin. So really, actually, this is an example where it broke out at like $90, and I missed the breakout. Like it had a big gap up, and I kind of missed it, and then it pulled back into around that $90 area, a little bit above it. And I didn't actually like buy that pullback. It actually like held up right there on the gap fill. But I did buy that next expansion higher, at around like $95.
We'll continue this. Where's yesterday? Is it BWAP? Quite a ways away.
Or so. And so notice how it expands up, and then it basically goes sideways for like a day and a half, and then it expands up again, and it goes sideways. So that's expansion, then contraction, and then it expands. And the next round of expansion is fairly extreme. It has some gap downs that get bought up right away, and then it pulls back again, and it it has a higher low, and it kind of like holds the 5-day this whole time. But in reality, you know, my filter, really the fastest moving average for me is the 10-day. And notice how this entire trend higher, you know, basically held the 10-day moving average. So we expand up. And then I would say right in here, Richard, this is an example of what I was talking about, where like the name has now moved from, you know, let's say $90 to 140. And the whole move there, it's just kind of like made a higher high, higher low. And it's never really taken the time to kind of regroup. And so right in here in this area, you know, from Friday to Wednesday, you know, which is only like 4 days, but the stock was able to pull back to the 10-day, move up, come back down, and build kind of more what I call a shelf, where it had like, you know, 3 or 4 days rather than just like, you know, a 5 or 6 hour pullback. And then it expands higher again. And it pulls back, it expands, it pulls back, it expands. And so if you really actually coin was an amazing example. Because actually I sold this stock on that gap up at 140-ish, you know, way to the left, um, you know, 140, way to the left, way to the left, way to the
And
left.
was it for the Trump bump or something? What was the price? 70 to like 180. Like this leg here. Happening at the time, I don't even remember at this point. Hmm. Basically leading into the ETF announcement, essentially. Nice little juicy trade for that guy.
And then I was actually able to buy the back test into 130. And if you really go through this stock, you know, you'll notice that these pullbacks, just about all are back tests of the previous higher high. This is a pretty amazing move from like a trend perspective, is that a lot of the pullback lows, all they do is touch the previous high. And this was the ultimate example of breakouts and back tests, breakouts and back tests, breakouts and back tests. And then, I mean, it's, you know, a little harder to see here. But on the weekly, we were getting pretty extended. And in this specific instance, coin was also working against the left side, and there was kind of a level in this kind of 200-ish area. We were getting a little extended on the weekly, and then is what ended up happening is, you know, we made a lower low through 180, and I exited half of my position. But we were kind of like above our filter, and this wasn't really an extension for me. Like, I don't know how to describe that looking at the 65-minute, but it wasn't like so euphoric. But then when we made a lower low and we broke the 10-day at about 170 or maybe a little under, you know, for me, that was the complete exit of the trade, because the trend had reversed. And is what ended up happening is this thing kind of needed to regroup. And I want to say it came back down into like, you know, 120 or something like that. But, you know, this was an example where, you know, this was basically 95 to 170-ish, you know, so that's about a, you know, 80% move, give or take. And, you know, let's see, 1, 2, 3, 4, you know, maybe like 5 weeks or so, you know, that's really good. You know, that's ideal. But, you know, this is a just example of seeing the higher highs, the higher lows, the breakouts, the back tests, the breakouts, the back tests. And I think, you know, buying back tests, you know, kind of once the move has started is better in the sense that your price is less likely to get tested. Whereas if you're always kind of buying the breakout, a lot of the time, you know, when it pulls back to the back test level, you know, let's say your price is like $50 and it comes back into 49. You know, when you, let's say you buy 50 and it goes to 55 and then it pulls back to 49, you know, most people want to get their stop at cost, right? You get shaken out. Whereas if you're kind of buying the back tests, you know, maybe it comes to 49, you buy it at like 50, you bought the same price, right? But it's going to now go up to maybe 60 and then pull back to 55, and your price is never going to get tested. So kind of after that initial kind of breakout, you know, I find it better to kind of buy back tests, especially, you know, if you can kind of get those pullbacks into the 10-day specifically, or the 20-day.
Yeah, it's building new Darvish boxes on the way up.
Yeah, exactly, exactly. Okay, so position sizing. So one size based on the risk you're comfortable taking. So for example, if you like taking really big positions and maybe you want to risk 50 bips a trade, that's personal to you. It works for you. Kind of have at it. If you like taking like 10% positions and you want to risk like 10 bips a trade or whatever, you know, do what works for you. But I think either or. I sort of think like the real edge in what I do and really when I stay kind of loyal to this, is it helps me prevent drawdowns when I stay loyal to this. But buying pieces and then average up and raise your stop. So is what I mean by that is if you buy like a pullback to the 10-day or something and you buy a 10% position with like a 2% stop, you're risking 20 bips. So let's say you buy at $100 and your stop's at 98 or something like that. And it kind of works up a little bit and then it follows through and you add another 10% at let's say 104, and your stop on that is going to be 102, or maybe it goes up and it pulls back again and you buy the back test at like 104 and your stop's 102. However you end up playing it, the idea is that you're buying a little bit higher, and you add another 10% with a 2% stop, but then you raise the stop on your first piece to cost, meaning you take that initial 20 bips of risk off.
I mean, we talked about this, right? We were talking the other day. Something we like to do as well. But you can size into trades, right? And the way he's doing it, there's just ways you can go about it, right? You can either like size into the trade like on the pullback, or you can like size into it like after the continuation and then like add enough to bring your stop to here. Either or, but he's doing the same thing. He's doing it on the pullback and then like putting the stop here. So like the risk he has with the bigger size is the same as his initial risk. So you're kind of just increasing your size as you go without take on any additional risk on the trade.
And now you have a 20% position with the 2% stop on the second piece, and then your stop at cost, or sometimes maybe even it's a little bit above cost, depending on the price structure. And you've got 20 bips of risk with full position or double the position size. So if you're wrong, you lose 20 bips on a 10% position. So if you take an initial position, you buy 10% with a 2% stop, and you're wrong, you lose 20 basis points, right, on that first 10%. If you add a second position and you kind of raise your stop on the first piece and you get stopped, you lose 20 bips. You lose 20 bips on a full position. And at the first piece, you didn't lose any money, but on the second piece, you lost that 20 bips. But then if you're right, your gain is on a full position. So let's say you lose 10% or 2% on a 10% position and you lose 20 bips, but then let's say you started at 100, your next buy was 104, your average is 102, and the stock runs to 150 or whatever, or let's just say like 120. Now you made, let's say 18% on a 20% position. You made 360 basis points, which, I think is doable. I think people, if they're sizing the right opportunities, can find 20% wins. I mean, that's a nice trade, but it's doable. And basically you're making 360 basis points and you're risking 20 basis points. And that is kind of like the edge, that's 18R. And you're going to have plenty of names that are like 6 or 7% winners, don't quite work out for you. But then, you're going to have those occasional, like really big winners too. And then, a lot of people say you should size all your trades the same. Nobody knows which trades are going to work. That's definitely not how I trade.
Same,
I like
yeah. Agree. Right, heavy agree. Heavy fucking agree with that.
Highest conviction trades, and a lot more.
You got to, right?
Kind of the difference between having a really big year.
When you have a high conviction trade, high probability, right theme, blah blah blah. Like in this case, like for us, we're just doing it on Biddy. But like in this case, like when everything's checking the boxes, like you gotta go for it, right? Because those trades like raise your account equity curve so fucking much, like it's ridiculous, right? It's like you'll be like trading like, okay, some gains, whatever. And then one of those trades just like boom. And then you're just like, and then you do it again, boom. Like that's what's gonna really grow your account in a really meaningful way. That you gotta, right? I mean, you don't have to, but in terms of like speeding up the process, if you can do it properly without taking on a shit ton of risk and nuking your account equity curve, that's like the ideal way to go about it.
Of a position you can get on your best ideas. You know, if you have a huge winner, but like a 5% position, you know, it's like you're not going to have as good a year. Obviously, I don't want to state the obvious, but it is like the case is if you have like a 20% position on that same play, or maybe bigger, depending on what you're comfortable with.
And it's super common, right? Like it's so like everyone says the same thing, right? It's for a reason. Typically, when you see everyone that trades, regardless of how they trade, and everyone has the same advice on a certain thing, like it's for a reason. So
I go about that.
whenever you notice that, like pay attention, right?
You know, here's an example of a trade I did. I did really, really well in this. I think it's the next slide, Richard.
Yep.
Yeah. All right. So Nvidia, when it kind of had its move from 500 to 1,000, you know, I did real well in this. And the reason being is because of how I was able to buy it. So to just like go to the left. So because this is reality, like, you know, when it kind of broke out on the left at like 475, you know, I got involved. It had the back test, and I added more. And it went up, and it looked good. And you know, then it kind of pulled back, and I think I reduced. But then later on, I ended up, you know, getting stopped out, and you know, it was further to the right is when I fully got stopped. Yeah, like over in there to the right a little. But you know, basically, I sat in this thing for like, you know, like 2 weeks, and you know, at the end of the day, like if I'm in a name for 2 weeks and I make like 1%, like it doesn't feel like a winner. Okay, it feels like a loser. But then on the right hand side here, that initial kind of breakout when we busted back through the 1020 EMA, I got long there, and then I actually like added on the back test into the close, and I brought my position up, and I raised, you know, like I raised my stop kind of to where that breakout was. Like I wanted to give it a little room to under the moving averages. But basically I had, you know, my first piece and my second piece on, and my first piece was just about risk free. In my second piece, you know, obviously I still had risk, like I had overnight risk. I didn't really know what was going to happen the next morning. But this had a huge weekly base too. So like everything was set up here. And this is what I was saying, like when you have those big weekly bases, you're able to kind of position size on the 65-minute before. And then the next morning when we kind of gapped, like I was ready, and I you know, I doubled my position, and I kind of raised my stop to, you know, basically a little below the gap fill. Like I, you know, I didn't have like an exact number, but I knew what I call my max pain point. Basically it was my first two entries were risk free, and I was willing to take a shot, you know, and add on that breakout, and that was basically my risk. And then the volume was so heavy that you know, I actually added a little more through 500, and then even above 510 when we kind of based out a little bit there. I think my average price was, you know, in the 495 area, and I was willing to bring my average price up to 500. So I just added like a touch more. The volume was so heavy, you know, I just didn't think it was going to fail. I had a lot of conviction in it, and this ended up being like a really, really big trade. But like, you know, obviously you're looking at the chart.
Part of the reason why this happens, right? Because people are in positions from earlier. And then like once it starts going and like confirming the move, people are adding, right? They're like, oh, it's confirmed. They're just starting to like market in positions, and everyone's doing it, right? It's just how you get these like green dildos shooting up as like you're squeezing out other positions.
Like it played out perfectly, and it did. But the reason it was a big trade, you know, wasn't necessary. I mean, it was because it worked, but it was a big trade because I was able to buy in kind of 3 or 4 pieces without ever really like significantly increasing my initial risk. You know, I will say on that breakout, I kind of really went for it. You know, the bigger breakout, the second one.
Like, especially when you have like because I do this a lot when there's like and I have like an early entry, and I can like walk up my price a lot without still being above break even with the stop, and like this kind of shit starts happening. I'm just like marketing and boom, 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 boom. I'm just raising up my average price. It's like no fear, right? Like worst fucking case comes back and gets your stop at break even. And usually you want to give it some breathing room just to avoid situation. Yeah, but you can work with it, right? Be flexible with it.
So I had some risk. Like this is a situation where I was risking, 50, 60 bips instead of like 20, just because, there's a huge weekly. But, I've had plenty of trades. So like I had a trade in SMCI where it ripped like 200% this year. And unfortunately, I was positioned just like this. And like the day before it ripped, I actually got shaken out of my position. And so then, it ripped on a pre-announcement. Then when they pre-announced, I was starting over with my buying process. And so I actually, in this instance, I had like a huge position. In that SMCI instance, I basically had, I had a 12% position. Whereas if I wasn't shaken out of my position the day before, I probably would have had somewhere in the 20% range for my position size, which for that type of name would be would be a big position for me in that type of name. So like,
Interesting.
that is like the big kind of edge I have on top, for me, at least on top of all the, strategy and all that, is like trying to buy to where you can get your size up and balancing, risking your cost basis. Cause obviously like if you average up like a moron, you risk like getting shaken out on a normal, reaction and you feel really stupid. But if you can do it the right way, you can put yourself in a situation where you can, really, really, do well. And then I would say, I'm trading real companies. I'm typically not trading, you know,
Shitcoins, stock market
stocks.
shitcoins.
And just to add, just to emphasize the point, you mentioned this is the very right side of a big weekly base.
Yeah.
I think you've also pointed out in the past that it was showing relative strength versus the rest of the market in this period, and then
Yeah.
had this wedge pop on the 65-minute time frame, and that's why you went for it right here.
Yeah, so like in this instance, even though Nvidia looks weak here, and like it had some selling coming into it, it was actually holding up better than the underlying market. So it was kind of being held back, and then
Kind of like
it
Tesla right now, right?
Once
Looking pretty strong.
Tesla
Everything else is
came off,
dumping.
Nvidia exploded.
And we've got a breaking recapture example as well.
Yeah, and then so this is just like an example, like when I'm trying to like buy support, off the 1020 EMA, like a nice way to do it is to look for a, I set alerts on the moving averages, but I also set alerts at like relevant swing highs and lows. And, if you can find an area that undercuts a swing low and recaptures, that's often a good area to execute. Why? Because they're running that swing low for liquidity so that they can buy shares. So, I'm not going to go kind of too into this. I actually think the skill in the break and recapture is setting the alerts at the right areas on the chart. But I mean, a name like Nvidia, they run the highs and the lows all the time. Like if you set your alerts at like these swing lows, and you're able to kind of identify what I call scums, where they kind of run the stops and then it recaptures. I mean, those can be the best areas to get long. Okay, so some key points.
It's not scums, right? I hate when people like frame this kind of shit, right? It's like it's just the nature of the game. Like large entities cannot trade in these little low time frame ding dongs. They have to trade at these large areas, or else the slippage is way too fucking high. So and the thing about this is that it becomes like a self-fulfilling prophecy, because like think about it. Like let's say like a large entity bought right here, okay? Like the only valid interaction zone for them. Now price starts to drift upwards towards like the next large entity interaction zone. And there can be multiple of them, right? We're just saying large entity for the sake of like simplicity, but there's obviously multiple. But like they interact in these zones specifically. And like once price starts to reverse from this zone, like you're not seeing any large activity going on from these large players. So price just like drifts back to the other zone because there's no large money entering to cause like a reversal in a meaningful way. So, and not only that, but like everyone knows this, right? This is a common understanding. So people that are trading on the lower time frames are like targeting like the liquidity on the opposing side. It's not being scums, right? It's just the mechanics of the game. If you're trading like $20 billion, it's just how the game goes, right? You don't have the luxury of being on the 1 minute trading.
Of your overall strategy. If a stock's in a downtrend and you're looking to buy a break and recapture, it's not going to go too far, even if it works. You want to be trading, a pullback to a moving average where you're in a weekly and daily uptrend. So, you're in a strong stock and setup. Then the higher time frames always supersede lower ones. So, oftentimes the daily time frame will top out when it looks like a bull flag, but the weekly's extended and everybody thinks it's a bull flag. Me 10 years ago said, oh, this is the best setup ever. And then the next morning it like tanks down the bottom of the bull flag. Why? Because the weekly was extended. So higher time frames always supersede lower ones. And then entry tactics allow you to manage risk and size into positions. I pretty much just went through that. And then the index price cycle will affect individual stocks. So for example, if the market has been running for like 8 weeks, 10 weeks, and now you identify a stock that's about to have a wedge pop, like you got to ask yourself, like, what's it been doing the last 8 weeks? Like, why is it only now just breaking out? And is it going to break out and then slam right on my face when the index?
Yeah, slam, but what?
The index just chops around. So pay attention to where the index is. I'm not saying like analyze every little tick price bar and but know where the index, what the trend is, and just kind of how long we've been moving. And if you're, if the trend's been going for like 10 weeks and you're just finding a breakout, you might be better off like buying a base and break in a stock that's already moved a little bit, and just treating it as more of a shorter term swing trade.
Seems like very common sentiment. Like these people don't believe in like laggards essentially, or like catch up trades. At least to an extent. Like if there's like multiple large blue chip in the same sector, and like, okay, Nvidia has run first, and you're looking at like AMD as like a sympathy trade kind of thing. Okay, sure. But if you're going like way down the risk curve for something that hasn't moved at all, and these things have already like finished their move and they're like almost unconsolidating, probably for a reason. Probably for a reason.
Because at least that stock has told you like, hey, I'm healthy. I've been moving this whole time as the market's been moving. So pay attention to that. And then the other thing is, manage your overall account risk in addition to individual stock risk. So
I mean, that goes without saying.
If you have 10 good setups and you're risking 20 bips on all of them, like no, you're risking like 2%. And really you're probably risking like 2.5, because at least for me, it's harder for me to execute like 10 trades at once. And it's what I found that helped me is like I trade more concentrated, like I trade less positions. And then when I come into the day, if I have a bunch of good ideas, you use your best judgment to say, hey, I'm going to focus on these 2 or 3.
Usually the best way to go about it, because the other thing about that is like we're trying to put on like a lot of positions at once with the same directionality without hedging anything. You're like leaving yourself exposed to a lot of like systemic risk, right? Any kind of like negative bearish news comes out or whatever it may be, and like the entire market starts to like roll over or do any kind of correction, and like all your winning trades just going to shit. And like if you're just got into them and you didn't get the chance to shave it all or put your stop loss break even, then all of a sudden you're taking like multiple unnecessary losses. Whereas if we just have like a handful of trades, like I would try and balance it. Like if I'm gonna have like a bunch of trades open, I need to have some like exposure on both sides. It can't just be like all 100% longs and no shorts. Even if it's just for the sake of having like an insurance policy, right? Just kind of short like something that has been relatively weak. But the market does roll over, like, you capture like, a lot of that asset's downside.
Because one, I can just fully focus on them and be ready and execute them right. And then 2, I could better manage kind of my overall account.
Fuck with that.
And then the other thing is, let's say you bought 2 or 3 stocks a day before, if you haven't gotten your stop, above cost on those, and then you're looking to add a few more positions, just take into account, you're kind of exposing yourself, to having more risk. And, there's certain times where, you just really think you're seeing a turn in the market where maybe you're willing to take a little bit more risk. But, you just don't want to get your head too far over your skis, and, kind of screw yourself. So, just take into account the overall account in addition to the risk you're taking on each individual position.
Excellent. Yeah, Oliver, this has been really, really great. I think especially the NVIDIA example, walking through where you size, where you raise your stops, and where I think that'll hopefully help a lot of people watching. One question I have for you is if you were to give a homework assignment or exercise for people watching to do, related to the price cycle or related to figuring out their own price cycle, what would you kind of tell them to do? And maybe it's related to the Swing Report webinar yesterday where we walked through studying previous winners, marking up those charts, all that. But yeah, what would you kind of assign everybody today?
Well, yeah, I mean, I would say go look at the stocks that have done really well the last 20 years, or if you have the data to look back further, is what I would start with are, for me, the names that have been key for me the last couple of years have been NVIDIA and Tesla. I would start there. Prior to that, Shopify was a really big name for me. And then when I first started trading, in like 11, 12 or so, kind of the hot names were like Google, Amazon, Apple. So, go back and go through those like bar by bar. The nice thing about Thinkorswim is you can kind of just press right and you can literally kind of trade those just by seeing one bar at a time. And then is what I would say is like, once there's a big move, kind of go look at the weeklies on these things and realize like how long they consolidate for in between these moves. And, sometimes, it's a stock that moves for like 6 to 8 months throughout the year and then it's quiet, or maybe it's like two to 3 month moves in the year. And then it's got like, 2, 3 month kind of basing periods in between. But stocks are not always just like going parabolic all the time. Like they do need to kind of catch their breath. So I would go through and kind of study those big winners, and then look at the weekly as well as the daily. To try to size those up and learn for future stocks.
Excellent. Well, Oliver, thank you so much for your time for
Interesting.
bringing this together. I think it will help a lot of people. To everybody watching, I hope you enjoyed as well. Make sure to thank Oliver in the chat right now. And if you'd like a copy of these slides, there'll be a link posted right there where you can sign up and register to get the slides, not just Oliver's presentation, but all the presentations as well. So make sure you click that.
Oh, well, pretty interesting video, right? I mean, at the end of the day, he like even before we started the video, we talked about the whole this whole thing, right? With the 30-week moving average. Seems like all these people are doing some variation of this, right? Sure, they each might have their own little spin on it, but they're all doing essentially the same thing. But this guy does seem a bit more efficient than the others in the sense that he doesn't just try to hold them, right? He gets in and out. Like he minimizes his risk well. That's what it is, right? He doesn't like stay on them and get caught in these like, reversal moves. He'll start to shave out, and then like exit completely, puts like a full-on breakdown, and then he'll just get back in, keeps going. Whereas some of these other people were not doing that. Also, I found the point of him kind of like monitoring the overextension from like the 10 moving average on both the time frames at once, like the weekly and the daily. It was like pretty interesting, right? Curious to go kind of play with that back. I'm just gonna code it and kind of see how this thing plays out. Kind of just quickly back test, right? Don't gotta do it by hand like a little noob. Well, pretty interesting though. I'm gonna get some food and we'll watch another one of these. I think the next one's on like another pretty common one, right? The volatility contraction pattern, the VCP. Probably pretty familiar with, but maybe there's another little nugget of juice worth checking out. Once I get a 3-hour candle close, how's this stuff looking? Where's the music? Where the music at? Interesting, right? Interesting. Seems like they want to go lower, right? Looking like they want to go lower. Maybe we'll kind of leave this for a bit while I go get some food. Your boy is hungry, goddamn.
She asked if I feel it. I said nah. I mathed it. price pushed up, but no one stayed. Failed auction, broke that high, couldn't hold. Candle popped, then it froze. TPO got left exposed. Fade that fake, that's how it goes. Auction failed, no bid stayed. Volume light, structure swayed. Price reversed, I was late. They got loud, I got paid. Saw that wit, didn't bite. You called run, I called right. First bike fake, second broke. Auction thin, I smell smoke. No conviction, just emotion. Fade and move, no real motion. Price came back, quick reclaim. You said breakout, I said blame. Value a high test once more. No follow through, I short that door. Liquidity gone, map been drawn. They went high, I stayed on. Broke that high, couldn't hold. Candle pop, then it froze. TPO gap left exposed. Fade that fake, that's how it goes. Auction failed, no bid stayed. Volume light, structure swayed. Price reversed, I was late. They got loud, I got paid. Imbalance shift, no one filled. They chase dreams, I let it build. Tape moved thin, delta dry. You played chase, I watched it die. Reclaim level, that's my cue. Pull back wit, got slipped through. Ops got hit, I don't blink. They post cope, I don't think. No follow, no intent. Price set stall, I took rent. One look up, then we dropped. Auction failed, I caught top. It broke, but no one followed. It spiked, but no one swallowed. It looked strong, but it was hollow. So I faded it. Broke that high, couldn't hold. Candle popped, then it froze. TPO got left exposed. Fade that fake, that's how it goes. Auction failed, no bid stayed. Volume light, structure swayed. Price reversed, I was late. They got loud, I got paid. Price slide, I didn't. Auction failed, I fell. The math is the math. Marcos.
Chart too clean, math too mean. Yeah, I marked it hella sharp. Jaw was loud, I played it smart. They went hype, I went calm. Now I'm dancing on that feel like art. Fibonacci kissed that line. Price came in right on time. You want pump, I want range. You chase green, I chase gains.
Feeling hella good, feeling hella right. TP hit the zone, now I'm dancing through the night. Feeling hella clean, feeling hella sharp. Mark that trade at 10, now I'm parked inside the chart.
She a runner, she a chart star. Price ran off, left my limit fall. I had the zone mark, I played it smart, but she took off fast, tore my plan apart. No feels, just chills, I watched it go. No wick, no tag, that candle stole. I was patient, disciplined to the bone, but that breakout left me here alone. Heartbreak on a 5-minute screen. Waited weeks for this move so clean. Fit was sitting at 0.5. Thought we danced, just her and I. Yellow line held, I set my bid. 1 tick shy, she did what she did. News hit loud, she broke out wild. I was calm, but missed by a mile. Now I'm scrolling, slow motion, replaying charts like old emotions. Hopium hits when I see that wig, but the map said no chase, so I ain't clear. She a runner, she a chart star. Price ran off, left my limit far. I had the zone mark, I played it smart, but she took off fast, tore my plan apart. No feels, just chills, I watched it go. No wick, no tag, that candle stole. I was patient, disciplined to the bone, but that breakout left me here alone. No revenge, no FOMO spin, just deep breaths in my discipline. Next setup, I'll be there still, even if this one missed the fill.
You still guessing? I'm still charged. Still floating. Still right. Marcos. I've been living that math life. With kids on, I don't ask twice. Top floor chart, got a glass pipe. Cookies in the wood tray past night. TP hit, got the dashboard glow. Price hit fib like it's stuck on code. She asked why I'm calm, I just know. They trade loud, I trade low. Back this line, entry divine. I ain't even blink when it crossed my line. 0.5 bounce, I just recline. That Bugatti wheel got chart design. Paddock on tilt, but the time stay perfect. Math too clean, I don't need no verdict. They get squeezed, I sip on sherbet. She said you psychic, I said just certain. Night got dim, but my screen still glow. High as Mars, but the levels still show. She said how you hit that so cold. I said Swan ain't that golden clear. That math like with kids on, I don't ask twice. Top floor chart, got a glass pipe. Cookies in a wood tray past night. TP hit, got the dashboard glow. Price hit fib like it's stuck on code. She asked why I'm calm, I just know. They trade loud, I trade low. Wrist got snow, but the feel still hit. Watch don't tick, it just exists. Trade so smooth, it don't resist. Zone got touch, now back I lift. No rush moves, I let them drown. Fill them up, I slow it down. You hype on green, I vibe with math. You chase the trend, I fade that path. I don't get loud, I just get rich. I don't need calls, I got that script. I don't need edge, I am that edge. Just say yes when the wick got clipped. 618.5 golden touch. Trade high, math life. Living that math life. Break his zone, I don't ask twice. Top floor chart, got a glass pipe. Cookies in the wood tray past night. TP hit, got the dashboard glow. Price hit fib like it's stuck on code. She asked why I'm calm, I just know. They trade loud, I trade low.
Living that math life, boy. How do these things all close? What's going on with gold? What's going on with the gold thing?
Size too heavy. They ain't built for this. Yeah. They keep talking about risk, but I am the range. Price hit my line, now I can't behave. I ain't even blink, caught the move like fate. They click long late, I reverse that wave. Smoking on pressure, chart glowing slow. Got a red box set where they think and go. I just draw, roll, chill, let it show. Hit they stops, that wick dip low. Ferrari red dashboard match the fib. She see the math, now she tryna live. Sipping wok, taking profits off rips. They need full setups, I just need a glimpse, yeah. Big size, bang, red wig, bang.
Oh, we're both eat good.
Slick, I slang. Your little bag got bang. Ain't stressing no screen, I smoke. Top shelf haze, pure dope. They chase highs, I just float. Math move mean they get ghosts. No cap, I tap into TPO zones. 0.5 slap like a slap to the dome. Imaginary lines still bounce to the bone. They said fake till they margin gone. Chilling in a robe, chart tucked in chrome. Jet fly, private trades hit from Rome. Wick kiss close, you know that tone when it reject hard and they bags get blown. Whiz type vibe, high math, no luck. Drawn from the top like a rough coat brush. Short, I'm clean while they foam mo clutch. Then I hit beach seats, feet up plush. Big size, bang, math. Red wig, bang, got 'em. Chart talk slick, I slang. Your little bag got bang. Ain't stressing no screen, I smoke. Roll up, top shelf haze, pure dope. Cookies, they chase highs, I just float. Drifting, math move mean they get ghosts. Marcos, I ain't gotta force it. The chart gon' talk if you draw right. They want signals, I want silence. Bang.
Where were we? Where the fuck were we?
Marcos said it's fake till price came kissing that dash. Pixel hit, no wig, just flash. Didn't react, just let it pass. Imaginary lines, but they always bounce like math. Call it voodoo, now they gas. I stay silent, still outclassed. Jar was dark, line still glowed. Dashing yellow script I wrote. Didn't draw that for the show. Prices came and hit it cold. I don't flinch, I don't speak. What came back, tapped it weak. Feel so clean, they call it cheat. Truth too sharp, they missed the peak. Overnight hit while I slept. Alarm said feel no second guess. They call dream, I call map. I place edge, they play stress.
Okay.
Till price came.
Let's start working on this next thingity thing.
No wig, just flash. Didn't react, just let it pass. Imaginary
Dun, dun, dun. Pause that. Switch this.
Trader who now runs Minervini Private Access. He's also the author of Trade Like a Stock Market Wizard.
Bruh. What quality is that?
For money, well, you stay away from the companies that can't grow those revenues, and you go with the companies that are showing not only earnings but also strong revenue growth.
It tightens up real nice here and holds its gains, sets up a perfect, if you look at it, it's a perfect cup of handle, right? VCP, what I call it. Boom, comes out here, we're back in, we move right back up.
I think Yahoo short-term is definitely extended and it's ahead of itself. The internet is something that's very viable and it's going to be here for a long time, probably forever.
If you lose on a trade, it's because you missed something. Either the market, the stock, it wasn't set up properly, something you missed. Because when you do it right, it works perfect.
All right, welcome back everybody to the Traderline Conference. I'm very excited to welcome our next speakers. Joining us are Mark Minervini, Mark Ritchie II, and Brandon Hedgepath. Mark Minervini, as many of you know, is a market wizard, author of Foundational Trading and Mindset books, a two-time U.S. investing champion, and a 40-year veteran of Wall Street. He is also the founder of Minervini Private Access and the creator of the Master Trader Program Super Performance Workshop. Mark Ritchie and Brandon are both experienced portfolio managers who teach through Minervini Private Access, and they both attended the first Master Trader Program back in 2010 with Mark. And over the 13.5 period working together, they achieved an outstanding compounded total return of 5,667%. And today, I'm really excited. We'll be discussing a wide range of topics based on your guys' submitted questions. And we'll be covering setups, trading mindset, position management, sell rules, progressive exposure, and much more, as well as covering a few of their key traits. Mark, Brandon, and Mark, welcome. It's a real pleasure to have you guys here.
Thanks for having us.
Yeah.
That's great to be here, and I'm really happy to be here with my team, with Mark and Brandon. So I think everyone's going to get a chance to meet some really great traders that I respect more than anybody probably in the world. That probably the only two guys that I would trust my own money with.
Yeah, perfect.
Thanks for having us, Richard. Good to see you again. So it should be a lot of fun.
Yeah, perfect. And yeah, I think it's excellent to get all your guys' different perspectives and all your nuances that you guys will share. To start things off, I want to kind of bring it back to the very beginning of your trading careers. A lot of people watching maybe kind of just starting out a few years into this. Looking back at your early years of trading, and Brandon, I'll kind of start with you on this one. What were some of the key mistakes that you found yourself making over and over again? And what were some of the key steps and improvements that you made to kind of correct those and work towards improving as a trader?
Sure. So style drift, I would say, was a key one. So I would, I think I spent, I don't know, maybe $10,000 jumping from one strategy to the next. Whether it first started with options, then it was selling options, right? So I was trading options on the long side. Then it was selling premium. I jumped to, I don't even remember. I traded Forex. I paid a guy $4,000 to teach me how to trade Forex. That didn't pan out. And it was like every 3 months or so, I'd have success and then I'd give it all back. And then I'd be like, all right, this isn't working. Where do I go to the next thing? And then it was over a 2-year period before Marky turned me on to what Mark Minervini was starting. So I had a good, 2-year experience of screwing things up, put it that way. So this idea of I was always committed, but for some reason I just had a sense like I was missing some pieces.
Yeah, and was
Rich, just to point out, Brandon calls Mark Richie Marky, and I'm Mark.
There you go.
That's a good point, Mark. Thank you for that. Yeah. So Mark Richie's Marky to me.
Well, that makes it easy to differentiate. So thank you. And I also want to kind of touch on for and hear from each of you guys kind of some aha moments. And it sounds like the Master Trader program for you, Brandon, and Mark Richie, of course, or Marky, was kind of one of those turning point moments. So would you guys kind of touch on, what were the key takeaways from that experience that really set you on that path towards getting super performance and really improving as a trader?
Can I just give a little setup here, because it's really inspiring when you hear about Brandon, in particular Brandon, but Mark and Brandon together, what they've done. And Brandon and Mark came to the very first my first Master Trader program. I think it was 25 people in the room. It was simply an experiment at the time. I was for me to try my material that I was using to write my book, and I wanted to see what would resonate with people and if it should go in the book or not. And so I said, let me do a seminar, and we'll that I'll get to see, people's visceral response and questions. And that's how it all started. And now it's, it's 15 years later, we're still doing it. But Brandon, at the time, couldn't afford to come to the Master Trader program. So he sold his car to pay for it, which, you want to talk about commitment. He said he was committed. He certainly was committed. And they came, and collectively they left and started trading as a team with, a relatively small amount of money, 25 or 30, $40,000. And now they manage together their own money over 25 million. I think now they're in the, the tens of millions of dollars that they've grown it. So, and they were a customer of Minervini Private Access for a decade, where they traded on their own. And it was after all that, and we of course over time became friends and so forth, and I was real proud of them. Then they started working for me and been with the company now for a good number of years. So it's just a great story, and I just want everybody to know what incredible dedication. These guys are amazing.
So Marky, you wanna lay the backdrop, or you want me to?
Yeah, sure. Well, the original question was, mistakes and those types of things, and just taking it back to there, because a lot of people know, obviously, or maybe familiar, my dad was a retired trader, but I never actually worked for him or did anything like that. Worked for an old associate of his. That's actually how I met Brandon, and they really got off to a terrible start. So even the idea of it's in your blood or it's in the genetics, so that's really not the case. Even I think it was talking offline, Sean Ryan made the comment in an interview with you, Richard, the markets don't care who your dad is. Couldn't be more true. There is no gene for trading in my view. But anyway, I didn't have a process. I didn't. Discipline is something that did come easy. I don't say easy, but something that I understood that, listen, if you can apply a process or tactics and discipline that work, I just didn't have that. So you did what a lot of people did. You tried different things. And then, to fill in a little of the details, Mark had just started doing a few things, even on StockTwits, and had a blog, and then started the MPA thing. And I told Brandon, I was like, look, I'm making money and just kind of learning, what this guy's doing, but he's doing sort of this seminar. Very similar. I made a little bit of profits, and I just took some of the profits and said, I'm paying for a trip to, Myrtle Beach to go figure out, how he makes the sausage, if you will, And to me, it was really more, like I said, I think, and one of the biggest things I took away, I still talk about this, is this idea of not being in too big of a hurry, where I felt like armed with the knowledge that we learned there. And then of course, getting a workbook and all these things saying there's a real path forward if you can continue to be disciplined and get good at this. Most people don't, I don't care what it is, what the, the discipline or the avenue is. They don't spend enough time really getting good. They just want to be successful. One of the things Mark talks about is you get the skill first, then the money and the success come later. And to me, I actually felt like, that was really what the course provided was like, this is a consistent approach to the market that is timeless, that isn't just a one-trick pony, or it's going to, go in and out of vogue and then not work anymore. It was working before any of us were around. This approach will be working long after we're dead and gone. So it was this idea of, for lack of a better word, this is the brass ring as far as trading is concerned. It's just going to require consistent application and discipline, some hard work. And it doesn't feel like that was 15 years ago, but I can't believe that was actually almost 15 years ago in 2010. And then, so we just put our heads down and did the work. It was actually years later when Mark was like, you guys have done a really good job. And Brandon and I were like, I guess so. We're just, again, heads down trying to do the work. Good things happen.
I got to say something. I got to jump in because it just reminds me of certain moments. We were all together one time, and this is after these guys have been trading for like a decade and a half, and they've amassed tens of millions of dollars. And I said to Brent, "You guys are massively successful." And he said, I'm just starting to feel like I'm successful." I'll never forget that, Brent.
That's right.
Like, I'm just starting to feel like I'm successful. So
Go ahead.
the humility and the discipline, and these guys are really purists, and now we're seeing lots of, we've got the U.S. Investing Championship. Norm Zeta restarted a number of years ago. I guess it's maybe 6 years now or so, 5-6 years. And we're just seeing, our members dominate. This last quarter, we had all 4 divisions were our members. So it's just these guys and all these people that are entering the contest are showing that it's teachable, and I think O'Neill did the same thing. O'Neill had David Ryan and had Lee Freestone, and it's duplicatable, it's teachable, and these are principles that are timeless. And there's going to be people long after us, and these guys are the next generation, and the people watching here are also the next generation.
Yeah, and I love that. Like that's one of the things that really stuck out to me, Mark, when the first time I met you, because you did say that. You said timeless principles, and I really thought about that for a long time, because I'm like, well, what does that mean? And I think one of the things I always struggled with when I was bouncing around other places was I had so many unanswered questions. And not that when we started doing the Minervini style or approach that Mark was teaching at the time to us, even leading up to that seminar, was, he gave you everything you needed. The process was there, and I never.
Quiet as fuck. Is it? Is it now?
Never saw that from anywhere else. And it was like I had this aha moment, like, holy cow, here is the holy grail. And the risk management alone, which is what we talk about, is the holy grail. No one taught me that. I didn't stumble across that, but that was something I knew in my mind I needed, because I'd always ask these questions of like, well, how do I know when to not trade? Like I would have success and then I'd give it all back. Like, was I trading too small? Was I trading too big? Well, it was like I knew the market changed, but I couldn't put my finger on it, because clearly what I was doing wasn't working. And when we went to that first, leading up to that, actually, Mark, we were subscribers to the platform under someone else's name, actually. And Mark sidestepped the flash crash in 2010, and we were like blown away. And so leading up to Marky and I actually had lunch, and he's like, "Hey, I'm going to go to this thing. I think you should come." And I was like, "I can't pay for that." And that's when I was like, well, I guess I could sell my car after thinking about it for a little bit. And so, yeah, I did. I sold my car for, I think, $14,000. I took the 4, paid for the seminar. And, it's funny, Bob Weissman told me too that this might be the last one. So it was one and done. So I'm like, all right, well, there's no next year.
We truly thought that we were just going to do it just to, do an experiment to get data for the book, to figure out, what material should go in the book. I wanted to make sure the book was
dedicated.
Good,
sold his car.
But another thing too, I mean, it shows a great commitment, but the real commitment, I think this is a real, we'll get to some of the tools and the important things that people want to hear of how they can be successful. And the real key is that we're 15 years later, and these guys have been doing the same thing. I've been doing the same thing for 40 years. They've been doing it for 15, and I will assure you 15 years from now, they'll be doing the same thing. And they'll be able to say what I'm saying now, and sticking to that strategy and becoming really good at it. And it's not just my strategy. Our strategy is not the only strategy that works. There's other strategies. There's people doing option spreads and value buying and all kinds of things and day trading. But whatever strategy it is, you need to make a commitment to it more than a year or two. And you got to think in 5-10 year increments as opposed to 1 or 2. So that's the real key. That's the real. And with me, I didn't do well for 6 years. I didn't make any money for 6 years. I mean, these guys you guys were a lot quicker to get, to do well.
Well, and to be honest, I mean, we struggled too. I mean, there was some periods where Mark and I, I mean, listen, if we weren't taking the approach that, hey, what did we learn versus how much money we made, we really valued of taking the wisdom that we gained from the market versus, okay, well, we didn't make what we wanted, so we should just quit or what? So, Mark's key too on like, you're going to have rotten days, right? And if you take that approach, and I think a lot of people don't understand, 6 years is a long time to not give up and not make money.
Yep. It felt like a long time. Hey, Rich, I'm just going to let you know that the 3 of us could rattle on for hours.
I'll jump in. I'll try to guide you
better
guys.
Get to like people's questions.
Sorry.
No, that actually leads me right back to the question I want to ask you now, Mark, about those 6 years where you struggled. And you mentioned in your book the realization you made when you looked at your data and you calculated if you capped your loss, I think it was at 10%, that you would have been up, I think, multiple double digits, maybe 80% versus being down. Was that the key aha moment for you where everything changed? And And what kind of specific changes did you make going forward to get on that path towards profitability and, of course, super performance?
There's been a lot of aha moments, and that was the main one that I realized that cutting the losses and what O'Neill was saying was even more important than I had understood, and that I didn't really understand risk management very well. And I went from, I had a 15% loss. I normalized everything to a 10% stop, and my account would have been up 72%. And I said, wait a minute, that has to be wrong. I obviously did a calculation wrong. I calculated it again, came back the same. I calculated it the third time. Lo and behold, it was correct. So then I went and I said, well, let me look at survivorship bias and see if,
It was a
would it knock me out of
disbelief.
some of the winners. And, there's got to be something here that it's wrong, but it wasn't. Even with accounting for all of that, it was still right around that same number. So that was on that day. I'll never forget it. I said to myself, never, ever again am I allowing a loss to balloon. I'm cutting a line in the sand, and that's it. A loss, unless it's going to have to gap through, and I'm taking the next best price after that. But I'm never, ever holding a loss. This is a hard, fast rule that I'm making, and I'm sticking to it. And they're going to have to if they're taking me out, they're taking me out by little, death by 1,000 cuts. I'm never getting taken out by a big loss ever again, because I was, every now and then, I'd have a stock blow up, or I'd fall in love with a stock and I'd buy more of it when it's down. And I just kept distorting my returns, and any little progress that I made would just
I was gonna say, did these people never read Market Wizards? But this guy's literally in like the first book, I think, or one of the first ones. That's the biggest thing about the entire book series, right? It's your risk management, really. I'm surprised people were just nuking their account like this.
get destroyed. So
Try to learn
I
one way,
made that
though, one
change,
way or the
and
other.
everything changed from that point forward. It was just amazing. I started getting consistent returns, my drawdowns, and I just started perfecting the risk management. And before you know it, I went into the 90s. I had that stretch that people read about in Market Wizards, 36,000% in 5.5 years. And you could do the math, regardless if you start with $2,000 or $10,000, it turns into a lot of money, and that was the beginning of a career. So yeah.
And what are your goals right now for risk management in terms of, average stop? I know you track your numbers quite diligently, and Marky and Brandon, I'd like to hear your perspectives as well with what you guys like. But starting with Mark, what are your goals right now in terms of capping your losses and keeping very strict risk?
So we all work together, and we actually at Minervini Private Access, we have a called the Minervini Select Trade Portfolio that we manage as a team, and then we have our open positions where we put breakout stocks and all that. So you'll see that in real time, and and also manage our own money as well. And these guys, if you look, and I don't know what they're doing with their own money, they don't know what I'm doing with my own money. We don't really talk about that much, but if we go back and we look at their losses, my loss, they're about the same. We're averaging anywhere between, if we're really tight, 3%, 3.5%, 4% in a market that's not very good. We might be 5, 6%, averaging 4, 5%, 6%, line in the sand at 8%, but we stagger stop sometimes. So we'll put like a 4 and a 12. Usually it's not even a 12. Usually it's a 10 is the max. And we might use, a staggered stop. And from there, you will still average that 8%. That 8% is a number that goes back to O'Neill, and it's a number. It's a very important number for a few reasons. Number one, if you just do the math, once you start going over
10% of what? Did I miss something?
10%, the math starts working against you because losses work geometrically against you. So now, you're down 20%, it takes 25% to get even. You're down 50%, it takes 100%, right? Everybody knows this. Well, 8% is about 8% to get even. And also, when you look at charts and you go back and you go all the way back to the 1800s, we looked at charts. I've looked at millions of charts, literally millions of charts, and we've got the research, and O'Neill had the research, and Love had the research, and you're going back to all the way to Jesse Livermore. When you look at these charts, you don't need more than that. Like that, if you back into the way charts fluctuate and stocks fluctuate, if you know how to enter properly, well, then it will be abnormal. If you start getting 10, 15% moves, that's abnormal fluctuation, and you'll know it. So that's what's necessary, and that's what mathematically works.
Yeah, perfect. Brandon, Mark, anything to add there?
Yeah, I'll just add, obviously, in terms of the risk management, we're all cut from the same cloth in that regard. And look, the tighter, the better, Richard, is generally when people go like, well, how tight do you like to be? Well, depends on the setup. But the one thing I will just add, where Mark was talking about post-trade analysis, and that process, though, is something that no one can do for you. But if you faithfully do it, where Mark was saying, I had this aha, where it was like, all right, I am drawing the Maginot line in the sand, like I'm never crossing it again. I had a similar experience on the upside, 5 or 6 decent years. And I'd gone to my 3rd or 4th Fifth Master Trader program, came back and did a big study of all my biggest winning trades, and actually found out that they were in the same groups that Mark had written about in his books, that O'Neill had written about, that I was like, my own results were bearing out that like I should be, if anything, more aggressive. What did all my biggest winners have in common? They either had earnings or sales, or they were part of some of the classic growth areas, minus the biotech. And so I just said, I'm not going to play favorites, but if that's where I've made all the money, and then going into the next cycle was, I think it was 2016, 17, we did something like 200% in the next 18 months, armed with that information. And this is where, again, one of the things, you know, we learn and we teach is that process of grading yourself, going through, studying your results. That is one of your best teachers.
Hey, let me just say two points. One is the results bearing out the research, as Mark just said. That's what happened with me too. As I started getting the results, it was confirming.
This guy looks like a younger Larry Fink.
The O'Neill research. It was confirming the Richard Love book. It was confirming Jesse Livermore. It was confirming all these people who I had concluded were onto timeless principles, that principles that will work forever, because it's a law of supply and demand is like gravity. You know, it's not going to change. So here's, and you asked about the haha moments. There's two more. And the one, and this is what something I've said many times that I learned from O'Neill. O'Neill was a man of personal responsibility. I mean, he really was. And I met him a bunch of times, and he said some things that were just so enormous that just lasted for the rest of my life. And one thing he said was, look, if you lose on a trade, it's because you missed something. All right. Either the market, the stock, it wasn't set up properly, something you missed, because when you do it right, it works perfect. And when the market conditions are right, that might sound obvious. That's a big statement. That's a big statement. And that means that, you know, there is a certain time to do this, and there's a certain time not to, and it's up to you to learn and get the skill to be able to do that. And you're not going to be perfect. You're not going to be perfect. So then not only do you have to get that skill to do it well, but when it's not working and things aren't going well, you have to have a mechanism to mitigate the downside, right? So what I did is I just listened to David Ryan. I went, just like these guys came to my seminar, and David Ryan actually he was my instructor for 8 years at the Master Trader Program. I went and saw David Ryan when I was a young kid, and I saw O'Neill, I saw David Ryan. David Ryan said, you know, just take a green pen and a red pen and mark where you bought and sold on a chart. And that's your best teacher. And that was the big aha moment. I reckon, and it's funny because originally the mistake that I found that I was making very often, besides holding losses, I corrected that. But then I was selling too soon. I was constantly selling stocks way too soon, and I'm still doing it to this day. Fortunately, I selling them too soon, I still make enough where it pays for the risk, and I've been able to build a fortune off of that. But we can go over NVIDIA, and I sold NVIDIA both times too soon. Just these last couple trades, bought it as perfect as you can possibly buy it, and both times sold it too soon. But so yeah, doing that post-analysis, and you will find common denominators, things that you do over and over, good and bad. So you'll see, these are my strengths. You'll see your weaknesses. And when you start to see something you're doing over and over and over, that's what really tells you what you need to work on and what you need to exploit.
And how often would you guys suggest for traders watching this to do post-analysis? And what would be kind of the key steps? There's calculating your numbers, and then there's, as you mentioned, going over the charts and the trades and marking them up. What would be kind of your guidance there?
That's a great question, the way you partitioned it into two things, where it's the numbers and it's the charts and the trades. And they're two completely different things. One is the math. And I'll let you guys talk about it too, Brandon and Mark. You know, they don't do it any differently than I do, where we do it the exact same way. But looking at the charts, there's a couple of general rules of thumb. One is, I find it's best to look at it later, to let some time go by, months go by. When you do that, when you go back, it's kind of like I'm grading your trades, Rich. You know, like you start to look at them as objectively and not emotionally. You're away from the trade. You kind of forget about it. And then you can really honestly identify, and you can be more objective about it. With the numbers, the math is the math. And the math, this is the thing I think that people have a hard time with, is bringing the two together. I always say, let the spreadsheet make its way into your trading. So you got to be cognizant of your numbers. And then you know where your average loss is, your average gain, and you see the math. Well, this math isn't working. You know, my losses are bigger than my gain. Obviously, you don't have to be a rocket scientist to figure out you're going to lose money, right? So you got to get that math right. But then you've got to back into trades and back into the risk, into the charts that math works. And that's the hard part. That's why I'll leave that up to you to explain, Mark and Brandon.
Go ahead, Brandon.
Oh, you want me to jump in here? All right. So yeah, so that's what I did. You know, in the early days was 3 months and 6 months. I would always review the trades. And I think for me, you know, before Mark and I officially formed our partnership, we would trade in the same office, but my trades, you know, were sometimes different than his. So yeah, I was always selling too soon because I was very risk adverse to the point where I was choking everything off. So to me, the math making sense with, how the chart, where I want to be the last week holder, meaning when the chart sours, that's when it matches with my, our percent stop. That makes mathematical sense. Typically for us, we run our win rate's a little bit lower because our average loss is like what, around 3%. So we don't have a problem taking, stepping aside quickly, but we'll also look to get back in quickly. So for me, that aha moment, or doing the hard work, because it is hard work, seeing how well you've played versus in your mind how well you think you did is two different things. So yeah, for me, the just understanding that I don't want to stop out something that's not doing anything wrong, without the idea of like, okay, well, if I do, I got to get right back in if it starts to go in the direction I wanted it to.
Yeah, and that's where we learn. That's where in my book I talk about confirmations of violations. So if you breathe, think, and trade like a champion, you'll basically what Brandon's referring to are violations. If there's no violations, then you want to stick with the trade. But go ahead, Mark. I'm sorry.
I was just going to say, I'm not going to add a whole lot of color other than just, I can remember though, it was, I think at the very first seminar when Mark called it knowing the truth about your trading, which is what he refers to in his book too. And he said, how many of you are tracking your trades in here? And it was like, I think R2 were the only two hands that went up. I couldn't believe the number of people that weren't doing this. But because it really is an exercise in seeing your own, it's the way you look at yourself in the mirror, in terms of the numbers don't lie. But I would agree. I think we try and log them right away and then come back to grade them later. So I have themselves and then come back and grade them. I
have seminars where, I have 400 or 500 people in the audience to say, how many people right now, raise your hand. How many people know your average gain, average loss, percentage of winning trades, biggest loss, smallest, biggest win, biggest loss? Raise your hand. Yeah, 5% of the room, 10% of the room, the hands go up, and that includes the people that are lying. So
God, that was funny. God, the Nas is puking. I mean, yeah, I guess so. These things all changed. What the fuck? The math is this guy's been watching the stream, right? This guy's been watching the stream. That's what's going on here. Where is that song?
The math is the math.
The math is the fucking math.
Nope. Lambo mad black.
Guy's been watching the stream. Little fucking fan.
And I say, I'm going to call on you. So you better, if you raise your hand, I might ask you your numbers.
No, I think it's interesting though, how the kind of point they made about going back and reviewing your trades like down the road. Kinds of ever like I review my trades, but like I don't go purposefully leave them unreviewed for some like later time. Interesting.
Guy raised his hand. I said, okay, what are your numbers? And he's like, okay, you don't know. So, but yeah, it's very few people, do the math and actually know their numbers. So my question always is, well, how do you know where to cut your loss if you don't know your gain? If you don't know, like, how do you know the math behind it? If you don't know what's going on in your trading, well, how would you know how to manage your risk against what? So knowing the truth is the very first thing, drilling down to the truth of your trading. And that's, for most, that's painful, and it's even painful to look at the, we have some really great tools on my platform, on the NPA platform for analytics. We have where you can put your trades in. It breaks down all numbers. It gives you these bell curves and so forth, proprietary stuff. We've got a grader where you can grade your trades. Surprisingly, a lot of people don't use it. They don't use it. Way less people than I would think and should. It's not the most favorite part of the platform, and that's the part that is the most important.
And to add to that, if for instance you do your calculations and your average gain is around 10%, where would using that information, where would you say, all right, given that average gain, where should I cut my risk now? Are you shooting for 2-to-1, 3-to-1? It definitely depends whether you're more of a swing trader and turning things over faster versus more of a position trader. But I'd love to hear your guys' thoughts with that, and maybe start with Mark Minervini.
Well, we're shooting for a minimum of 2-to-1. We'd like to have, the gains cover the losses by 2-to-1. And that gives you some room, to be wrong. 3-to-1 to 5-to-1 is, where I'd like to be on my better trades on the bigger winners. And sometimes you get 8 or 10-to-1, 8 or 10 or 12-hour trades. But on average, this is the thing that people have to understand. It's all about what happens on average. It doesn't matter what individual trade, what one individual trade does. It matters about what you do on average. When it all comes down to it, it's going to be your average gain divided by your average loss times your batting average. And that's it. That's the holy grail. Manage that, keep that a positive number, and you're a winner. The bigger that number is, the less trading you have to do. So if it's 1.1 to 1 and you're making $1.10 for every dollar you risk, you're going to have to do a lot of trades. You have to turn that over. If it's 3 to 1, you're not going to have to do a whole lot of trades, and you're going to be able to be wrong a lot more. So that's the balancing act that you play, and that is going to depend. If you're a day trader, you could have a 1.1 to 1 reward to risk, and you're going to turn that edge over. I mean, I have a couple friends that are day traders, very successful, and one of my friends, he does in one day sometimes 5,000 trades. I mean, can you even? It's almost unimaginable how that is possible with the amount of time that's in a day. But I've seen it with my own 2 eyes.
It must be automated, right?
In one day. So think about that, turning that edge over. Even if you're making, $1.01 versus what you're risking, if you did it 5,000 times a day, that can add up.
And one thing that I've struggled with, especially, say you do it quarterly and looking back at a trade that was a few months ago, is it's a little bit tough. Of course, you can add an index to the chart, but it's a little tough to know the context surrounding that trade. Because we all know that if it's a semi trade and, it starts pulling in, it's still above the moving averages, but all the other semis that are also maybe in your portfolio are pulling back in the same time, putting pressure on your equity curve, that type of thing. So my question is for you guys, how do you take into account the context of a trade to identify maybe those hidden mistakes that you're making, selling something too early, just because everything's pulling in when the chart is still not broken, and still, fine overall? And maybe I'll start with Brandon on this one.
Oh, you want to start with me on this? Okay.
Yeah. No
So well, that's a tough question because, listen, we always want to try to expand that average gain as well. So it's like, you could be a strict 2 to 1 trader. That's fine. And your goal is to turn that over as much as possible. What Mark and I learned, though, is we got some really good stocks that we sold up 10% that we should have held for 20-30, right? So it's like, you got to, again, this is going back to the post-trade analysis to understand how a stock fluctuates, right? So if you get 10% and you haven't even sat through a first natural reaction, maybe you don't want to sell yet, or maybe you just sell a smaller piece, right? And then you want to hold for a bigger move. And that's typically what we try to do. Again, I think, Richard, the idea of like, what is the market? What's the environment, right? Because we do stock tactics feedback, right? What's the feedback from the market? So it's important. But if you're just coming out of a bear market, you know that, or you don't know, but your thinking should be, I want to hold maybe a few of these if they have the earnings and it's coming out of the right pattern for a bigger move.
Right.
So yeah, we always, this again is something, in my opinion, is hard to have a good answer for because each stock is kind of unique in its own. So like, this is where we talk about, hey, give us an example, right? And this is where Mark's from the MTP, the trading book that he gives us, which is a model book, is so valuable. And I will still, to this day, Mark and I both will review these charts if we're just not doing anything. And I have one on my desk from the first one, and I'll just flip through it because I want to see how just the natural flow of a stock acts. And we want to maximize, obviously, the most gain we can in the shortest amount of time. And that's something that stood out for me that Mark taught us originally too. Would you rather have a 60% gain that took a year, or 10% gains that actually compounded equals more than 60%? That happens all the time.
Yeah, real quick too. You asked about context, and I don't know, Mark, if you have anything to share too, but you asked about context. And I don't generally worry too much about like if another stock in the group, unless it's a key stock and it has a major break. Nvidia, has a major break and has the biggest down day since the last 5 years and the biggest down week on the largest volume. That tells you something. That's what we call the axe in the group. So, but I tend to stay stock by stock, right? But here's the real key. Are you in a bull or bear market, right? Are you in the early stages of a bull market or the late stages of a bull market? What kind of traction are you getting in your own trading? So now if I'm in the early stages of a bull market, we've had a bear market, right? And now all of a sudden, stocks are breaking out and we're coming off the lows. And this is the first sign of stocks breaking out of really great high RS names or coming out of bases. Well, I might have a monster by the tail. You might have Nvidia, Amazon at the beginning of a big move. Even if you keep a tiny position, you sell 90% of it and you keep 10%, it could be life-changing. So at that point now, I have a different tactic, right? I'm going to maybe, even though I might short-term trade some into strength, I'm going to finance my risk and now I'll play the rest for a big move. And some of these stocks go up thousands of percent. They don't even close below their 50-day moving average, let alone the 200-day. So you start backstopping them. Now, let's say we're in a late stage. We've been in a bull market for 2.5, 3 years. Your stocks are coming off, then the groups are coming off their 4th, 5th stage base, and you're running up. That's a gift. Those are gifts that you have to take, sell right into. And now I'm short-term trading. I'm getting shorter and shorter and shorter as the bull market gets older and older and older. That's really the key, and the traction is the real important part. Mark, Brandon, we're everything that guides us, and whether we get aggressive or not, is all based on it is our own trades working. Doesn't matter. The whole world could be doing well. If our trades aren't working, we're not increasing size.
It's pure gold right there.
Yeah, Mark Ritchie, did you have anything to add on this?
The only thing I would just add back to your original question was because you had asked about, hey, what if I sold the stock for other reasons or things like that? I would just put that in your notes, or in our grader now we have this annotations where you can say, hey, maybe I was getting stopped, and so I just reduced overall risk. But generally, when we're grading stuff, we're just looking at the chart, like in a vacuum. Even to Mark's point about you want to be in your own little echo chamber in terms of your own trading. That's what you should be hearing. How are my tactics working right here, right now in the market? And that should be the only thing really driving. Am I getting more or less aggressive? The same thing though, like that trade has to stand on its own. So yeah, I may have, I got stopped on a few other positions. I was raising a little bit of cash, so I sold this one a little early. I might make a note for that, but that still doesn't mean it was a proper sell on that chart.
Right.
If that stock was acting really well, I might rate that as an early sell or a bad sell. I'm still going to be honest in terms of how I do the grading of each one trade on its own.
Yeah, perfect. I think that's what I was looking for. And to everybody watching, some of this might seem theoretical, but we're going to actually jump to some trades in just a minute. I just have a few questions on mindset.
Is it theoretical?
Where everything hopefully will come together.
Yeah. And very little of what we say is theoretical. I mean, it is practical. We use it in real life, but you're right, Rich. It will sound theoretical. It can sound theoretical. Yeah.
Yeah. Just to start with, Mark, for you, what are some kind of mindset shifts that traders can make to unlock the belief that they can achieve super performance and be very successful? Is there something that you've noticed over time, teaching many traders at your workshops as well as through MPA?
Well, to me,
believe in the math, right? That's right there. That's the fucking key. You gotta believe in the math.
Was the power of choice and
number
the power
one
of making the choice to believe and to to believe in yourself.
Fuck yourself. Believe in the math.
And again, it sounds corny, but when I was a kid, I watched the movie Rocky, and there's a part in there where they say, he's great. Rocky says he's great, and then his cornerman says he's just a man. Just be more man. And I started thinking about it, and I said, when I was going to see O'Neill and these guys, I said, these are just men. These are just people just like me. If they did it, I could do it too if I learn. And so I took that personal responsibility.
True.
One of the things I got from O'Neill was that personal responsibility. I mean, also Dr. Wayne Dyer, who people know I'm a huge fan of. It was like my life coach. He passed away, unfortunately, but there's someone who I spent a lot of time with and studying his work. It was all about taking really 100% personal responsibility and saying that I can do this because someone else did it. The 4-minute mile. After they broke the 4-minute mile, a whole bunch of people broke the 4-minute mile. That's the way it works, right? That's why we do this, is to inspire. That's why I write books, is to inspire others. When I see these guys winning the U.S. Investing Championship, and I had a little to do with it, it makes me way more happier than me winning it, to be honest with you. I probably wouldn't have 30 years ago, but now it does. So yeah, the mindset has to be where you need to be open-minded to, number one, that if you're not doing well, you probably suck at it. And you're going to suck at it because you don't know shit. And that's the bottom line. All right. And you don't know shit for 5 or 10 years.
True.
And you got to realize that that's the way it is. And find somebody who knows what they're doing, shut up, listen, and make a commitment to something. You can't go to a coach and give it a half-ass effort for a couple months and then go to another coach. There's no magic coach. You've got there's coaches that coach different ways, and some coach with a lot of positive motivation, some coach like Bobby Knight, scream and yell, and there's different ways, right? So, but you got to make a commitment to that coach. You got to make a commitment to a style. You got to make a commitment where you spend a lot of time not being very good at it and working. And I think that's the mindset, is that I think that's my strength, is my unconditional persistence. These guys, I don't know why, if I had anything to do with convincing them to stay with something for 15 years straight and doing it over and over, and a lot of other people too that have followed in my footsteps. But I know O'Neill did a great job of convincing me that this was the way to go, and that if it doesn't work, it's because of me, not because of the style of the strategy. And that was the key. The key was convincing myself that it wasn't the strategy, it was me. I think that's the ultimate mindset, is the responsibility.
And Mark Ritchie, I know you won the 100% challenge after 2010, attending the MTP. Was there a mindset unlock that you made there, or kind of a realization? What kind of led to that, shift in performance there?
Well, I was just, again, armed with all the things that we're talking about, and the idea of, we talk about this when preparedness meets opportunity. Well, that is essentially what
plan,
what
prepare,
we do in this business,
ready to
in my
go,
opinion, is just making sure you're prepared for those good periods in the market. And you know, there's so many things, you know, we're all complicated individuals, right? And some people, we all struggle with different things. The reality is that the market has a way of, you know, exposing our weaknesses, and through a number of the things we just talked about, post-trade analysis, you're never going to perfectly remove those things. The key is but you can manage them. And even the idea of, you know, look, whether it's, you know, holding losses, selling too quickly, style drift, you know, is getting over those kinds of things and realizing too, all the way back to, if this isn't a business about, you know, I've got to be right. My goal is to make money. If your goal was and you have to, you know, it's very humbling. Even when Mark goes like we have people now complimenting Brandon and I going, you guys are, you know, helping us change our lives or whatever. And that means a lot to me because I was broke when I came to the first Master Trader program. So I know what that feels like to try and figure this out where, you know, okay, I didn't work at an investment bank or a big hedge fund or anything like that. And to be able to go from, you know, very barely getting by to being quite successful is humbling. But yeah, I would just say, I think it's once you start to realize, you know, I've seen this and I've seen this. Okay, there's a setup here and it's working and I can do this repeatedly. Or as I remember Mark first saying, like,
How long is this yap?
Is there going to be more setups than you have money to buy? I have that like written in a little margin. My very first.
Can we get past the common sense shit
and
and
then I
start
remember
actually talking about trading? Or
maybe a
no?
month later, 2 months later, I can't remember. It was like, holy cow, there's just these setups, like they're everywhere. You know, I remember saying that to Brandon, and it was like I was just buying every one of them so aggressively. And it was again using that whole progressive exposure though. I was at new highs, things are working, and it was like wham, you made a ton of money in a very short period of time with what seemed very low risk.
There's silent gold there, by the way. There's you know, because right now we're in a situation, and you heard what Mark said, a lot of setups, right? But you also heard him say they're working. So right now, just last week, I just did my weekend report, and it was there was a lot of setups last week. Lots and lots of stocks were on our focus list, but a lot of them didn't work. There's a lot of reversals. The Qs obviously they went tagged that high and reversed. If you take a look, even the equally weighted Qs tried to break out of a base, had a big reversal. So, but a lot of stocks were failing. So yes, the setups are the setups there, and are they working? Those are our two gauges. If they're setups and if they're working. And if they're not working, even if there's lots of setups, we're not going to get aggressive until they actually produce results. And then we'd start, you know, progressively exposing, which I'm sure we're going to get into progressive exposure, because that's the most popular question that we ever get, is the progressive exposure.
Yeah. And Brandon, before we move on, was there anything else you wanted to add mindset wise about, you know, key things that unlock a belief in yourself that allowed you to push past what you thought you were able to do and really get stronger performance?
Yeah. So what's that saying? Feelings are great servants, but terrible masters. Is something that comes to mind, and that's something that I think we all have to battle. You know, some of us are better at it than other, but it's like anything. The more you practice and build that muscle, the better you're going to be. Where your feelings don't get to play a role in this. And when, you know, Mark, you know, laid the groundwork, you know, he was just another iteration from O'Neill, right? And now he's passing this on to us, and it's just like, so at some point you have to surrender, you know, what you think you know to the guy that knows more than you, and focus on what he says is the process, and refining the process. Who cares about the results? And that once you do that, and that's exactly what I had to do and what Mark and I, you know, have done, that has led to our successes. We have a process and we don't waver from it.
Yep. And that's what I did. I had to surrender too. I had to get off of my own opinions, and I had to surrender. And quite frankly too, that one of the reasons why, you know, Brandon has a place in my heart for his dedication is because I was broke too. When I first started, I was broke beyond broke. I grew up in a family that, you know, my parents got divorced, and my mother, I used to listen to her cry at night because we didn't have money for food. So I came from incredible poverty. So to be
the trenches,
you know, it was I had to get over a poverty mentality, which was very hard to even accept. Even when I started doing well, I had to pinch myself and go, wow, is this really happening here? But yeah, so there's, you know, that's, look, I know everybody wants tools and they want to know what moving average you use, but really read my mindset book, because that book is life-changing. You know, I read my own book. It may sound nuts, but I read my own mindset book over and over just to keep that stuff in my head. And I wrote the damn book, but it's just a great book, and it's really the most important element. It's the most important part of the whole equation of becoming a great trader or becoming a great anything.
And I'll just add one more thing. You know, when Mark and I first started, we were trading so small. You know, a few $100s was a big deal to us. Now, you know, we have $1 million months, and it doesn't matter. Like, it's not about the money; it's about the process.
Yep.
And that's real. Like, when you get to that point, that's when you know, like, okay, you have something. Your work has paid off. And I think Mark Minervini helped us realize that.
I started off when I first started in the 80s. I made my first trade in 1983, and my goal as a trader, my long term, the big goal, like if I would say this would be successful, was to make $500 a week. That was my original goal. Yeah. I went from $500 a week to tens of millions, and that takes a mindset shift. because and
Tens
you
of
guys
millions a
are
week?
perfect to
This
speak
guy
to this,
capping?
because I know some
Doesn't
people,
make that
you should
much.
have this problem. You should have the problem where you start off with $10,000, it becomes 100, and then it becomes 1 million, and then it becomes 10 million. You should have the problem of saying, oh, it's a lot harder now to mentally deal with taking a $50,000 loss as opposed to a $500
Or
loss.
70
And if
million
you
net
get to that
worth.
point, believe me, you're going to hit a serious wall. It's and this is why a lot of people don't become really rich from trading. They can't elevate to that level. It's the same thing as if you're playing Little League baseball and then you play high school and then you go to the major league. It's a whole different story. It's a whole different game, right? So once you start moving up, so that mindset's got to grow, and that belief in yourself. It's really key. It's more important than the strategy. Strategy is the least important because there's lots of strategies that you're going to have to commit to something.
Yeah, I think I saw a few people ask that question where what's different between trading a $1,000 account, $10,000 account, $100,000 account, $1 million account, and what kind of adjustments you have to make, along the way. But I think you answered that. But was there anything else you wanted to add on that front, or?
Technically, nothing's different.
Yeah, I was gonna
Mentally,
say
everything's
nothing.
different. You
But
guys
it's
can
not
just speak
though,
to that.
man. Like that's not right. If you're getting mentally compromised because of that, you're just weak-minded, right? Literally no
Particular
fucking
because you're
difference.
closer to
The
that than me.
numbers
I
on
got-
the
that
screen
was-
have more combos.
That was like two, 3 decades ago for me to jump that hurdle. So you're, I think, closer to that. You've jumped that hurdle more recently.
Sure. And listen, yeah, there's definitely a mentality shift, but this is where I think, what Brandon talked about.
aside
where,
from the obvious
you know,
mechanical differences, right? Like having to deal with slippage and whatnot. When it comes to the mental shit, nah.
the process is the same. And I don't know if everybody's seen that, where yes, there are some mentality and a few shifts, but it's still the same process. Liquidity obviously changes. How aggressive you can be in certain situations, may change. But this is why I still like the idea, and I always encourage people: don't keep track of your losses in dollars. Do it in percentage. So if you lost 3%
Exactly.
on $1,000 position or $1 million position, it's still 3%. And it removes some of that emotional impact from things. But this is also where I think growing into these things is a much better way of doing it. Rather than just starting too large, if you will. And it's so ironic, when you read a lot of these success stories, most people started off with humble beginnings, at least in terms of, you read the Market Wizards and those types of things. I think there's a reason for that. You usually don't hear this. Oh, I came into the market with 100 million and ran into $1 billion. It's usually, no, I came into the market with very little, figured some things out, and then was able to really continue to grow. So I don't know, Brandon, you can add anything to that.
I mean, there's not much to add there. I can, this is where, for obviously for Marky and I, we had each other to talk to. So, when we did whatever, feel like as we grew in our drawdowns, you look at the dollars, even though the percentages were fine, it was like, okay, why does this feel worse than it is, right? And actually, a lot of the time, it was just because the trading period, it's not the loss of money. It's more or less the duration of being in a drawdown. Sometimes that is harder than the actual drawdown, the percentage decline itself, because you want to get out of it, you want to claw your way out of it. So again, this is where just putting things in perspective helps a lot.
And he just inadvertently uttered a Livermore observation or Livermore technique, and that is time is as important as price. Time wears people out in the market, and that's why consolidations and basis and shakeouts and all that stuff is really important to understand, because those are people that are sitting with the stock, and as time goes by and the stock drifts down, just think about it. You have a stock and you've owned it for a couple days, couple weeks, and it has a down day, and it's a big down day. You go, you check the news, you see what's going on. You don't usually panic right out of it, but if that stock just drifted off little by little every day after day after day after day for a month straight, it went down every day, you'd be worn out to death, as opposed to a real quick drop. And so that's what, and now it comes back up and it gives you some hope, but then it comes back down and crushes your hope again. And all these emotions get tied up in it. And that's what you're seeing in a chart. You're seeing the emotions on display, and you're seeing the supply and demand intersecting, and all that. When you learn how to read that properly, then you really know how to make heads or tails of it and find out, where the line of least resistance is. And that goes, again, back to Livermore, Line of Least Resistance. One of the best books to read that crystallized everything for me was Livermore's little book, How to Trade in Stocks. That's one of my favorite books of all time, because that was a pivotal moment. When I read that, I said, okay, these are timeless principles. This worked back then. It worked for Love. It worked for O'Neill. And this is amazing stuff here that I can count on, that I can build a career on. So I was willing to put the time in because I felt like it would pay me for a lifetime. And that's precisely what happened. Real quick too, if you want to get into specifics, I know we're going to end up running out of time here, but I do have a couple charts. You asked for a couple trade examples. We can show how this looks. And then talking about risk too. I think we talk about risk as far as stops are concerned, but risk is more than just your stop. And the way we look at risk is it's like there's 5 levels, and we're assessing a stock on, of course, the stop. The stop is where you're going to get out, and that's whether it's technical or you just decide I'm going to get out at $500 down or 5%. That depends, but there's liquidity. All right. As you get bigger, you have to get out when you can get out. Again, you should have that problem. But in the beginning, when you're buying 500 shares, you don't have that problem. But you do have the problem that if it's unliquid, it could fluctuate quite a bit. And then that gives you overnight risk, where now the stock may gap down against you and it rips through your stop. So that's your next risk. Your next risk is position sizing, right? If you have your whole entire account into one stock, well, then if the next day it gaps down 50%, you're down 50%. So that's another level of risk. And then we've got spread risk. We got spread, and that's for more shorter term. I'm taking a big position. I'm buying 50,000 shares, and the spread is a $2 spread. I'm not buying that. I'm not starting at $100,000 loss. I can tell you right now. So I take spread risk into consideration. So if it's General Motors, it's it's a Goodyear tire. It's got a penny spread. I'll go buy, and it's completely liquid. It trades 8 million shares a day. I'll buy 100,000 shares, no problem. But now it's got a 2-point spread and it trades 150,000 shares a day. I'm going to put very little money into that. So that I'm going to have to be a lot more careful. So there's risk on a bunch of different levels, and it's assessment of all that gives you your risk profile.
Yeah,
that's a real nutshell version, but just giving you sort of the basics.
Yeah, that's perfect. Let's actually jump to those examples now, Mark, if you want to bring that up.
Sure.
And I know a lot of people's questions had to do with position management, selling to strength, and there's some really good
It's just not
examples that
worth
we're
it,
gonna walk
right?
through
Like
here.
that, even dabbling in that kind of shit. When we're trading with sizes, it's not fucking worth it. You're just better off just being patient for something that's liquid to have a setup, right? Because like not only do you have to deal with like the slippage that he's talking about, but if it's a stock that's not liquid, it's probably not some like large cap, right? It's like a medium to low cap, which means like the overnight risk that he's talking about is like that much more exacerbated, right? Like, are you gonna see a fucking 20% gap down on like fucking Nvidia, like Google or something like that? Probably not. On some of these lower caps, it could be like fucking some massive gap down. You just get fucking wrecked.
And kind of everybody will chime in and provide their perspective on things, I think.
So this is I tweeted this pretty much along the way as we did this trade. This is the Micron trade, and a couple things that are interesting about this. And on this chart, we've got some proprietary gauges that we use. This is what I call the Fab 4 panel. And we don't have the time to get into it right now, but these are the charts that we use on our platform. You'll see this is a little uncharacteristic for me. This is sort of a bottom fishing pivot where you come back near the 50-day and you just form that very short-term little pivot. I very seldom do this. This is one Micron. I like what AI is doing for this industry group. I think they're elongating their cycle, their earning cycle. This is a growth cyclical group that is turning more to the growth side now because of AI. AI is obviously moving and pushing all types of it's like a big river pushing out all these little streams all over the place. So AI is very influential in a lot of areas. So we got aggressive on it right off the lows, but it didn't go right away, and it started turning down, and so we immediately started reducing it, and we reduced it on the second day. It turned down, and then after I got that little bounce back, I actually thought we were going to get a little bounce, and that was sort of like the bounce before the dead cat bounce before it was going to collapse, and I had it wrong, so I reduced again, but kept a little position. But then it held up, and it moved right up, and then it formed what I call a cheat area. This is the cheat, which is just basically a handle or a pivot within the middle portion of the base. If you're in the lower third, I call it a low cheat. If in the middle, I call it a cheat, and the top would be a typical O'Neill handle, which O'Neill got the handle from Giller, who had the saucer and platform, and O'Neill changed it to the cup and handle. I took the cup and handle, started realizing, you know what? There's lower points in the base that you can buy this. So I had a friend of mine, we used to trade, and we used to call each other throughout the day and talk about our trades. And he'd say, hey, did you buy, did you see XYZ? And I said, hey, I already bought it. I cheated. And he said, what do you mean? I bought it, a week ago. It was a lower pivot. And that's how the cheat started. And we realized that when the cup completed, before the handle, you would get what we call the cup completion cheat. So then I realized, and that was, we would have to have the stock run up the right side a bit, and it would form in the lower, I'm sorry, the middle portion. But then years later, it was like maybe 10 years later, 15 years later, I started recognizing and going, you know what? There's a low cheap. There's even a, wait, there's more, like on TV, you know, there's even another spot. But the thing is that you're going into, the lower you buy, the more you're going into overhead supply on the left side. So as I developed as a trader, I started getting better at recognizing overhead and being able to read it and be able to effectively buy off the lows a little bit better. And that just takes, I call it an expert buy. As you go down in the base, you need to be better. Your skill needs to be better because you have to be able to assess overhead supply to the left. When you're on the right side and you're up by the old highs and you're breaking to new high, there is no overhead supply, or there's very little. So you don't have to be as skilled. So with this one, this is what we would call an expert buy coming off the lows. And then we quickly lightened up. But as it's set up, now it improves. And very often, whether we're putting progressive exposure and building into a position or just buying it for the first time, the best buy is at a higher price than the previous buy. And you can see here, we're buying higher here, but I get even more aggressive. So here I go full 100%, not 100% invested the whole account, but a full position. We went to the full 100% position, went back. Then it was able to mark itself up and tighten up even more and really form a nice large base. And at that point, that's when we went overweight. Now we took a really big position. Now with that overweight, a lot of times what I'll do, and I'm just walking you through this so you can see sort of how, you know, we trade, I trade, they trade. A lot of times what we do is if we're overweight and we're fortunate to get a quick move, we'll take the overweight off because now we still got a full position. And now maybe, you know, we're up, let's just call it 10%, and our stop is 8 or 10%. Well, now we have a full position and we fully finance all the risk. Holy cow, what a position to be in. I have my whole position and I have zero risk. That's what we call asymmetric leverage. So we're always trying to get to a point, angle ourselves to have asymmetric leverage where the upside far outweighs the downside to a point where
that's a nice thing about adding to trades when they're running, right? We were talking about this the other day, but like the idea of like adding once it starts going, you can walk up your average price however you want, right? But keep it in a spot where you can always get out break even or like even tiny profit depending on how you want to do your stop. So like in cases like this, you can like build some pretty huge positions doing this kind of shit at zero risk.
Scenario where we don't have any risk anymore. And that's really the key. That's the key to making big returns, having low drawdowns, is to always move towards asymmetric leverage. This is a term that I learned from my very good friend and one of my mentors, Larry Height, who those of you who know me and came last year to our gala, met Larry Height. Well, you know what I know. He's one of the most beautiful people you'll ever meet in your life. He's awesome. And he's in his 80s, and he calls me up and he goes, I just love to learn. I just love to talk to you and learn. And he's still learning, and we learn from each other. But we always talk about asymmetric leverage, creating this asymmetric leverage. So then as you rally here, and again, the stock gets extended from a swing trading standpoint, you know, I very often will just sell the stock, take a quick profit, whether it's 15, 20, 25, sometimes, you know, 40, 50% or more, and sell right into strength and get out when the getting's good. This particular time happened to be the day before 17% drawdown, so it was a perfect sale, but it could have very easily been a horrible sale. I mean, if you look at NVIDIA, I don't have the chart. Well, actually, I could pull up a chart. Hold on, let me see. Let's pull up. So 2 things about NVIDIA. Let me say one thing. First of all, we heard
curious what their sell rules are, right? Didn't really expand on that. And typically people have something a bit more like systematic. I mean, I'm assuming he has some more like systematic methodology than we just said, but he didn't really go into it.
Don't work anymore, and we hear this from time to time. David Ryan and I commented about this many times, where you get periods of times where breakouts don't work, just like anything. Nothing. If this system, you know, and what I do work every single day perpetually, I'd be a trillionaire. You know, so yes, it takes work, it takes faith to go through the tough times, and you got to give everybody gets their chance. You know, like your breakouts will work for some cycles, and then the value guys get their chance, but you got to stick with it because you're not going to be good at switching from one to the next to the next to the next. So. But to say breakouts don't work is to ignore.
That's not true though, right? It's not really true. Like realistically, you can like dedicate time to like mastering like, something in a playbook, and then you have that in perpetuity going forwards. And then you can just focus on the next one, focus on the next one. And before you know it, you have strategies for like every market environment in both directions.
You know, okay, let's say we look at a 10-year period. Even if they didn't work for 10 years.
Yo, you're still online? Oops. Yeah. Probably just gonna finish this video and then call it a night. The usual thing, right? Usually stream for like 4 hours or so. So kind of right along that path currently. Like what are we at right now? 3.5 or so. Kind of chugging along while we're watching this stuff in the background. Speaking of which, we just got 4-hour candle closes. Interesting.
They work for 120. So it's to ignore history. And if you look at that 120 years, you'll see that there's stretches where, yes, it's very challenging to play breakouts. But here's the great news. When they don't work for a while, I love it. Mark's smiling because he feels the same way. He knows. He learned what I know, is that when they don't work, it's perfect because you weed out everyone and then they work like a charm. The longer they don't work, the more I am adding money to my account and getting ready for the chance of a lifetime where I'm going to make a fortune in a very, and Mark and Brandon have years where they're up 350%. I had a year where I was up 412%. Up in the U.S. Investing Championship in 2021, I was up almost 350%. So you have those years every now and then. You only need a few of those, and as long as you keep the downside in check, you make a lot of money. So, but looking at NVIDIA, we bought NVIDIA right here, right on this day right here, just as it started to come out. But you couldn't buy it any.
I mean, a little bit of a dangerous statement. Like, yes, highly probable the market will bounce back soon at some point. But it could be like a multi-year drawdown, right? And if you're trying to like take a breakout trade every month in this like prolonged downtrend, you could like do some pretty serious damage to your equity curve. Not like thoughtful about what you're doing.
It was textbook. I'm sure lots of people bought it there, but I also just sold it right into the first rally. But I also bought it back here. I'll show you another time. And this just speaks to 2 points. One, breakouts. This is one of the biggest companies in the world, and it should be. These are the companies that the breakouts shouldn't work because they're so efficiently priced. But look at this breakout here. I bought it right here too, right on this day. Bought it. And I also sold it into strength very quickly, and it turned out to be, obviously way too early. But that's.
I'm surprised he's so aggressive with his profit taking, right? Like at least leave like a partial running kind of thing. Seems like he's like very binary in that regard.
Day one. So, and a lot of times what I'll do is I'll sell into strength and it'll rebase. I'll buy it again. I'll sell into strength. And when it's all said and done, I traded Yahoo in 1997 off the IPO like 7 times. I ended up making, I don't even remember what it was, 400 or 500% on it. And I traded the first time for a double, the next time 60%, the next time 30, the next time 20, next time 25. When it was all said and done, I made hundreds and hundreds of percent on a stock that went up 8,000%. And over the years, I bought Amazon right off the IPO base. I bought Yahoo off the IPO base. I bought Cisco off the IPO base. People go, well, if you held that, you would have made 100,000%. I've made over 600,000% in my career. If you compound everything, I'm up about over 600,000% over my. It's actually over about 30 years or so. I think it comes out to 35 or 40% a year compound. Funny thing is, Mark, when we were just preparing for this, I looked at your return, 5,000 plus. You guys are up, I think, about the same that I am up career. I think your return comes out to about 35% a year, something like that. So I've had those triple digit runs where, in the 90s, I had a run where I was up 220% average for 5 years. But over the long term, I'm up in the neighborhood of just under 40%. But anyway, I want to show you that. Let's go on.
Just to add a quick comment to the NVIDIA though, Mark, where Mark's talking about, selling too early. And to my comment before, listen, if I make multiple of my risk and the stock goes higher, that's fine. I'm in the business to make money. And if you look at the way Mark is handling these, the way we're handling, and even this most recent example with NVIDIA, it's all alpha. He's grabbing that quick alpha. And a lot of people don't understand this concept. They want to just be in NVIDIA forever because it's the stock that's always moving. But we're looking.
And that's another way to skin the cat.
That is another way to skin the cat, but it's a much more volatile way to skin the cat. You're skinning a live cat, if you will, or something, where we're sitting here trying to grab, that quick alpha move. Before letting, being very precise on our timing. And that's what we're trying to continue to turn over and not allowing that stock then, to take you for a while to ride as it gets extended. The other point I would make from the Micron is that every one of those buys,
seems like a bit of copium, right? Seems like a bit of copium. I think these people are reasonable enough to know that they could like systemize that a bit better.
At them in a vacuum stands on their own. And that's one thing we're always talking about. Is each one of these buys. So even if you didn't own the name, and that first buy was the most professional buy for sure. But the second and third buy, if you didn't own the name, that's where I'd be wanting to buy it. It's just sort of.
It's a great point. What Mark is saying is that we're not adding to it just simply because we'd be buying it at that spot anyway. So that's a really important point, that every buy stands on its own, and you're not just haphazardly. People think that when they listen to comments like O'Neill makes, where you say, you pyramid into the stock, that you just buy it just for the heck of it because it's up 5%. No, it still has to meet the same criteria, meet the same hurdle. Now, these techniques will work. And this is something that Mark pointed out a long time. He said, why aren't we trading, crypto, and all these cryptos? They're like responding perfectly to your tactics. And then, of course, recently we were trading IBIT, which is Bitcoin, of course. But there's lots of cryptos. But this chart shows a couple things on how we trade and also how we handle the risk side and getting stopped out. But one point to make is opportunity cost. So yes, you could own a Amazon and hold it for I have a friend that's held Amazon for like 15 years. He's made a fortune in it from a very small investment. But how many people are fortunate enough to do that? And how many people would hold through a 50% drawdown or 90% pullback to get to that, right? So I always say somebody wins lotto every week, but every week the name's different, right? So I started trading because I wanted to get rich and I wanted to have the freedom of having a job that I had the freedom and I didn't go work for somebody. And I needed consistency. I needed to make money consistently for two reasons. One, because I needed to make money, and two, to grow your wealth, you need to compound. So I realized that, you know what, stocks go up 10, 15, 20%. Every stock goes up 10, 15, 20%, but only a handful go up 80,000%. And it takes a long time. So I did the math. I realized, and we have something, the Master Trader Program, it's relatively new. I've been only talking about it in the last few years. It's called Mind-Blowing Math. And once you see that, it changes everything. Your entire, I've had hundreds and hundreds and hundreds of people.
I don't know. It's like, the thing is, there's no right or wrong per se, right? Like in that situation, like the Nvidia example of like taking profit too early. In the grand scheme of things, like, yes, you are securing profits. You can continually compound your account like year over year. But I think there's like a pretty like fair argument to be made that it's best to be as efficient as possible, right? That's the goal, to be as efficient as possible. Especially in a world where we are entering this like age of like high beta tech stocks just having crazy moves. For you to just like cut off your entire trade, to cut the legs up from under your trade when it hits like 2R, just because that's what you do, probably not optimal efficiency. We'll say that.
Will send me
regardless of the compounding long term or not.
Emails and just go, my God, that is just blew my mind.
The guy in the last video had a way better way of taking profit compared to these guys trading the same system essentially.
And you said it was mind-blowing. It was mind-blowing, and it changed my whole perspective. And so here's a perfect example, you know, and this is off of the what we would call the cheat, the low cheat right here. It's a perfect example. And this was already an existing security, obviously, but this is where they put the ETF and it formed what looks like an IPO. But you've got this little low cheat. We bought it right here, right? Took a full-size big position right into strength, reduced it. Bitcoin could be volatile. So I said, you know what? Let's take some off the table here. Now we're free rolling, right? But then it's set up, and like I said, you could sometimes get, very often your best buy is at a higher price. So it sets up, it tightens up real nice here and holds its gains, sets up a perfect, if you look at it, it's a perfect coupled handle, right? VCP, what I call it. Boom, comes out here, we're back in. We move right back up and we ratchet up again. And I do the process all over again. I reduce it into the strength and I cover my risk once again. And now I've already backlogged a profit, and now I backlogged 2 profits. So now I'm really free rolling. Moves up a little more, I reduce, and then it had this break. And I felt like, oh shit, I should have sold it into the strength and just closed it. But I got what I call the gift. When you get a big break and you get that dead cat bounce, especially if it comes back 2/3 or so, I usually just get out right then and there. So I punted it on that next day. And then it went up a couple more days, rolled over. Now we tried to get back in it over here as it came off the lows here on a little pullback buy. And we were thinking this will probably not take off right from here. It'll probably come up and tighten up and then we'll add to it. And it did. And it was looking perfect, but then it turned tail and we put a break-even stop. We got out. Then we kept watching it. It went through this, it undercut these lows, perfect, tightened up. Now I was like, okay, this is it. This is where it's really going to take off. We got a nice big base now and really getting, you know, aggressive on it, and started buying it right here again. And then we just put a super tight stop, got out on it right away, got stopped out of it. And I thought I might have blown it because right after that, it took off and up a few days. And Mark, you know, we had a conversation. He's like, I think we might have got out too quick here. But since then, it's rolled over, and now, you know, we're out of it. But that's the way, you know, we're trading around positions. We're adding back, we're reducing, we're using strength to sell into, getting out when the getting's good, and not walking away from a stock. You know, even there's sometimes where I'm buying the stock on the 5th base. I was buying it on the 1st base. I sold it, but 2nd base, I bought it 5-6 times, buying it as it comes out of base after base after base. And then when you string it all together, you got this really nice big return on that stock, but it's from a number of trades.
And jumping with the question, because you mentioned free rolling a trade, and just to clarify for people who may not be familiar with that, when you say reduce, if you could go back to that chart just quick, sorry. No worries.
He puts on his like fucking core show.
The Bitcoin.
Yeah, this one, yeah. When you say reduce and that label, when you're selling for that first push up, you're also moving your stop up to break even, and that's what's free rolling the trade. Is that correct? And is there anything you want to add there?
All right, so it's a great question. And Mark, if you guys have anything to add, I know usually we're talking the same language, but look, there's a few ways that you can free roll. One is you buy the stock, it moves up, and now you move your stop to break even. Obviously, if it goes down, you break even, right? But the problem with that is that now you choke the trade. You cinch up on the trade. You do have a full position. You have your whole position still, right? But now you're not giving it any room. So a compromise is to, if that stock goes up X percentage, and the more it goes up, the less you have to sell to do this. If it goes up an equal amount to your stop, let's say your stop's 8%. If it goes up an equal amount, it goes up 8%. If you sell half, you now can let it go down at 8%. And you're still break even. Now, you only have half the trade, but you have two things to your advantage. One, you have unlimited upside on that half position, and you have zero downside. All right. So, and you've been able to give it more room now. You give it the room. So you've got those two things going for you. Now, you could do the same thing mathematically and say, well, I have 100% upside and no downside, and I have double the position. Right. But now you might be knocked out of it and you have no position. So me, I'd rather have half position and give it more room most of the time. Especially if it's the beginning of
the way I do it is it depends on the entry. If my entry is like not ideal, and then I'm like, what would be like an example here? What would be a good example? Okay, something like this. Like, suppose for whatever reason I was getting into a long here. My entry was like here somewhere, and then the trade starts to go, and like I have like a fib drawn, like as it's going up, and like my entry's like right at the golden pocket. So like, yeah, I'm definitely looking to like shave some so I can like be like more flexible with the stop loss. But if I got like an entry right at the fucking low, my stop loss break even's like at the bottom of the wick. Obviously, I'm moving that bitch. Of course, I'm moving that bitch.
Now, if I'm on a monster, even a half position could be huge. Later stage, I'm not even playing that game. I'm just selling right into strength and just getting out when the getting's good. And I'm not thinking hold for a big move when I'm fifth stage base and I've been in a bull market for 3 years. Now I switch over to more to a trader.
That's
so again,
true. That's true as well. Context really matters in terms of like the higher time frame, how much you want to be like willing to leave running.
There's nuances there, and there is some art to it, but a lot of it's science too.
And one more question I had about this trade is, before your June or late May trade there where you were stopped out, there was kind of a potential low cheat area there in early May where it pushes off the lows. Was that not quite tight enough for you? There was also a gap out of that area. How would you kind of analyze that part of the chart?
So we were looking at it there, and that's exactly right. And I know you have a good eye for this. But you see it gapped. It didn't really tighten up, and then it came out in the gap. And we're not going to chase the gap. So you have the overhead too. You've got more overhead when you're going low cheat. You've got a lot of overhead. So if you're really close to the overhead, now you've got to measure how much overhead to the left and how deep you are. So let's just say this was a 50% decline. Okay, this overhead is major. I'm not touching that. Let's say this is a 15% decline. Now this is very viable because there's very little overhead. Still, even with that scenario, probably, unless things are going great and everything's just ripping, we probably still would take a partial position and then sort of build into it, because most likely it's going to run up, it's going to go into this overhead, and it's going to pause just like it did. And this is where you can see how it's developing. Is it doing what it should do? This is absolutely perfect. Up to this point, it's perfect. And even this pullback, nothing wrong. Then here, that's abnormal. That's not acting right. And as it comes below here, now it's really not acting right. So now it's got to go through a whole reset. It's just not, when I say not acting right, meaning that the supply is coming to market. We have not gone through this supply. The supply, and this is a concept that I originally heard O'Neill say. He said, you have to find out when supply stops coming to market. And then I termed it, I want to be the last week holder. We talked about week holders. I want to be the last week holder. You heard Mark talk about that earlier. That means that the supply, you're in an uptrend. There's big institutions that are buying this stock. There's a lot of small guys, right, that are trading this, that they're weak holders. They're gonna get knocked out on a little pullback. They got their stop real tight. They're doing all these techniques that we're talking about. Those are weak holders. But the big guys, the guys that are really moving the stock, that can sustainably move the stock, they're forming the cup. They're buying down here. They're supporting the stock. So when finally you weed out all these little guys, well, there's nothing left. There's no supply. And now you have big demand. So if you have big demand and low supply,
the change of hands, right? For anyone that remembers this whole sequence, like if you were looking at the data, you knew exactly what was fucking going on here, right? Like every time we got to like range highs this whole fucking time, Just spot whales were just dumping, right? Dumping hardcore as like it's the perps are just ramping up, and every single time it was just like a cascade right back down. And then the whales that wanted to keep accumulating were just loading up at the lows again, and the ones that were trying to offload massive positions from like the actual lows continue to offload. Because they have to, right? Like the video we have on YouTube, like one of the first videos, like we had like a whole discussion on this. Like when you have like a shit ton of Bitcoin, you have to sell like early into the cycle. You have to start selling partials here. Then you got to do it every single consolidation. Like they're selling out. Because when everyone goes to sell like this, you're not going to get value for your supply, right? It's going to nuke down.
Boom, explosion. That's why it's not a coincidence that when you see these charts and you see these tight areas on the right side, that the stock catapults out of there. People think, well, that's because of the chart. Everybody sees it. No, absolutely not. It's just the opposite. It's not the cause, it's the effect. If everybody saw it, it wouldn't work. That's precisely would be the opposite. So
when the sellers are done selling,
how is the supply coming to market? This took me a good decade to even understand, let alone to apply. And even to this day, Bob Weissman, who's worked for me for 21 years, it took him a decade. 10 years later, he goes, all right, I think I got it. It's like 10 years later, he goes, I think I got what you're talking about. He's asked me every day, what does it really mean? Then he said he thought he would get the point. And then he'd tell me, and I said, no, that's not right. That's not what it means. And we had to go over it and go over it and go over it and go over charts. And once you understand that, then you really understand what's going on here, and it can make sense to you.
I'll just add to, and you look at those first two little pivots. They're tight in price, and the volume is contracting, and especially that second one. Well, that volume comes in, price only has one place to go. And that demand that Mark is talking about, you're seeing it right there. It's just a textbook example.
Yeah, and again, they say, well, why aren't you the richest man in the world? You just do that. Well, because there's discipline involved. It doesn't work all the time. Matter of fact, it only works about half the time in a good market. In a bad market, this will only work about 20-30% of the time. All right, but that's part of the strategy. Part of the strategy is managing the times where things don't work well. It's like, do you go up to bat and get a base hit every time? No. Do you hit a home run every time? No. Good baseball players bat 300. That's good, right? They strike out 7 out of 10 times. So then, how do you ever win a game? You know, it's the same thing. You've got to manage it. You've got to manage it and take advantage of when it does work. With trading, you have the position sizing. You know, you can step on the gas when it's working. You could ride the brake. And that's the art part. That's part science, but also takes a lot of experience to get it to where you really understand when you should be really gassing it and making those returns and then laying off and letting all the noise go by.
And that ties in really nicely to the concept that we know everybody wants to hear about, progressive exposure. Mark, if you wouldn't mind going back to the MU trade, because this, I believe, would have been one of your first trades, that first buy coming out of the correction that we were in. Could you kind of talk about your mindset when you're coming back into the market from 100% cash? We've been through a correction. What are you trying to do with your first few positions? How are you judging the traction of those positions to determine if you're going to increase size, try more trades? You know, all of that I think would be really excellent.
Okay, so I'll start off with, I'm going to give you some guidelines on progressive exposure, and then also I'll let Mark and Brandon also come in on that, because they're really great at explaining that and deploying it. So you have to think of progressive exposure on a couple different levels. It's not just position sizing. It's exposure. It's total exposure. So for instance, 25%. You come into the market with 20, whether it's, let's say it's 5 stocks at 5% each, or 1 stock at 25%. Both times you're 25% invested, right? One time theoretically you have more risk because you have 1 stock, so you have a single stock risk. Okay, so now there's position sizing. There's that individual risk. So to where you progressively expose, maybe I start off with 5% positions, but now as things get better, I move to 10, 15, and I move the position sizing up. And then there's your number of stocks, which by default is going to happen. But actually, you would think, as you're getting more exposed, you have more stocks. No, actually, a lot of times it's just the opposite, where for me, I start off with some lighter positions, some smaller positions, and then I start concentrating. As things get going well, now I'm taking bigger positions, so I actually have less actual positions. So those are like and I don't know, Mark, Brandon, did I leave anything out with progressive exposure?
I'm not sure what he means by that. I think he's like saying, because a lot of people will do when they trade this style of trading, like they'll be like, okay, let's say there's like 3 to 5 breakout setups forming at the same time, and you're looking to like take these, and they're not that high win rate as he was saying, because like you do have to like essentially bet that the breakout follows through or you're gonna get stopped. from what I think that what he's saying is that like he takes like a small position in like the setups, or at least this is what other people do, and I think that's what he's referring to. Like they'll take a small position in each of the potential breakouts, and then the one that runs, like they cut the losers and then consolidate that position into the one winner. Not sure if that's exactly what he's referencing. I think so, but it was a little bit ambiguous because like, I don't know if he's referencing like the total account size when he's talking about percentages or not. I think he is. That makes sense. Yeah. I'm gonna rewind it just to make sure.
Things get for me as you're getting more of stocks, which by default is going to happen. But actually, you would think as you're getting more exposed, you have more stocks. No, actually, a lot of times it's just the opposite. Where for me, I start off with some lighter positions, some smaller positions, and then I start concentrating. As things get going well, now I'm taking bigger positions, so I actually have less actual positions. So those are like your, and I don't know, Mark, Brandon, did I leave anything out with progressive exposure?
A question. I'll jump in with a question. Sorry, and Brandon, feel free to elaborate on this. I think a common question people have
is that like a defined term? What does that mean exactly? Progressive. I mean, I assume it's like a changing exposure over time, but is there like a nice definition of this? Mark. Bruh. Minervini. Oh, it's just a way of like building a position essentially with what it seems like. Like sizing into the trade essentially.
Are you selling those first smaller positions and then going back in with a bigger position on a new stock, or are you just adding to those first initial positions? I think that's a good clarification question there.
Mark, you want to take that as far as adding to a position and talking about
I think the Micron
standing on its own 2 feet?
Yeah, the Micron example is a perfect one. In the same way that you want to add to a position as it's working is the same way you want to step up exposure in your overall portfolio. And to the specific question, Richard, though, do you have to take profits in order to buy another name? You can, but you don't have to. And we often don't. We'll lean on those gains in the form of cushion to say, okay, we buy a name, it starts to move. We're going to lean on that a bit to take some more exposure. And that's the whole concept of feedback that we were talking about before. When I was saying, if you think of your own trading as the most important of echo chambers, if you will, that's what you want to stay in sync with. One of the biggest mistakes people make is they go, well, and the question I get, well, what do you own and how invested are you? Why is that as important as what do you own and how's your trading going? Because what's going to drive my trading and my exposure is how the positions I'm in are doing. It's not, and as Mark has often said, if you're 50% invested and it's going horrible, it doesn't make any sense to double up. That's how you get yourself into a disaster. And the whole, start with the end in mind. The whole goal of progressive exposure is to be trading your largest when things are really humming, when they're really working. Well, the only way you can do that is to stay in sync with how things are going. So
the goal to do really well in the market is to get to whatever strategy you're using is to develop a method or a mechanism that you are trading your largest when you're trading your best and your smallest when you're trading your worst. That is a huge, enormous statement that everybody should listen to over and over and over, write it on the wall and live it every day as a goal, because that's how you make the big money in the good markets and you keep it. All right. So now there's a couple things to talk about here. One is, and these are the questions. Mark said we're going to lean on those.
There's been multiple people that say this, and I don't necessarily agree, honestly. Like, one, like you have the ability to see what's going on in the market, right? It's very clear right now we're not in some like fucking trending bullish environment, right? Secondly, you can gauge the quality of your setup given the context of what's happening. So like, just because I had a few losing trades previously does not mean I should be sizing down in like a potential golden opportunity when it appears, right? But I think that these like statements are really apply to like specifically like highly systematic traders that are trading like one style, right? Because in that case, like, yeah, like let's say these people, for example, they're trading like consolidation breakouts in a high time frame. Well, if the market's in some like prolonged downtrend or beginning to enter like a prolonged downtrend, and you keep trying that, it's not going to work. So in that case, okay, fine, valid advice, but I don't think that's like really great generalized advice.
Profits. Well, now there's open profits, right? And there's closed profits. Those are two completely different things. If you close a trade, well, that risk is out of the portfolio. Now you add a new trade, right? So let's equate it to the crap table, right? You've got a bet out there and you have a bet on the 6 and you hit a 6, you make some money, it's still out there. So you say, you know what, I'm doing pretty good. I'll take the 8 now. And I'm going to buy the 4 and the 10. Now you've got more exposure, right? So now if they roll a 7, you lose on all those bets, right? So you have a much bigger drawdown. So now you didn't close those out yet. If you close them all out and then you put one bet, well, now you're financing that new risk. So you got to think closed versus open. If they're open, well, you got to watch those carefully because those open trades can move at the same time as those new trades. But if it's closed, you've got a little more leverage, a little more, you have profit in the tank. It's going to be a combination of that. It's never going to be one or the other for very long. And at some point, you've got to make a decision whether I've got the traction that I feel comfortable to push harder. And that's where we got to look at your worst case scenario. We're always talking about our worst case scenario. What is the worst case scenario? If I get knocked out of everything here, what am I down? And that has to be managed. All this has to be managed. So one thing is what I call the 2-for-1 rule. So you're in a stock, whether it's doing good or bad. Let's just say it's doing bad. It's not doing very good, but it hasn't hit your stop yet. And you got another stock that's setting up, or you have even a couple stocks that are not performing too well. So you want to participate, but you don't want to lever up, because why would you add money? As Mark said, you're going to add money when things aren't working. So you sell a half of the 2 positions and you buy a full position in the new stock. So now the stock that's looking the best at the time is getting the most money. The stocks that aren't doing too well are getting reduced, and you haven't raised your exposure at all. So that's one technique. There's lots of different techniques that we use. They're just permutations. They're permutations of that concept.
Well, and I'll just add, progressive exposure is, one of these topics, like, we're going to talk about this forever, right? And Mark and myself are continuing to try to get better at this. And I think a lot of people get hung up on, well, I got more exposure on, I thought I was being progressive, and, I did it wrong. I got stopped out. It's like, well, that happens. That's what's going to happen. Right. And I think what Mark is saying too, as far as what is the risk factor that you are willing to take? And as for Mark and myself, as we're getting the feedback, and this has taken a long time to get good at this, as we get the feedback, we are willing to take that risk number up. So if we're getting the feedback we want to see, we will increase the amount of risk we were willing to take. And I think a lot of people get hung up on that. And we have to be okay with that if we do up the risk and we get our hand slapped when we were wrong, that we're going to take that loss. And so, I think a lot of people think like, oh, progressive exposure, I should just do it when it's only working. It's like, well, it doesn't work every time.
Yeah. And perfect. What you said was, people get hung up on a specific answer. They want to know if it goes to, I take 25% and this stock goes up 10%, I add X percentage. It doesn't really work that way, because it's just like poker. It's a texture of the game. You got to feel the texture of the game. You're playing poker and there's a guy on there that's a really good player. There's a couple of fish on the table and you see how things are going, how aggressive the betting is, and you feel that, and there's an art to it. And there's the science of the pot odds and the actual percentage of the hand. You have to know that. That's the basics. But then there's that feel. There's the bluffing factor. There's the factor of your stack size versus, there's all these things. It's the same thing with trading. That's why it's beautiful. This is why it's a beautiful business. And the reason why, I want to point this out, the reason why there's this awesome opportunity is because it can't all be figured out into a spreadsheet. People want to put this into a spreadsheet, want to put it into a program. They think AI is going to put everybody out of business. It's nonsense, absolutely ridiculous. Okay, this is an art. This is no different than you learning how to be a great baseball player. You can learn all about the physics and be in the right angle and in the box and have the bat in the right spot. But the bottom line is you got to have experience. You have to have experience. There's an art to it as well.
I don't know about
if it
that.
could all be put into a
Do not know
spreadsheet
about
and everything
that.
could be figured out and some algorithm could just run it, guess what? No return. The market will be 100% efficient and random, and the random walk hypothesis would be right, but it's wrong. It's wrong.
Well, that's not
Guys
true,
like myself,
right? Like
Brandon,
the market's incredibly like that's what do you think quant funds are doing? Like they're exploiting inefficiencies, like mathematical inefficiencies.
Mark, David Ryan, Jesse Livermore, Nicholas Darvis, you name it. David Ryan, it couldn't exist. William O'Neill, we couldn't exist. And it goes on every generation all the way back to the 1800s, that there's people that outperform the market. And the real thing is, it's not like Lotto. The names don't change. Stanley Druckenmiller's been doing it for 10 decades and decades and decades. I used to advise the Soros Group. These guys, I had a young guy that was that I advised back in the 1990s. He went on to become a multi-billionaire. Okay. So the names don't change. Matter of fact, they seem to get, with the guys that are good at this, they have long careers.
Excellent. Yeah, I think that provides a lot of clarity in terms of progressive exposure. Hopefully, that answered a lot of your guys' questions. One last question on.
It's going to raise questions too, Rich.
Yeah, it's true. It's true.
We're definitely doing a lot of thought-provoking things here that are going to raise a lot of questions.
Yeah, but there's resources for that, which is fantastic.
That's right.
One last chart question.
That's why our Master Trader program is 5 days now. It started off 1 day. It just keeps getting longer and longer and longer. But go ahead. I'm sorry.
Yeah, no worries. Could you go back to the IBIT chart? Because I want to ask about, because I know people are wondering this, for the reduced labels, how much are you typically reducing into strength? Is it always 50%? I know you talk about that in your books, or does it depend on the situation?
So I can speak from me, generally speaking, and generally what we put on the platform, and Mark and Brandon, you guys can speak from your own personal trading, but I tend to operate in like quarter positions and half positions. It's just the way I've done it. I've tried it different ways, and it doesn't seem to make a whole lot of difference if I do thirds, halves, and quarters. But certainly I'm not taking off like 5%, 10%. That's more of a mutual fund type strategy. Usually what happens is the stock moves up. I'm taking off enough to either cushion all my risk or cushion half my risk. So, and again, if the stock goes up 20% and you got an 8% stop, you could sell a lot less than half to cushion the entire position, right? So depending on how much it goes up, depends how much I'm going to sell versus where my stop is. So if I want to finance risk. So I'm generally in quarter position, half positions, and full positions, and overweights are usually, 1.25, 1.5, 2 times. But when I go overweight, I usually go heavy. I usually go pretty heavy on an overweight. Like I'll double my position. If I've got, let's just say it's a 20% and I go to a 40% position, I'm probably not going to hold overnight, or at least I'm going to take some off. If I'm just looking for that thing to get some gas and give me a little return, take a little off, finance a little, that'll finance me overnight. And if I get a little more, take a little more off, and that'll finance my risk for the whole full position. So always looking.
Man, it's going to be so nice trading this shit in the future when like this overnight crap goes away. Everything's like tokenized to the on-chain 24/7 trading. Don't have to worry about like this like gapping fucking nonsense in the traditional markets anymore.
My risk, finance my risk. I'm trying to get into, and this is really.
Like, so what an inconvenience, right? Like it's just, who wants to have to deal with that shit? Like what a shitty game mechanic. Like, honestly, right? It's like outdated garbage. Like sure, not everyone's gonna enjoy the fact that the markets are going 24/7. At the same time, you don't have to deal with that crap.
This has been my whole life's work, and Paul Tudor Jones is really one of the main people responsible for me being so stickler on my risk. But Larry Hite really took it like to another level, not with giving me any techniques, but just with his absolute discipline and passion for improving that worst case scenario and creating asymmetric leverage. We've had so many discussions. I'm so fortunate to be.
I don't know about that. Like, yeah, I guess so, but like, if I have to pick between a trade-off of having to have an alert on my chart that might wake me up in the middle of the night versus coming to the market Monday morning or like any morning and see that like some position I'm in, or even like a long-term spot hold is just gapped down like 25%. We're not even talking about like full market black swans, right? Like imagine there's something happens, like, I don't know. Who the fuck knows? China nukes like fucking Russia or some shit. Like just some random story. Like a massive war breaks out. And the entire market gaps down like 30% on open, and your entire portfolio net worth is just disintegrated. You can do nothing about it. I'd rather not deal with that.
Friends with these market wizards who I idolized when I was your age, and now Stan Weinstein's a good friend of mine. Larry Hite's a great friend of mine. I talk to him all the time. We talk regularly, and it's just wonderful because I learn. I learn and I get these great insights from guys that've been doing it even 20, 30 years longer than me, and I've been doing it for 40.
Yeah, excellent. Mark, Richie, or Brandon, did you have anything to add with regards to selling into strength? How much you guys typically do it, or also the concept of going a little bit overweight in a position as well?
The ideal way to do this, at least in my mind, it's like a little discretionary, right? If you were to like read like how overheated it is, how key of a level you're running into, what the data is looking like. But for most people, you're probably gonna be better off just having some systematic way of like, okay, 3R, let me take off 50%, etc. I don't think you could do anything about it if market was 24/7 if there was a nuke. Well, if you have like a trailing stop on your positions, like you don't need to be trailing it so tightly that like you'll get accidentally stopped out of a trade. but you also can have it like not so far back that if the markets do start to tank on the news, you just give back the whole position. Like you can cut every single position at like a 10% loss. Like from where it's currently at, kind of thing. Like obviously the number is like arbitrary, you can kind of pick for yourself. But like you can cut the losses before you go take the full brunt of the news effect if they were running 24/7. Never did stop losses before. Yeah, pretty powerful tool. But you have to be careful though. You have to be careful with it. Like you need to be mindful how you're using them on those kind of positions. So that you don't want to just get stopped out needlessly for no reason either, right?
Not much differently, honestly, we sort of cut from the same cloth, but yeah, as a general rule, sort of thirds or halves, if it's a position we want to play for a bigger move, we generally don't sell more than half. And then, as Mark was saying, the most important thing, in terms of even going overweight or getting more aggressively long, like he said, the more concentrated you are, the more overnight risk you're carrying. So you have to be thinking in terms of like, how do you, manage that worst case scenario? What are you comfortable with holding overnight? So if we're going to get really aggressive in one name, we're going to be really cognizant of that. And then, be more likely to reduce a little bit faster because we're not going to carry, for us, anything over a 20-25% position would be considered overweight. And we're not usually carrying more than say 30% overnight in any one name.
Mm-hmm. Yeah. Did you notice the entire time that we've all been talking that we almost exclusively have been talking about risk? And no matter what question you ask, it all roads lead back to risk management. And that's the bottom line. And that's what we just work at becoming better and better and better and better at.
And if you read the Market Wizards books, everything comes back to risk. They all mention risk management as one of the keys.
Yeah. I said it in my book. I don't remember what book or where I said it, but I remember I said it. But Jack Swagger, when he had interviewed me for Market Wizards, he came in and he threw his tape recorder on and we talked for hours and hours and hours. And he sighed and he took his recorder, he turned it off and he said, Mark, this is all great, but this is what they all say. He's like, this is what he's like, this is what everybody says. I've already written several Market Wizards book and they all say the same thing. I said, Jack, I hate to tell you, but there's a reason why this is what they say. And I'm sorry, but this is how I do it too. That's right. There's a reason why, and while it may be boring, I remember Jack telling me that day, he said, my Market Wizards books have been really successful, but I'd like to write one that people would like to sit on the beach and read it like almost like a novel. I said, Jack, that's not going to happen. I said, people are reading these books to read.
I'm very excited to read the next one. When does it come out exactly? I think it's like in June, right? I think it's in June. Yeah, June 9th. We already got that thing pre-ordered, ready to go. Only 6 months away.
Well, they did it, and they want tools, and yeah, they want stories too. But it was a fun conversation that we had. But I went right back to talking about risk and cutting losses.
Only the most committed traders are reading that at the beach, and I think there's definitely a lot in the audience who do that. Brandon, did you have anything to add as well, or cut from the same cloth? Yeah.
Yeah, no, definitely. But I was always taught early on in life that risk is bad, and I think when you really calculate risk is an opportunity. And I think when like what Mark just said, my job, what I'm trying to do is understand all the risks and get better at it. And I think if you do that, there's a lot of opportunity out in the world.
Perfect. You said you had nothing to add, and then there's that gem that you just provided. So thank you so much for that. Mark Ritchie, did you have something to add on that, or you just agreeing? Cool. Mark, did you have any other charts to share, or should we start with the
No, I didn't even know I was sharing charts until the last minute. So sorry about that. But
well, I think everybody really valued you walking through that. I know I got something out of it. So
they're all going to look very similar. That's the thing. We rinse and repeat. Certainly people will show the losses. The losses are really the most absolute most boring because basically we just buy the stock, and if it goes down, we sell it real quick.
I mean, yeah, if there was a way to ingest all the information in a more efficient way, then probably wouldn't be reading. But I mean, like if you watch, literally any single notable CEO, they all say the same, and not even CEO, like any notable person, they all say the same shit, and it doesn't even matter what field they're from, whether it's like finance or technology or like health. Everyone just harps on reading. It's a cheat code. It's a cheat code. Like, think about it. Okay, like that Ray Dalio book, like The Changing World Order, right? This guy's a global, like the head of one of the biggest global macroeconomic hedge funds in the world. This guy has to dedicate all his time to learning about like global macro factors and whatnot. He spent his whole life doing this. And then he just writes this massive ass fucking book summarizing like thousands of hours of knowledge. And you get to absorb all that knowledge in like 10 hours of reading, if that. It's like a cheat code, right? Like, for instance, this Market Wizard series, I paid like what? Maybe like I don't remember exact cost, but let's just say it was $200 for the entire series to read all the books. Those $200 and like 20, 30 hours it took me to read all of them has probably saved me hundreds of thousands of dollars trading. Along with all the time I saved not having to learn all those fucking lessons myself the hard way. So it's like each book is potentially like a lifetime of someone's knowledge being passed down to you. So yeah, like a very useful, right?
There's not a
These
whole
things
lot
aren't
to
to
show.
go.
Sometimes we sell them before they hit the stop. If there's a lot of what I call violations, that's what you have up here. Actually, this is what's called Monitor. We have a module in our platform that monitors the stock and looks at confirmations versus violations, which are basically programmed by me, what I would look at and with my own eyes, and then tells you, where you're getting. This one's set on what we call no-nos after you buy. So once you buy, we don't want to see many of these red lines, and you'll see there's very little here after the buy, and then there starts to be a bunch of them, and that's where we want to lay off. So then after the buy, like even right here, you can see there's very few. It's acting right, but then as it starts to not act right, you start to see the no-nos coming in.
Advantage if you can do
It's
it.
just these are just basically a sort of like
I mean, everyone can, right? Everyone can read. It's not like I mean, I hope. I guess nowadays, standardized test scores in high school, they're not vibing with that statement. Probably not everybody can read anymore. But yeah, it's like a pretty important.
A gauge of that would be looking at it like I look with my own eyes, a sort of a shortcut function, and then you could hover over them. It'll tell you which ones are triggering. So again, this is what we call the Fab 4 panel here that has the indicators that will tell you sort of what I'm looking at, just to get you in the right direction. You can't get too far off track if this panel is in line. It's hard to get too far off track unless you're arguing with the market.
Excellent. And I'll ask you guys kind of key resources and tools like that in just a second that people can take advantage of. But first, I want to ask this question. I thought it was a pretty good one. Hopefully you guys agree as well. But for everybody watching, if you had to give them one exercise to help them improve their trading, one assignment exercise, what would it be? And we talked very early on about post-analysis, how important that is to go through all their trades. So maybe it's something in that vein. But maybe starting with Brandon, if you had to give them one exercise that you think would help them, improve their trading, improve their chart eye, risk management, whatever it is, what would it kind of be, do you think?
Oh boy, that's a good question. Wish I was more prepared to answer it.
Yeah, that's a good question.
Obviously, tracking your trades, if you're not doing that, I just don't know how you're going to get better. Knowing what you've done is the best teacher, like we've talked about prior. So without that, I just don't, if you're doing that, great, then develop a process where that's repeatable, where you continue to do it, and then judge the results. Are you getting better?
Perfect. Mark Ritchie, do you have anything to add? Oh, you're on mute, I believe.
We covered a few of those things, but the other thing I would add, maybe that at least seems to be popular, is just shut off the noise. Take the indexes off your screen, take Twitter off your screen, take all that other crap off your screen, follow your rules, stay in your lane, and don't pay attention to anything else, and do it for a year, not a day or a week, and then come back to me or you and tell us how it's gone. And I think most people will be shocked how much better they do if they did that versus listening to all the noise and nonsense up there.
Excellent.
True. I mean,
Mark, I know
kind of goes with the thing we were saying the other day about like the funnel. When you're a beginner, like you kind of forced to funnel a lot of knowledge, because you need to know like what you want to work on and what works for you. So you need to expose yourself to a lot of things at the beginning. But then once you're like kind of have an idea, yeah, you're better off just kind of going in your own lane for a while. And once you got this kind of region mastered or on your way there, then you can start to branch out again. Because for me, like that was the biggest skill increase was this period here where I just said, because I was figuring shit out, right? But like I was still relatively new. So like I would be looking at stuff on the chart and thinking to myself like, okay, I should be taking like a long here probably, huh? And then I would go and like watch like some like good influencer like pundit on YouTube and they're like getting bearish at the zone or whatever. I'm like, fuck, maybe I shouldn't be taking a fucking long here then. And then it ends up like fucking bouncing, ding, like pixel perfect. I'm like, fuck this shit. Fuck these people. Start doing my own thing. And then that's when my trading just fucking ramped up like crazy, right? Like crazy, boy. The thing is, like, it's not even about being like right or wrong versus other people. It's more so like you're trading your system, your ideas. Other people are trading completely different data sets, completely different systems. And you can both be right. Like I might be thinking I wanted to long this zone, and the price comes like bounces here, and then ends up just going lower anyways, right? So like they're thinking about shorting here, I'm thinking about longing here, and we're both like correct. And we're both not losing money, worst case scenario.
Got some good tasks for everybody, I'm sure.
Yeah, I mean, look, when I first start working with somebody, if I was to work one-on-one with you and coach you as a trader, particularly back when I was running hedge funds and I had guys come work for me, I would narrow them down to just a very small number of parameters. Like I would only allow them to trade a certain area of relative strength, a certain price pattern, and say, look, you're going to trade this one price pattern in this RS with these characteristics, and you can't go outside that. Until you can trade that, you're not going outside those parameters to really get someone focused, because there's so much noise. There's so many things. Again, indicators, all these indicators. Now, I'm showing you some gauges that we have here, and I was very reluctant to even produce these because I don't use any indicators. I use no indicators whatsoever. But we did indicators in a very different way. If you even want to call them indicators, I call them gauges. We did them where they're really looking at the stocks. They're not like this. They're kind of a bias. They're kind of biased indicators. They're built around me and how I look at the stock. And it was amazing that we could even program this. I didn't think we were going to be able to, but we were able to do it very effectively. So this focuses you. Like these gauges do that. If you're sticking with when they have certain readings, and I have those recommendations for our members that you have these certain readings, you are automatically focused in a specific area and you can't trade outside it. So that's sort of what I'm gearing our whole platform around. Now, they're not going to, for a value buyer, these are not going to work. See, like a stochastics or some of these other indicators are sort of agnostic. You know, you can use them oversold, overbought. Not my gauges. My gauges are built around me and what Mark Minervini sees through his eyes. These things are like looking like me, and we're actually using AI now to enhance that and to look at the charts like Mark Minervini looks at them. Now, you could use them in all different ways. It's just the way we decided to do it for those who want to trade like I trade and learn my strategy. So I would narrow down to a very specific, you know, say whatever the parameters are, and really just filter it down so you're only looking at a very small number of names. Your screens are, people screen, they run all these screens, they got 500 names, and there's, you wonder why you're confused and you can't do well. You can't buy everything. You know, how many stocks can you even buy? You can only buy a couple. So, and you got to get used to letting a lot of pitches go by, you know, it's, and that's the way you do it. You know, that's the way you do it. You narrow your universe down, you say, hey, you know, and there's a good book. I forget what it's called. It's by Ted Williams, but it talks about, it shows a box. I'm going to put this in my next book. I'm going to talk about it, but it shows his box and sort of his sweet spot of where he liked the pitches. And Mark says this all the time. If I'm seeing the ball, that ball's coming into my strike zone. You know, we've got a very narrow strike zone. You know, and we're only swinging at those pitches that come in at that zone. You've got to condition yourself to do that, or you're never going to have a strategy. You're going to be all over the place, buying everything, listen to every tip that comes on TV, and trying all these different things. You got to narrow down. You've got to get focused, and that's the real key. And then, as they said, you know, Mark said one of the best things you could say, advice you can give, is to get the indexes, everything off your screen, trade the stocks, and as Brandon said, do the post analysis, go in there, look at the trades, see what you're doing. That's your best teacher, but do it on a very narrow, a very narrow set of parameters to start off with, and do that for a while. Do that for at least a year or two. You should be able to double your account first. I mean, you tell me I could only, you say, Mark Minervini, you could only trade 98 and 99 relative strength stocks that are 5% from their highs, I will make money. You give me those, give me any parameters. I don't care what they are. You give me any parameters, I'll make money. I'll figure out how to make money in that narrow window. And there'll be long stretches of time where I won't participate because nothing sets up for me. But that's what you have to get used to, because that's precisely what it means to have a strategy. There's going to be periods of time where you got to sit back and you got to let others take their turn, and then you get your turn. And you make as much as you can when it's your turn, and when it's not your turn, that's where you got to learn to sit on your hands, what I call sit out power, and not lose your money. Not lose what you made.
Excellent. A lot of
True.
people.
Although I would suggest just having multiple fleshed out strategies in both directions, like longs and shorts.
It's there, and that focus. Yeah,
Because it also helps a lot with the FOMO, right? Because like, let's say you're one of these people and you're just trading high time frame breakouts, and like some are like kind of forming but not really, and none have formed in the past like week or two. Yeah, you're probably gonna feel a bit of FOMO, right? Especially if you're like haven't been doing it for a while. Because like you kind of get you like over time the FOMO goes away, right? The more you trade, the more trades you miss, the more you realize there's always another trade. You start to just care less, right? It's like fuck it, like this GEV thing. The day that we missed it, I literally came on stream. I said, "Oh, I missed a trade. Feels bad." Forgot about it. Never thought about it again. Right? Who fucking cares? It's consuming. I'm doing the same shit sooner or later. But when you have multiple strategies, then like you can look for other setups. If you want to approach your FOMO that way.
I wanted to also talk about one other. Yeah, sorry, Rich, I'm sorry. I wanted to not only talk about the Master Trader Program, but I want to talk about my birthday bash before I forget. Yeah, I wanted to give that invite to everybody. But go ahead. I'm sorry.
No, I was just going to say one of the key changes I made in my trading was I limited my daily buy list to 3 stocks. I 3 years ago, I would have 15 names in there, which I'm trying to watch and manage alerts and all that. And limiting to 3 really helped me. That focus really helped me execute better, manage risk better, get tighter entries, all of that. So I would double down on that focus. I think that's a golden nugget. So thank you very much for that. And I was going to ask you, which leads into this, what resources, given what people learn today, if they want to learn more, where can they go to learn more and learn more about from you guys?
Well, let me say a couple things. First is that there's more resources than ever, and it's an amazing time to be a stock trader. It's an amazing time to be a human being. There's lots of crazy things happening in the world due to technology, but there's a lot of wonderful things. So we didn't have, when I first started, there wasn't a Master Trader Program, although eventually I went to the O'Neill seminar, which was pivotal for me. But we were going to the library. I was going to the library reading crappy books about strategies that never worked in the first place. So it took me a lot of time. That's why it took me 6 years. I had to figure this shit out by myself. I was graphing the stocks on graph paper by hand in the beginning, which some people can't believe. But and standing outside a brokerage account to go in and check the quotes because I didn't have quotes. So crazy things that I went through, the commitments. And then of course, Brandon selling his car, we've all made these sacrifices to get to where we need to get here. So the resources are fantastic.
Right, that's the other thing, right? People think it's easy. It's not fucking easy. I literally sat here before I was streaming. I was doing the same shit, same fucking shit, sitting here nonstop every fucking day. No going out, no partying, no friends, no nothing. Every single day, like fucking 16-hour plus day nerd outs every fucking day. Still doing it to this fucking day, right? You definitely got to put in the fucking work, right? To this day.
The problem is that there's information overload now. There's a lot of self-proclaimed experts that are turkeys in a strong wind, maybe have a good year, and they think they're ready to teach the world.
Turkeys in a strong wind.
You have to be very careful of who you're listening to,
because
there's so much information and so many people to listen to. Obviously, I'm biased to my strategy. I think we've proven ourselves over 40 years of my own results, 15 years. These guys, U.S. investing championships, thousands of people around the world. I've got a very solid platform of based on fundamentals. O'Neill, is his books are homogenous with mine. The Market Wizards books are always great to read for inspiration and to learn about how some of the greatest traders, particularly the first Market Wizard book is wonderful. You got Paul Tudor Jones in there. These are going back to my lineage. So there's tons of information, but you got to guard from information overload. I think that if you read my books and O'Neill's books, you don't really have to go anywhere else. You might add a couple other books on psychology. You know, you don't really need any more than that. Everything's right there. You're probably going to dilute and start to go outside, you know, the strategy. And then there's other strategies that I can't recommend on, like if you wanted to have value and you're doing a, you know, a strategy that was more of maybe a Warren Buffett strategy, a Benjamin Graham strategy. I know nothing about that, so I couldn't give any advice on that, but that's another way to do it, you know. But my advice is to commit to one of the ways that makes sense to you and matches your goals and your risk tolerance. That's the main thing, is your risk tolerance. You could have one strategy that says you got to hold through a 50% decline. Well, you may not be okay with that. That was never okay with me. I tried it and I felt like my stomach was bleeding. I was going to get an ulcer. And I said, well, I'm not doing this to get sick.
They couldn't update this guy's infographic. This guy's like a different human being at this point. He's got glasses, a ball top. This is like 20 fucking years ago. When the winds are strong, even turkeys fly. This is a Wall Street adage, meaning that in a strong, favorable market, even poor quality investments, companies can appear successful and perform well. Yeah, that makes sense. In the market, 16 hours a day, it's kind of fun. Yeah, it depends on the person, though. I don't think many people would enjoy, like... We'll say this, it takes a special kind of human, probably a little off, something's probably a little wrong with you. And this applies to me, to just be isolated for like, I was isolated for months on end, right? Quit my job and I was just nerding out for months on end by myself. The only time people would see me is at the gym. Other than that, then I'll leave my house for anything. Or talk to people. So not many people can kind of deal with that kind of isolation. Even now, it's like it impacts you, right? It impacts you. You have to be pretty strong-minded in that regard because it's not normal. It's like unhealthy.
You know, I'm almost to make money and to have success. I just couldn't go through the drawdown. So I came to this strategy because of the risk aversion. And I think Mark and Brandon are similar in that way, where the risk aversion was the attraction to this strategy. But there's lots of strategies. There's lots of resources out there. Of course, now let me just say two things real quick. Master Trader Program, of course, this is our 14th or 15th year, right? 2010, yeah, 15th year. Going to be online in November. It's 5 days of curriculum, or actually 4 days of curriculum, 1 day of live trading, and then we do Q&A days during the week. I think 2 this year, so it's actually 7 days. But the thing I wanted to point out to everybody is we for our members, if you come to the Master Trader Program or you're an MPA member, we have a gala now. Once a year, you come and we all get together, all the clients from around the world, and we exchange ideas and we have special guests. It's just a wonderful, awesome day that we all get together and have fun together and learn. Well, this year coming up, my birthday, my 60th birthday, is in January. So we moved the gala to January 18th because on the 19th, I took the House of Blues, the entire House of Blues in Myrtle Beach. I've got a national band coming, which I'm going to be playing drums with the band. We're going to have, I don't know, 500-600 people, maybe even more. Clients are coming, friends, family. So if you're a client of mine, you're welcome to come to the bash. I want everybody at the birthday bash. I wanted to do this when I was 50 and I didn't. I regretted it. So now I'm going to do it when I'm 60 because God knows if I'm going to be here when I'm 70. So just wanted to give that invite also.
Yeah, fantastic. No, excellent. The last question I want to kind of close things out today, and first of all, I want to thank all three of you guys for being here. I think you guys have all shared a lot of golden nuggets, so thank you very much. My last question is this: what kind of final piece of advice would you give everybody watching this? You know, what final piece of wisdom? And this could be trading or also life related, however you'd like to take the question. And Mark Ritchie, I'll start with you, not to put you on the spot or anything. Oh, he may be frozen actually.
Is he?
Brandon, we'll go to you. Hopefully, Mark's able to come back.
Yeah, sure. So for me, obviously, this Master Trader Program changed my life. Yeah, it seemed like a lot of money at the time, but man, has it paid many, 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 many multiples of that. So I can't, obviously, you know, I get to work with Mark every day, so that, you know, I might be a little biased, but if I wasn't working with Mark, I'd still be a client at MTP because Mark is such a great coach, and I believe in that. But, you know, this idea of everybody overestimates what they can do in 2 years and underestimates what they can do in 10, like that, to me, that's my life. And, you know, it takes a while for you to understand that and get that, but that's what I would say. Invest for a decade into learning this approach for us. Like Mark said, there's a bunch of different things out there, but you got to invest the time. You get in what you put out. And, you know, yes, I sacrificed by selling my car, but I also sacrificed many other things to get to where, you know, I am today. So there is a cost, and, you know, sometimes it's friends and you know, leisure time, which I sacrificed. But it's been worth it. So.
Perfect. I was engaged several times, and once I had a girlfriend for 14 years and was engaged for 5 years, and every one of them said you love your work more than more than me, which to a certain extent at the time was true. And so I sacrificed a lot too. I delayed having children. I delayed a lot of things to put my full time into trading, and really my whole life went into this. And even to this day, writing books, it's a lot. It's a lot to write a book. And my advice would be the mindset side is really important. I wrote the mindset book because that's really the most important part for a lot of people. Because I mean, if you grow up wealthy, and you grow up in a family, you're privileged, you know what? You've got a big handicap. You feel entitled, and that's a handicap. And if you grow up poor, you grow up with a handicap. You feel unentitled, and you feel and you have a poverty mentality. Both sides create challenges, and mentally, that's what it comes down to. Because this is a very, very difficult profession. It's even difficult as a hobby. And so I think the mindset is the most important. And if you definitely read my mindset book, because that book was written as much from the heart and as much research and as much personal experience that I could ever give. And I think that's the most important element that will get you to where you need to get.
Excellent. Thank you very much, Mark. And Mark Ritchie, I don't know if you heard the question. You tried to duck out.
No, I got booted. I'm not sure what happened there, but yeah, I did hear the question. I'll just add, look, I think the market still provides a great opportunity, an opportunity for people to have, life-changing results. But yeah, you've got to find, for lack of a better word, a process, a strategy, and possibly even a coach to get you there. But yeah, I think look, we're living proof of that. Mark's living proof of that, and the success stories will continue to be there. And it's a really rewarding business at the end of the day. And so, but you have to treat it like that. So that would be my piece of advice.
Perfect. Well, I just want to thank you guys one more time for being here. I really, really enjoyed this. Thank you guys all for the gold nuggets, and hopefully everybody watching this really enjoyed as well. Check out the resources, the Master Trader Program. I attended in 2021, really enjoyed it. The workbook, which you guys didn't mention, is just by itself a fantastic resource. So many model book charts. If you want to improve your chart, that's the place to be. And I'm considering joining again this year. And the gala tidbit, Mark may have just tipped the scales. So
you have to be at the gala. So everybody at DPU needs to be there. You guys are invited, of course.
Awesome.
Scientists at Johns Hopkins University had a recent study that told us spelling your own parts can improve cognitive function. I mean, yeah, I guess that's one way to go about it. That is one way to go about it. Let's fix some of this stuff. We'll put this back down to here. Put this. Put this there. We'll wrap up these notes. And do this juice boxing out of here. Yeah, this game's incredibly taxing, right? Very taxing. Well, in terms of having to sacrifice stuff, and also you can't have like a hard to say. You have to be confident, but you can't have an ego, if that makes sense. Because like if you're a know-it-all, you're gonna get taxed. You're lazy, you're gonna get taxed. You're fucking emotional, you're gonna get taxed. You're not introspective, you're gonna get taxed. Every flaw is like brought out here, right? But anyways, juice motherfucking box. Let me look at some of the data real quick. So how's the weekly looking right now? Oh, interesting. Oh, they're trying to defend this for real. Trying to defend this. Interesting. Interesting. Because all the spot orders are 85 and lower. And right now there's like a massive buy wall in the perps order book right here. Massive. And they already, and it's not even a spoof either. They already got filled on part of it. Interesting. I have my doubts of that holding, to be honest, but let's just look at some of the other stuff. Interesting. I don't know if that's gonna hold, to be honest. Like, there's basically one order trying to hold up the entire fucking market. I don't know if that's gonna play out like that, especially with how this shit's all looking. Clean up some of this garbage. So we'll get rid of this because this one's not particularly relevant. Right, yeah, as usual, right? For Lyle, the non-believer of the math, another golden pocket bounce in this bitch. And what you see is pretty common, right? If it bounces here, then it starts to come back again, it like nukes through the second time. So local price action shit going on there. And then again, right, another bounce at the golden pocket again. But we'll get to this one. The smaller one's not particularly relevant. Actually, just out of curiosity, where was that? I was gonna say, in terms of this like 886 to like golden pocket thing, keep that in mind. Keep that math in mind. Because that will be like a potential short setup, right? Coming up to the zone. I just want to see what the liquidity is looking like on the low time frame. Because this move down had like a crazy ramp up in open interest. Like, this is the open interest on this move down. Like, a lot of shorts like piled into this move. Yeah. Oh, is that even? Where's the calculator? Damn, it's still over $1 billion in shorts just in this low leg right here. It's a lot. It's a lot. Which makes me think this might hold for a bit, right? Like, squeeze some of these people out. Could be the low, honestly. Like, it seems it'd be a bit surprising. But if they're gonna defend this and start to squeeze back up, this would be the place to do it, right? While front running all the spot orders. Ideally, these come along though, right? They're not looking particularly strong right now. Just kind of hovering below the point of control. And on the higher time frames, like, yeah, right. Looking a little sus. A little sus. Closing below the Valeria low on this thing. This is like the line in the sand, right? Kind of zone right here. Basically, it have to be like a high time frame failed auction of this like all this value. Essentially doing this kind of thing, like ding 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 ding. Like right at this point of control. Looking sus though, looking sus. Boom, 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 boom. Okay, anyways, I started yapping. Started yapping about this stuff. Potential longs. Yeah. Eight, 7, 7. Interesting perspective. What is? A long and short theory. Not sure what you're referring to exactly. 872, 866. The shorts have it. ETH tagged this perfectly too. Let's look at some of this options data first before anything. Because like, if we do start going from here, essentially, like we have to be uncorrelated from the rest of the markets, basically, right? What it's looking like. It kind of makes things a little suspicious, right? A little sus. 6920, 6800. Six, 7, 1, 5. Interesting. Like, right now, the price is going to be like pegged in this range. But if we start to lose this level, it's going to start accelerating down. It'll be pretty interesting to watch like how this level reacts tomorrow. Interesting. Because if it does start to like do like the bounce back up, then kind of help the bullish case of this being like a temporary low potentially here. This will be tricky, honestly. This is a little tricky right here. There are so many buys in the spot order book here, from like 85 down to 79. There's just like infinite Bitcoin buy walls. It's gonna take a lot of selling pressure to get through this shit. And if we do get enough to get through it, I don't know if it's gonna be enough to like continue a sustained move. Like it'd have to be like fear entering the market, causing people to like panic sell at that point. Which probably would see, right? People are just like taking the breakdown trade to the low. Really risky though, because this could be some like mega bear trap happening kind of thing. Like one last move down, stop all these positions out, and then you just yeet back up. Definitely be watching the data to get down if we get down there. But anyways, whatever. We already talked about this zone, right? Most of the perps liquidity is here in the middle of this like massive spot wall. So like they might start denting through the wall and then just kind of get absorbed down here. Like this zone obviously is like kind of like the main zone of interest. Especially given that most of like liquidities in the upper part of the box is just right to 786, right the yellow line, right the 2.5 extension, right the poor low, blah 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 blah. Obviously pretty important level of interest. Also, this is the point of control of this range, right? Like 84 region. So a lot going on right here. It's gonna be like a pretty interesting zone, right? I'll go as far as to say if this zone is lost, it's fucked. It's probably fucked. And normally I would be saying that if the order book wasn't looking the way it's looking. But the fact that there's so many buy walls here, unless they pull those orders, like, yeah. They're really trying to defend this bitch down here. So whatever, we'll leave this here, right? Like kind of like 83.7 region. We already talked about this. Like none of these lower levels has changed, right? But we've already discussed all this in the past anyways. 3.7k. Liquidity grab at the poor low. And all the other levels we've discussed, all the lower levels have been discussed previously. Hey man, hello Mr. Vex. Hello Mr. Vex. Yeah, let's kind of go back to when we were talking about that stuff. And from the upside, hard to say. Hard to say. Because like, if you were going to take this, it would have been like we were talking about this at the start of the stream, right? Like this zone was one of the long setups that we talked about previously. Like you would have gotten filled like on these two levels, right? Like ding ding, or you would have got filled on this pullback. Boom, boom, boom. And like a lot of liquidity here. This box, like this is like kind of mini liquidity. This is like where there's like start to see like major liquidations up here for the short side. So from all the people that plowed into this breakdown, a lot of them got in like right here. Like this high volume candle is where like a lot of the shorts piled in. A lot of people here for the juice, came for the juice. Must be some good juice today. Okay, we're getting to a pretty pivotal point in the game right here, right? Because if this lower level gets lost, and they rip through this order book wall, like we're going like way lower, right? Like 72 is probably like the next kind of region. Like maybe we do like a tap, like some kind of triple tap down here. But like pretty key zone, right? The key zone. I'd say if they give you the retest of this level, whoops. Like, let's say we come up, and this will be one of the short opportunities, by the way, right? Yesterday's VWAP on this like liquidity grab to 382. I suppose that we come up and do this ding, and then you come back and get the retest here of this thing. Probably gonna be like your long, right? Whether it's this or this with your stop here. Or if you take this one, like stop lower down here somewhere, targeting this higher shit. Probably gonna be your best bet. A bit tricky though. A bit tricky. I'll kind of just say like a bullish retest of 86.4. Because there's a lot of shorts here, right? Like this is like an egregious amount of shorts that piled into this move. $1 billion in like 2 candles worth. It's a lot, right? And yeah, the other bet, the more safer bet, would be potentially getting in on the retest of this higher level. Like if we kind of do this, if we reclaim this stuff and start going, this kind of thing. Might not get this though, because this could end up being like a pretty aggressive move back up, right? Like the kind of thing that we were seeing back here. Where it's like we're just kind of like going up and down to the same like low volume zone, like just might be seeing the same thing here, right? So don't be surprised at all if tomorrow this thing is just like right back up. But we'll leave it written on here. Bullish retest of 87.7. 87, 88 region, you know how it goes. And then all the higher time frame stuff to the upside in terms of like longs of like this red box. Already talked about it. Nothing's really changed there. We should get more clarity once we get actual job data and CPI this week. Yeah. Also, it's a Bank of Japan stuff, correct? I just don't like. I don't really know if that's gonna really care for what's going on with Bitcoin right now, to be honest. Like, I feel like what's happening here is just like in its own bubble, its own little world. Because either these buy walls are either getting pulled, they're holding, or they're getting fucking punched through. Like that's only 3 options here. And if they're spoofs or they get punched through, we're probably going way lower, gun to my head. Because that's also like the max pain move, right? In terms of people waiting to get like a dead cat bounce to the higher levels and they don't give you it. People were sitting here talking about like 100 plus K, like 98, 100 plus, blah, 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 like planning to sell all the dead cat bounce, and the best they gave you was like 93, 94. So most people probably didn't sell anything. So if they drag your ass lower now, sheesh. You want to talk about capitulation? You might be seeing it, right? Might be seeing it. But it's gonna have to be hella bearish, right? This is a lot of Bitcoin in the buy order. I haven't seen a wall this big in a long time. Long time. Boom. And for the shorts, I mean, it's like these 3, right? Like this thing we were talking about with like the low time frame liquidity, like this zone. And then we were talking about everything else yesterday. Nothing's really changed in that regard. Now, like low time frame 382 liquidity grab. Second one's like what? Like the golden pocket. Single print liquidity grab. And like the high time frame plans haven't changed. Boom, 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 boom. Yeah, that should do it, right? It should do it. Anyway, interesting times ahead, right? Well, lots of possibilities here. It ends at 78. 78 is the last buy wall. So there is a world where we like triple tap this kind of thing. Maybe we do like a massive 3 drives here on the high time frame to sweep the final low before reversing, if we reverse. Anyways, right, to be planned, prepared for all situations. I might be reversing right now. I reverse right fucking here. Because there's like fucking 3,000 Bitcoin in the perps order book right here. Trying to defend this low. Delete that, delete that. We'll get rid of this thing. Delete this. Also, the thing we didn't mention it, but like the 886 from like this fib that we had earlier, the 886 like the golden pocket, kind of confluences with this short. I'd be careful though for all this stuff. I mean, as always with the juice box, like don't trade it blindly. Like make sure like you're looking at the data and you have edge at the moment. But I'd be careful with these shorts because if we do start to squeeze up, it can get like pretty violent given how much nominal value of shorts are in here. So be careful, don't get got. Do not get got. Yeah. Yes, on Friday, I believe. Oh, the Japan stuff? I mean, I don't know how volatile it's gonna be. 'Cause like it seems like everyone's kind of expecting them to hike it, right? Seems to be the case. Yeah, we'll see. A lot of data coming up this week though, right? We kind of talked about this a few weeks ago and last week, but pretty interesting week, right? A lot of data coming out. Hopefully we're all planned, prepared, ready to go. We're not. Are we just winging it? Winging it. Juices are flowing. I'm curious. Because you don't see this too often, right? It's like a fucking this is like the it's like those videos you see people in the club in Atlanta just ignorant as fuck. And they're just buying bottles and pouring on the fucking ground, right? Just fucking a pissing match of money. It's what we're about to fucking witness down here. Who's got more money to just fucking blow? That's what's about to go down essentially. Cause yeah, like how much is this right now in terms of like Bitcoin? Damn's a lot. One thing that makes me paranoid about these walls down here is like we saw this before, right? Pretty similar. Where was it? I think it was here, right? Somewhere in this region. But at one point, there was like 1,500 Bitcoin or something in the spot order book, and they fucking ran through that shit. Fucking plowed through it on the market open. It's gonna be the same story as today, essentially, right? Like all eyes looking at the order flow when the New York session starts. Boom, 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 boom. All eyes open, glued to the screen. Boom, boom. Michael Burry Substack is long today. I don't know if I'd give that much thought, to be honest. Long in length? Oh. I can't say I give it much attention, honestly. Also, like, I makes a lot of money from that shit, though. Have you guys seen the math behind that? Makes a lot of money from that. Boom, 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 boom. Did we miss anything? Did we miss anything? Michael Burry, the perma bear. Okay. When they leave for Christmas break? Good question. Good question. I don't know yet. I'm definitely here until at least Saturday. I have to get my stitches removed. And I'm also waiting. I have to get an ultrasound of my shoulder. And I submitted the request to the place, but they haven't called me back yet. I'm supposed to have it done before Christmas, so I'd hope it's sometime this week, maybe early next week. The latest I'd be here is the 24th. So sometime between now and then, but in terms of a set schedule, nothing particular in mind. Something like that. Are you sub to his Substack? What did he say in it? Out of curiosity. Guys, yeah, it's almost Christmas, right? God damn. We have to have our 1 year channel anniversary. We're gonna do it in the style of a mastery. Kind of reflect on the year. then that way next year we can kind of look back on it again, right? Do the same thing. Because I don't know about you, but like after watching these channels, like come on. Tell me these traders aren't my fucking kids. They're literally my fucking seeds. We're gonna put them onto real trading, right? That high rank shit. None of this fucking copy paste VCP breakout only trading garbage. Come on. Put them onto that real trading game, that real rank 100 plus. Hopefully. Can you imagine? We're on one of these interviews next year. Can you imagine? Also, roll the radius sit sideways, by the way, right? Don't think we have to be seeing some like volatile move one way or the other. Yeah, it is options expiry on Friday. Also keep that in mind. Oh, it's also a quad witching, by the way. Was the Max Payne for options expiry? We looked at it pretty recently. I think like this week was pretty low, and then the next week's like really high. And the next week's like the main Bitcoin one. Where's this thing? On the 19th, Max Payne is, what is that? 88k. And then on the 26th, it came down a bit actually. It's 98k. Same story on Binance. It took a little higher on Binance. It's like 90 and 100. Thing is, we have to keep like the IBIT. I don't have a good place to look for the IBIT data. The IBIT is like the biggest options flow now for this stuff. Also, no guarantee you have to go here. Like at the end of the day, like just price trending towards this reach. Okay, like if the price is here right now and the Max Payne's like 98k, then like closing any price better than this is like just good enough, right? It doesn't have to come exactly to 98. So like typically you'll see it like gravitate towards these, but they're not like exact magnets. Price is just gonna like ding, like right to 98 on the dot. Usually, sometimes you see it like that, but not too often. Because you'll see it a lot, right? Especially like the Bitcoin specific expiry, like the 26th. Like if you stay awake at night to look at the chart, because it expires at like what, 3 in the morning or something? But if you go like back and like back test it and look at these, like, you'll see like in the middle of the night, like right before the hour before expiry, price starts to just like you just start pumping randomly, right? Going in one direction. Okay. Let's wrap this thing up and get out of here. I'm tired. Got a lot of shit to wake up for tomorrow because this stuff's pretty early, right? All the data releases. Hey, 8:30 a.m. So it's an early morning tomorrow. That's the other thing. If we start to like nuke lower for real and it's looking like hella bearish, I'm probably just gonna close out the longs. Probably just gonna close them. And right now I'm just leaving them both open as is to have the gains locked in on the positions. But depending on how we react down here, we'll kind of decide. Same with up here on the shorts. Kind of like the two decision zones for me. But realistically, the shorts, I'm probably just gonna keep them open for a while until we like can clear the level that we've been talking about. More of an insurance policy than anything. Yeah. Anyways, I'm tired. Let's get out of here. Roll back to this chat. Do a quick chat shout out to all the yappers in here. Shout out to Dev. What else do we got? Now, I don't know how your fingers aren't tired at the end of the night. You just in here writing a goddamn essay day after day. God damn. You must have jacked fingers. Shout out to Lyle. Shout out to Mr. Vex, late to the party. Shout out to Harris Kamal. Was it right? I type a lot. No, me too, me too. I'm always sitting here just yapping away. Typing up a storm. Because like during all those videos, I'm typing notes, right? I'm like, how big is this document now from these videos? Out of curiosity. I could probably write like a trading Bible, no joke. Just look at this. Where's the page count? I've 35 pages of notes for the stuff that we've been watching on stream, plus like a handful I watch off stream. And then like the notes that I write for myself for trading. Wait, that shit is crazy. This one is 60 pages. This is just one of them. How long is this? This one's it's not even done loading. Holy shit. This one's 210 pages Google Doc of trading notes. But this is from when I first started. This is like the OG one, the trading notes from day one. So this is like all the way to the most basic beginner garbage, right? I'd have to look between that and the notes I have on this tablet, like handwriting notes. I must have, I don't even know. Probably like somewhere in like the 700 page region of the Google Docs worth of notes, of like trading notes. Yeah. I take a lot of notes on stuff. To do a type eraser one day. Yeah, we can. I think I'll probably beat me though. How do you even do that? Type eraser? Is it just like a code we'll enter? I used to be much faster at typing, but now that I don't like code anymore, kind of like tapered off a bit. Boom, boom. Also, I don't have like the perfect typing technique. Like I don't know if you guys have ever tried to sit down and learn how to type with like perfect finger placement. I tried to like relearn how to type properly and do it that way, and I just gave up. I was like, fuck it, whatever. Whatever. Yeah, we can do that though. You guys want to get your ass beat in Type Racer? I type a lot, but I did not say I type fast. Yeah, because it depends, right? It depends the typing speed. It's like a trade-off. There are people who can type really fast, but the real question is the error rate. Because if you're like typing really quickly, but then you constantly have the backspace to like fix an error or be like other word, that actually slows you down a lot. That tech lead guy made a video on it. That guy tech lead, that guy's an elite typer. I don't know if you guys have seen his video on that shit, but goddamn, that guy's elite at typing. Like super fast typing speed with no error rate. I was watching this video, I'm like, damn. That's a fucking nerd. My mechanical skill is in video games, right? WASD. And that shit you do not want to smoke, I'm telling you. I'll give you guys a beatdown 1 by 1, whatever game you want. Okay, technically, what is that? What? Okay, technically, though, that method in school. No clue. What does that mean? I guess you're saying that they taught you that, but you just do whatever you want. I mean, it is important though, because like you have to think about what's it called? The long-term ergonomics of typing. It actually is like beneficial to like type with the exact finger placement that they tell you, and also ideally one of the split keyboards, like not like the typical one that's just like this kind of shit. Like ideally you want the actual split keyboard. Your hands can be like further apart and at an angle if you're really trying to nerd out on ergonomics. Did Michael Burry perfectly play a GameStop? I didn't know that. Not sure. Not sure. I saw him post something that he was like emailing the who's the guy? Who's the other guy? The kitty guy or whatever. Roaring Kitty. I don't know if he was actually part of that trade or not. I wasn't either. I didn't know anything about trading back then. But anyways, whatever. I'm out of here. I'm out of here. Out of here. Be back tomorrow. Usual time. Let's see how this day plays out. Do we get volatility? Do we not get volatility? What's the rest of the market doing? Is this Tesla thing gonna go or what, right? What a tease this thing's being. Is this thing gonna finally break out for real? Or no? Or no? Or no, right? We've been patiently waiting for this thing. He calls it the big short squeeze. I'll have to research it. I'll research it later. Yeah, I'm out here. We'll continue discussion tomorrow. I need to go to bed. It's almost 1 o'clock. Wake up in like 6 hours, basically. So later. Later. Stay safe. Do not get got.